Secretary Robert F. Kennedy Jr. said to be pushing for a change to childhood vaccinations. Secretary Kennedy is looking at the Danish system, which recommends only 10 of the 17 shots on the U.S. list. Joining us now, former FDA Commissioner Dr. Scott Gottlieb. He serves on the board Pfizer and United Health. He is also a CNBC contributor. Gottlieb. Dr. Gottlieb, good to have you on.
Morning.
What's the, what do you think of this?
Gottlieb.
When you talk about stimulating the immune system, there are obviously great benefits to being able to do that in terms of these herd diseases that we basically have eradicated.
Gottlieb.
I can see how, in a perfect world, if they were gone, I'd rather not be introducing, antigens, foreign things into my body or my kid's body if I didn't have to. Does this make sense the way Denmark does it?
Well, they make a decision to accept preventable hospitalizations.
Good answer.
Pediatric population. They have a much different healthcare system than us. They have paid sick leave. They have universal health care. But they also accept a higher rate of hospitalization and deaths, quite frankly, on a per capita basis. They don't vaccinate for flu, hepatitis B,
Look
hepatitis
together.
A, rotavirus, varicella, a chickenpox, meningococcal disease, which is a devastating disease, rare but devastating. RSV prevention in children and adults. And just to put that in perspective, RSV alone, before vaccination, accounted for 60 to 80,000 pediatric hospitalizations in the United States under the age of 5, about 100 to 300 deaths annually. It was fully 10% of all hospitalizations, infant hospitalizations, were accounted for by RSV. That's dropped 70 to 85% as a result of the introduction, not of a vaccine, but an antibody drug that's used as prophylaxis and also a maternal vaccine, so a drug called Beyfortus by Sanofi. To give you another example, with varicella, chickenpox, we all remember getting it. There were 100 to 200 deaths a year from varicella and about 11,000 hospitalizations. So these aren't benign diseases, and they put a big burden on the healthcare system and families and cause a lot of morbidity. They accept that in Denmark. They also have different patterns of spread among these diseases. Historically, we have not accepted that. If we go to the Danish model and we end vaccination, or substantially reduce vaccination for these diseases, we're going to see them resurge, and we're going to have to build new pediatric hospitals.
So what's the scientific rationale for doing it then? Or there isn't one?
Well, look, they put forward arguments about purported causal relationships between vaccines and autism and other things. I mean, the argument is constantly shifting. Before, it was supposed to be the preservative thimerosal that was in vaccines that caused autism. Once we reformulated the vaccines at FDA, and I was there when we did it to take that preservative out, the argument shifted to the adjuvants in the vaccine. They also say that children get too many vaccines, but if you look at historically, in 1985, children were vaccinated for 7 diseases and received about 3,000 antigens. Today, they're vaccinated for 15 diseases and receive about 180 antigens to get back to your initial point. So you're getting protection from more diseases with fewer exposure to antigens. I think this is really about, quite frankly, liability. If they move away from recommending these vaccines and move them to a different configuration on the CDC schedule called shared clinical decision-making, there's a question of whether or not they will still have liability protection under the vaccine injury.
That's true.
Whether people will be able to seek compensation through the VICP, whether they'll have to sue manufacturers directly. And a lot of, Secretary Kennedy's trial lawyer colleagues want to be able to sue the manufacturers directly and not have to guide parents through the vaccine injury compensation program. And in fact, they were on Twitter this weekend saying that. They were talking about a number of the people close to Kennedy on the outside, working the trial lawyer community, were talking about the fact that if these get moved off the recommended schedule, it will waive the liability shield that
Don't believe him, Gottlieb.
that was put in place to entice manufacturers back into the space. I will say this is an open question. There's arguments on both sides of this question whether or not these vaccines
Don't believe him.
under the VICP. It's going to get litigated. They may have to go through rulemaking. So this is an open question, and ultimately Congress could step in and legislate, although I'm doubtful that they would.
Have studies been done on the adjuvants that you were talking about and whether that could actually be one of the reasons for the increasing rates of autism It almost looks like this is, that, and the way the word science is thrown around lately, at least for me, there's plenty of science that I think is junk science. I do, but just to have a feeling, wow, there's a lot of autism, must be, maybe it's the adjuvants, it's obviously not the thimerosal, maybe it's Tylenol, it just seems sort of scattershot, and it almost seems like not science-based, and it doesn't seem like the way you want to run a healthcare system.
Yeah, look, I think the rising rates of autism, we know some of it's related to diagnosis. There's probably demographic factors at play. Older birth cohorts, people having children at older age.
Well, just thinking it might be because it coincides with the advent of a lot of vaccine usage. Just using a coincident indicator without having the double-blinded studies that take into account all the variables doesn't seem like the way you should be setting policy in the country.
Well, look, I agree with you, Joe, and there's been good studies done looking at...
Why don't more people say it then? They're afraid to say it?
Well, a lot of people do say it. I think that, the people currently in control of the public health agencies don't say it, but there's been a lot of good studies. This has been one of the most exhaustively studied questions probably in modern times, and there's 4 studies that people generally point to. 2 that
How dare you talk to Gottlieb like that?
Denmark, believe it or not, they do very good vaccine research there, looking at the question of whether or not there's a causal relationship between increasing vaccination and rising incidence of autism. And these were long, exhaustive studies, some of the largest studies done. And they didn't show a correlation between vaccination and rising incidences of autism. And the thing that a lot of the people who are opposed to vaccination, and Secretary Kennedy points to, is an adjuvant used in the vaccines called alum. We've talked about this. It's an aluminum salt, not elemental aluminum. It's an aluminum salt. It's been used since about 1930. It was introduced when, the history of the Great Depression that Andrew wrote about started. So it's been used in vaccines for a very long time. It's a safe adjuvant. It's used, as you know, as an immune booster so that you can get a better response from the antigens in the vaccine. If you took it out, you'd have to put more antigen into the vaccine, which you wouldn't want to do. But that's what people point to now. After thimerosal was removed from the vaccines, the argument of the anti-vaxxers shifted to, well, it must be the alum then.
Well, Tylenol, it's just kind of scary. Talk about most favored drug pricing. I always worried that if we import price controls that it's going to hurt innovation. How did this all come to pass where it's like Emily Latella, never mind, it's not going to hurt innovation if we import, the prices that some of these other countries have negotiated down, or I don't know, it's not even negotiated, they've capped prices.
How dare you?
Yeah, so look, there's under the IRA they did, but there's a lot of different elements to what the President Trump has been doing with respect to drug pricing. The latest announcement that came out on Friday was that they are putting in place mandatory rebates for certain Medicare drugs, Part B and Part D drugs, based on the price differentials between what the drugs are sold for in the U.S. and in Europe. So if the price differential is significant, it's sold a lot less expensively in Europe versus the U.S., companies will be obligated to pay a rebate back to those programs. But it looks like the impact of this is going to be relatively muted. It's only going to affect anywhere from 5 to 10% of overall Medicare spending on drugs. There was a good note out from Raymond James this morning. Chris Higgins, who worked with me in the first Trump administration, he was working at 8 cents at the time, did an analysis on this. And it's probably going to have a limited impact. There's also a question of whether or not the companies assign these MFN deals to basically cut a deal to offer mandatory rebates in the Medicaid program, whether they'll be subject to this new demonstration project that was announced on Friday. Many people think they won't. Genentech put out a press release suggesting that they think they won't be subject to this new announcement that was put out Friday. I will say, though, the most significant part of what the president announced, which I think hasn't been talked about, is that in these MFN deals he's cutting with the companies, they're agreeing to launch their new drugs at a world price. So they're agreeing that any new drugs they launch, they'll launch them for basically the same price in Europe that they sell it for in the U.S. And so going forward, you're going to see prices in the U.S. on new launches probably come down, prices ex-U.S. go up. I think that's the most significant piece of all of these deals, is the one piece that hasn't been talked about. And final point here, they're holding on to 4 more deals with 4 additional companies. That's the speculation in Washington right now. but later this week when they make an announcement about the rollout of Trump RX, this is going to be a website where people can go online, buy drugs directly at a discount, drugs that companies offer to sell there. And so they're going to announce that, and they're going to announce 4 additional MFN deals with additional companies. The president, I think, hinted that one of them was J&J. That's the speculation right now among folks in Washington.
All right, thank you, Dr. Gottlieb. I love it. It's right in the intro. You know, every single time, Pfizer, Moderna, every single time, and yet I hear immediately no mention of the Pfizer. I don't know, people have excrement in their ears, or they just don't want to hear that we disclose that you're on the board of Pfizer. They just, it's part of their narrative.
And we disclose it while we're talking as well, right?
So yeah, we disclose it while we're talking, but you're obviously conflicted, and we're hiding that, and we never say anything about Pfizer. Can you say it one more time? Don't do it. I'm joking. Dr. Gottlieb, thank you. Good to have you on.
Thanks a lot.
All right, coming up in Video on the Move, we'll tell you why next. Plus, Pennsylvania Senator Dave McCormick is going to join us to talk about the challenges ahead on Capitol Hill in 2026. Talk about it. We'll be right back.
We got a market flash for you. NVIDIA now telling Chinese clients that it aims to start shipping its second most powerful AI chips to China by mid-February. And that's according to a Reuters report that says it plans to fulfill initial orders of the H200 chips with existing supply. The plan is contingent on government approval. Meantime, you can take a look at shares of NVIDIA as we speak right now. $184, up about close to 2% right now. We come back, Pennsylvania Senator Dave McCormick is going to join us right after the break, talk about his message for the Keystone State and the legislative agenda for the new year. Squawk Box returning after this. Welcome back to Squawk Box. Our next guest planning to discuss his letter to shareholders, the people of the state of Pennsylvania. I want to bring in Senator Dave McCormick of Pennsylvania. Good morning to you. It's nice to see you. You've written this letter. Have your predecessors ever done something like this? Where did the idea come from?
You know, I don't think anybody's done it before, not that I'm aware of, but it just came from, you know, being in business for 25 years and being the CEO of a public company and a large private investment firm. You had accountability. You had to report once a quarter and once a year. What did we promise? What did we deliver? Where did we fall short? What can you expect in the future? And I thought, you know, we've had such a busy year. We made a lot of promises, and I thought this would be a great way to engage with the constituents of Pennsylvania and also be very forthright. Here's what went well, and here's the things we fell a little short and where we hope to improve next year. And that just seems like a good way of ensuring accountability and transparency to the people of Pennsylvania.
Okay, so let's tick through the list of things that worked and the list of things that are still left to do.
Well, I think big picture, I made 10 promises throughout my campaign. I gave a series of speeches, and I think President Trump's agenda and the legislation we've done in the Congress, we made enormous progress on slowing the flow of fentanyl across our borders. Killed 4,000 Pennsylvanians last year. That's been a huge focus, and I think a real area of success. There's been a lot of progress on energy dominance and really unlocking energy across Pennsylvania and America. That's a huge deal for Pennsylvanians. Although, as I say in the letter, the one big thing we have to do, where I wish we would have moved faster, is permitting reform. And the thing that I think we've made great progress on and still need to focus on is through the efforts of the Trump administration and the Congress and the passage of the Working Families Tax Cut. I think we've put the American people and working families in a great position to have more money in their pocket. They already have more money in their pocket, but they're going to have a lot more next year. But there's still a lot of work we need to do on health care and get those costs down in health care, energy prices, housing prices. And then the final area where I give us a pretty poor grade as a country is fiscal. Our deficit, despite bending the curve on our annual spending, we're still out of control. We have $38 trillion of debt. That's I'm new to Congress. I'm 1 year in, but that's an area where we're just going to have to make much more significant progress in the future.
Let's dig into two issues, or maybe three different topics on that list. One actually I think is probably not on the list, but let's talk healthcare first, because that's clearly front and center. Where do you think things really are? And if you were to look at the Republicans' plan, the question about that plan is how, to the extent that it's aimed at trying to ultimately lower costs, there's a market mechanism to it. And so you have to believe that the market's going to work, and you have to believe it's going to happen, but it's not going to happen quickly. I wouldn't imagine. Maybe you think it's going to happen more quickly. And so the question is, where do you think your constituents are going to be 6 months, 8 months, a year from now?
Yeah, I think there's a near term and a long term, and you know I think you have to start. I'm not trying to make a political point, but by any measure, the Affordable Care Act made a bunch of promises, and it's failed to deliver lower cost, improved quality, or greater access. And we're going to need to reform healthcare in a way that has greater transparency, more competition, and more consumer capability to make choices. That's the only way you're going to drive down costs significantly. And that's going to take a while, just as you say. And even though we didn't create this mess, if you're a Republican, we're now in the majority. We have responsibility for working with our Democratic colleagues to fix it. The near term is a really pressing problem because you have these COVID subsidies, which the Democrats are trying to extend for 3 years in their current form. And I just don't think there's any way Republicans are going to support that. I don't think that's going to pass because they literally give subsidies to folks that are making $500,000 or $600,000 a year. There's a lot of fraud in the system. But I do think there's a possibility of some compromise where you extend the subsidies for a couple years. You got to reform them and cap them pretty significantly. You got to probably have a minimum payment to avoid fraud. And I think there's a real possibility for starting with health savings accounts, which are going to put money in the pocket to help pay down those initial healthcare charges. I'm hopeful. You know, I think we've got a lot of work to do, but I've been part of bipartisan discussions in the Senate where there seems to be a lot of agreement. And I'm disappointed we didn't make more progress at the end of last year, but I'm hoping when we get back in January, there's a path.
Okay, I got a different one for you. You talked about the fiscal, I don't know, you used the word for fiscal cliff, but a lot of people are talking about sort of just where we are financially in this country, given the debt that we do have in this country. I don't know if you saw Mitt Romney published a fascinating op-ed over the weekend, I think maybe on Friday, effectively saying, you know what, we actually have to raise taxes. Instead, including, he said, on himself, talked about raising taxes by carried interest, changing the estate tax so that the sort of step up in basis upon death, can't happen to the extreme levels that it does, which therefore creates all sorts of other perverse incentives during life, which is to say that some of the wealthiest people effectively are living off of loans so that they don't actually have realized gains. What do you think has to happen on that front? And do you think there's any movement at all afoot in that direction?
First of all, I haven't read that op-ed, so I won't comment. I won't comment on that. But I do think there's three things I can say, which I feel some confidence in. One, we are on an unsustainable path. I don't think anyone should dispute that. If you look at debt or deficit as a percent of GDP, it's really on a path it's unsustainable. Now, it may be sustainable for the foreseeable future, but it has to be addressed. Second, in the appropriations bills that we unfortunately didn't pass in the Senate on Friday before we left, or Thursday before we left for the break, there were 5 bills that if we had passed those, that they would have bent the curve. We would have had spending at or less than last year, less than the continuing resolution. So I hope when we get back to Washington, we can pass those. And I think the only way that we're going to address this growing crisis is to step back and have a bipartisan process that addresses all aspects of it. And unfortunately, that's going to require a level of discipline and bipartisanship that doesn't exist at the moment. But we're headed down a path where we're going to hit the skids, and we're going to have to address it. And that's why in my letter, I say, listen, I want to highlight we're not making progress on this, and it's a real challenge.
Senator, the journal makes the point that, I mean, it is always an attractive, I don't know, in terms of virtue signaling, to think that rich people are going to be able to make up the difference, but there's not enough money there, no matter what you do. Stepped up, it might help a little bit, but you need to tax everybody more.
Yeah.
And that's where you need to ask the fundamental question: is our tax system right now, as progressive as it is, are higher taxes the answer to the deficit issue, or does that impede growth, which might be the only way to grow out of it? So it's the same tired story that we have again and again. It's not, the rich don't have enough money to make a real difference without going way down into middle class or people to address the deficit that way. Isn't that right?
Yeah, I'd say 2 things, Joe. Number one, we've got to have pro-growth policies that are going to get our economy at 3-4+% a year. I think we have those policies. I think with the deregulation at our back, the energy dominance, the foreign investment that's coming in, I'm expecting we're going to have really strong growth next year, and that's going to create huge opportunity. And I don't think we're going to reduce taxes in a way, or can. The numbers don't work to actually address these challenges in a more fundamental way. But I do think there's a point here, which is despite that incredible growth and opportunity, there's a lot of people that were left behind. And that's what President Trump ran on, that's what I ran on, to make sure that those working families were participating in this great growth in the economy. And that's not happening enough yet. So that's why I think it's school choice.
Some of the methods that the president is employing, and Andrew has been highlighting this, you're a Republican, a capitalist, a business guy. Is anything that you've seen President Trump do in terms of statism? Is it similar to what happens in China? Is it similar to a socialist creep where the government is too involved in the means of production, or is it?
Well, I think it's a slippery slope when you get the government more and more involved in the economy.
Are we slipping?
Yeah, when I say this, number one. So if you look at some of these industries that are so crucial to our economic security, our national security, semiconductors, pharmaceuticals, rare metals, magnets, we need the government's involvement. We become dependent on China. We need to find ways to bring the investment to the United States and guide that policy. So I've been supportive of things like that. But we can only do that in cases where it's really critical to our national security, not as a matter of economic policy. And the principles that should guide us here are principles that we as Republicans should be able to live with if the other team was in the White House or in the majority. So I do think we got to be careful that we don't slide down that slippery slope. I think the areas that the president has focused on, the things like steel, like semiconductors, like pharmaceuticals, are really critical. And we learned during COVID that when those things are in the hands of the Chinese or other countries, that we're going to be dependent. So I do think we needed the government's engagement, but I agree with you. We need to be careful. It's a slippery slope. We don't want the government involved by and large. And it's the old Reagan line, the scariest words you could ever hear is, I'm here from the government and I'm here to help you. We don't need too much help.
Senator McCormick, I want to thank you for joining us this morning. It's always good to see you. I want to wish you happy holidays.
You too. Merry Christmas.
Merry Christmas. You bet. See you soon. When we come back, a lot more on Squawk Box after this. Coming up, the surge in IPOs has been a welcome trend for investors and companies that have stayed private for longer. We're going to dig in to the major trends in venture capital. We're going to do that next. Right now, though, as we head to a break, take a look at the biggest winners and losers year to date in the NASDAQ 100. We'll come right back. Welcome back to Squawk Box. The IPO window open once again, which could offer relief for some limited partners who have been strapped for quite some time for liquidity over the past decade as more companies stay private for longer. Joining us right now is Anin, co-founder of Acme Capital. He has backed the likes of Alibaba, DraftKings, SoFi, and so many other companies through multiple venture capital cycles. But this has been a particularly unique one in terms of just the length with which these companies have remained private. What's your expectation going into 2026 in terms of how much money ultimately gets delivered back to the limited partner community?
Good morning, Andrew. Thank you. Look, I hope it's going to be a lot because for the last 10 years, we haven't done, as an industry, we haven't done a very good job of giving our LPs back capital. It's been really easy to stay a private company for the last 10, 15 years, given how much money has come into the asset class. So we've had a lot of LP dollars coming into the asset class, creating these mega funds who are able to invest millions of dollars, tens of millions of dollars, and oftentimes hundreds of millions of dollars into these small private companies. So when you're a small private company getting a better valuation in the private market, and you don't have to do the regulatory scrutiny of being public, why go public? And so that's been the biggest issue, I think, for the IPO market, especially from the tech scene.
When you look out longer term, do you think we're going to go back and look at these vintages of companies that stayed private this long and say that was the right move, that was the wrong move, that was a mistake? Do we want to change the incentive structure so that these companies do go public earlier? Is that better for the public markets? Is it better for you?
Look, I think the longer the company stays private, probably the better the quality of the company when it ends up going public. However, you do miss out on a lot of the growth these companies see. Most of the growth happens in these companies, I would say, between year 5 and year 10 of their life cycle. And when they're spending those years in the private market, the public market investors are not getting the benefit of that growth. And so when they're coming public, they're probably a little bit slower growth company than they were 3 or 4 or 5 years ago. So that's one aspect that I think the public market shareholders are missing out on, which is frankly why you're seeing a lot of these 40 Act companies or 40 Act funds come in and saying, hey, we're going to get you into these best private companies before they go public, whether it's SpaceX or Stripe or have you in the secondary market. So I do think some of the public market investors are missing out on some of the growth of these private companies before they go public, given how long they're staying private.
Okay, so now I'm going to make you the SEC chair, or I'll make you the president of the United States if you want for a moment here. What would you do to quote unquote make IPOs or make being public great again, if you will? That is a mission of this SEC and this president. And I wonder what you think you could do that both creates enough disclosure and enough transparency for the investor class in the public markets, but also makes it attractive both for the managements of these businesses and for folks in your business.
So absolutely reduce the regulatory burden on small private companies, or small companies, public companies. When I started in the business, an IPO would be a company that was doing $30 to $50 million of revenue, doubling year over year, getting a great valuation and getting a lot of public market support. That's no longer the case. You've got to be $500 billion in revenue in order to get public now. And because of the regulatory burden and the expense associated with being a public company. And so Frank Dodd was probably one of the worst things that happened for the IPO markets for these small private companies. And so there's lots of regulations that I would probably get rid of.
But how much of it is it cost, like actual economic cost versus mind share cost? Meaning the idea, a lot of CEOs don't want to have to do quarterly phone calls. They don't want to have to take a week out of there. And this is why the president's talked about making earnings calls and earnings announcements only twice a year. Now, by the way, on the flip side, even people like Ken Griffin say that's a bad idea. You want the transparency. So here you have sort of a mismatch of interests that are not aligned, oddly enough.
Look, I think we can't get over the fact that the public market tends to be very short-term oriented, while private market and private investors tend to have a long trade. Somehow we get across that gap. I do think it's both a mind share and a capital share problem that you just outlined, Andrew. I don't know what the best way to solve that, frankly. But I do think you have to enable small companies to go public without the scrutiny that happens today and the headache of trying to, maintain, all the regulatory rules for it.
We want to thank you Appreciate it very, very much. Want to wish you a Merry Christmas and a Happy Holidays as well.
Happy holidays.
You bet. We do have some breaking news that we need to tell you about. Literally crossing the tape as we speak. Paramount Skydance amending its $30 per share all-cash offer for Warner Brothers Discovery in response to WBD's concerns about the bid. Paramount still offering to buy 100% of the outstanding shares of WBD and assume all the assets and liabilities. The per share offer price is not changing. It does not appear to be, but Paramount says in response to a Warner Brothers filing and comments made by WBD's principals and advisors in some television appearances, including right here on Squawk Box, that is now going to amend its offer in 6 different ways. And I want to walk you through what they're saying here because it's really quite interesting what they're going to do here. The first, Larry Ellison is now going to provide an irrevocable personal guarantee of $40.4 billion of the equity financing for the offer and any damage claims against Paramount. You may remember that was a big issue that the board of Warner Brothers has talked about, saying it was in this revocable trust. So Ellison now saying he will not revoke the Ellison family trust or adversely transfer its assets during the transaction. The other pieces of this, Paramount now saying it's publishing records confirming the Ellison Family Trust owns approximately 1.16 billion shares of Oracle common stock and that all material liabilities of the Ellison Family Trust are publicly disclosed. That was also an important point because WBD's board had some questions about how much money was actually in these trusts. Then Paramount now saying it's revised its agreement offers improved flexibility to WBD on debt refinancing transactions representing and an interim operating covenant. So that's another piece of this. And then Paramount also saying it plans to increase its regulatory reverse termination fee. So that fee now going to go from $5 billion to $5.8 billion. That effectively matches the fee that Netflix would pay if, in fact, the government or regulators were to block the deal. Lastly, the offer is now conditioned on WBD continuing to own 100% of its global networks businesses, and that is important because it touches upon what's going to happen if, in fact, Warner were to try to spin something out early. Redbird's Jerry Cardinale is going to be with us. Cardinale is going to be with us to talk about all of this and this revised bid in just a few minutes, so you do not want to go anywhere as this breaking news takes place in what is perhaps the biggest deal in the media space. It is just past 8 a.m. right now on the East Coast. You are watching Squawk Box on CNBC. I'm Andrew Sorkin, along with Joe Kernan. Becky's off this morning, but we got so much going on, as you can tell. Take a look at the futures right now, ahead of the market open, an hour and a half before we get there. 33 points higher on the Dow. You're looking at 31 points on the S&P higher. At NASDAQ up 170 points. We'll show you treasuries, the 10-year note and the 2-year note. The 10-year sitting just at 4.1, the 2-year sitting at just under 3.5 now. And then oil, if you want to buy by the barrel WTI crude, it's going to cost you, well, Joe will tell you, because he was just pumping some gas. So it'll cost you $57.74. Meantime, the Trump administration continuing to pressure Venezuela and its president as well, Maduro. Over the weekend, U.S. forces seizing a sanctioned oil tanker, and U.S. officials telling NBC News that the Coast Guard currently pursuing another sanctioned ship in international waters off the coast of Venezuela. If caught, it will be the 3rd vessel that the U.S. has intercepted. Joe?
A lot of things cost more, but gas does not. $2.50 a gallon, those places, and you notice it, even with a big gas tank. Let's get to Mike Santoli for a look at the markets. Hey, Mike.
Hey, Joe. Yeah, I got a bit of a positive bias in the index futures this morning. Last week did also manage a small gain in the S&P 500. It's been a couple of months, almost a couple of months, of kind of sideways churn, a lot of divergence below the surface, but has stayed on this positive trend. You see the S&P relative to its 50-day moving average. That average is starting to flatten out a little bit, but we got through a bunch of potentially hazardous catalysts, right? The delayed jobs report, CPI, Broadcom earnings, Fed meeting, and it seems as if maybe some of that typical late December strength might be kicking in right now with NASDAQ leadership. One of the big questions going into next year is this whole concentration story in the market. Is the index too top heavy? Can we have a broadening trade? Should you even wish for the market to be broader and not being anchored by the big guys? This is the 50 largest stocks in the market. That's the XLG ETF. That's the eco-weighted S&P 500. Both positive, so both giving decent returns, but you see double the return for the largest 50, and it sort of lifted off there mid-year. So we'll see how that tracks from here. There's been a little bit of narrowing, not too much in that. Also a question is what Bitcoin is telling us in terms of risk appetites, in terms of how people think about it. Its linkage historically with tech stocks seems to have broken down. This is silver relative to Bitcoin. So in theory, two diversifying non-dollar assets. Obviously silver, massive speculative stampede. It's going vertical in there. It's now kind of, it's often one of those things that once gold has been running for a while, silver gets ahead of steam. So we'll see how this relationship goes. By the way, short term, Bitcoin is bouncing this morning. There's been some heavy outflows from the ETFs. Tactically, that could be a contrarian signal that maybe it's looking to firm up in price, Joe.
I can't believe it. That all those dorks on all those silver commercials on all those networks for 5 years. It's finally happening.
It's true. Yeah.
You know,
I mean, they're always there. I mean, it's a crazy wing of the markets, as you know.
Yeah. But it's when they're right. They have been now they've been right at least for a while. Thank you, Mike.
Return the news that just broke on Paramount in the last few minutes, amending its offer for Warner Brothers Discovery. We've got Redbirds, Jerry Cardinale. He's going to be joining us live to talk all about it. And then Walter Isaacson, he'll be with us to talk media deals, Tesla, SpaceX, and Elon Musk's pay package. All that and more as Squawk Box comes right back after this. Welcome back to Squawk Box. This morning, our breaking deal story, literally just moments ago, Paramount now amending its $30 per share all-cash offer for Warner Brothers Discovery in response to WBD's concerns about that bid. The per-share offer price not changing, but Paramount says in response to the Warner Brothers filing and comments made by WBD principals and advisors in television appearances, including on Squawk, that's doing a whole bunch of different things in 6 different ways, and we're going to get into all of it. Jerry Cardinale is here. He's the founder and managing partner at Redbird Capital Partners, of course, a partner in Paramount Skydance. Jerry, it's great to see you this morning, and thank you for coming in to talk to us about these changes in the offer. As we mentioned, the price tag not changing, but some important details are, including perhaps most importantly, the backing of Larry Ellison and him now making this a personal guarantee as opposed to a revocable trust. Tell us about your thinking about the various parameters and different things in this new amended offer.
Well, look, you make a really good point. We've been trying to get our offer vetted since we submitted it December 4th. And, you know, this is a pretty simple thing. It's about shareholder value and it's about certainty. In fact, when we talk to Warner Brothers shareholders, they point out 2 things. 1, why is this so hard? It seems pretty straightforward. And 2, why would they go exclusive with Netflix so quickly when you see these 2 offers lined up next to each other? We still have not been able to talk about shareholder value here. We're talking about all these other things. And so what we've done in this amended filing is we've cleared the brush on all the obfuscation around the offer. And, you know, the big one that you know has been percolating. By the way, we only found this stuff out in their 14D9 filing this past week, and so like we've done through the 6 bids that we've made, we are being responsive to what their concerns are. The big concern was that Larry Ellison and his family is not money good for this transaction, and so we've come in and said that okay, we will give you, Larry will give a personal guarantee on the equity financing for this transaction, $41 billion. You know, what we did when they asked us between our 5th bid and our 6th bid, they asked us to backstop. And so the Ellison family and Redbird backstopped it. And we did it through the Ellison Family Trust. The Ellison Family Trust, which has been around for close to 40 years and has been the counterparty in tens of thousands of transactions, including the Paramount Skydance deal. That is where all the assets resides. That's where, and it's got $250 billion of assets in there, anchored by 1.2 billion shares of Oracle. That's over 6 times coverage of the 40 billion in equity that we're backstopping. But that seems to be the sort of red herring that is out there and preventing our offer from getting vetted and taken seriously. So we took it off the table. It is now off the table. All right. The second thing is this.
Just before you go there, one question on that front. Had they not told you? Are you suggesting prior they had never raised this as an issue in terms of the revocable trust and the guarantees?
We are still waiting to get a response on our December 4th offer. Full stop. We found out about these things in the 14D9 filing, and so that is why we went to shareholders. You know, the shareholders own this company. And so we went to them directly because it's clear when you look at our offer and you look at Netflix's offer, our offer, just to reset the table, $30, all cash, 100% of the company, and a clear path through regulatory. The Netflix offer is, you need 3D glasses to understand it. It's got Netflix stock, which is blown through the bottom of the collar, and it also has another currency, another stock that is to be issued. That is the stock of the spin-out company. And I think the chairman of the Warner board came on one of your shows last week saying that is $3 to $5 a share. I'm a math guy. All the people on our side are math guys. That's not $3 to $5 a share. It's $1 a share when you look at what they've levered it with. $15 billion of leverage on TBS, TNT, CNN, you know, the only independent variable there is what does it trade for? For it to trade at $3 a share, you'd have to assume a 6 times multiple. Right? We're assuming, we're giving them the benefit of the doubt and assuming the same multiple that your Versant is trading at, which is 4.5 times. At 4.5 times, the math is the math. The EBITDA is the EBITDA. The leverage is the leverage. It's $1 a share.
Gary, our Versant should be trading at 6. I'm sorry. No, I'm kidding.
we can debate on
Sorry,
that.
yeah, sorry
But the thing on the stub-
sorry to interrupt.
That's all right, but the thing on the stub that's really interesting is we can't even talk about these, have not been able to talk about these issues, right? And so no one talks about, on the Warner side, no one talks about the value of the stub. But here's the interesting thing. It doesn't stop at the value of the stub. If that is over levered, that spin out will not be able to happen. And if that is the case, then that $15 billion of debt is going to need to be reallocated over to studio and streaming. So just for the sake of argument, let's say, Versant trades at 1.25 times leverage, trading at 4.5 times, right? At $15 billion of debt, this spin out is close to 4 times leverage. So let's say we take $5 billion of that debt out of the 15 and we move it over to studio and streaming. That still reduces it only to 2.5 times leverage. That's still double what Versant has. But nevertheless, just illustratively, let's say we do that. What will end up happening is that will squeeze the amount of cash that Warner Brothers shareholders get in studio and streaming, right? So what effectively will happen if you move $5 billion of debt over from the SpinCo over to studio and streaming, Warner Brothers shareholders will be effectively exchanging $2 a share in cash for $2 a share in equity in the SpinCo, which is a declining asset. That's dead on arrival. That is a disaster. And that unwinds this entire deal. You don't have to do any of that extrapolation. You don't have to deal with 2 stocks, 2 currencies, 1 to be issued, let alone, that's before we get to the regulatory risk, right? Our regulatory risk is straightforward. Our deal creates competition. The Netflix deal kills competition. Netflix buys HBO Max. It's 420 million streaming subscribers. The next number 2 is Disney Hulu at 184. No wonder the constituents in the ecosystem, talent, content creators, theatrical exhibitors, are losing their minds on this because they see the pricing power that will create, and hence they see what's coming, which is everybody in the value chain is going to get squeezed. So that is not good for
What is the
Hollywood.
rationale for Warner Brothers board and David Zaslav? Why favor the Netflix deal? Honestly, right? Does David want a job? He wants to keep his time. He wants to run the studio. What is the reason?
It's a great question, and it's the question that I get from Warner Brothers shareholders. No one knows other than, look, you got to remember, our first 3 offers here got the board to put the company up for sale. So I think we were always a little bit on our back foot because they were originally spinning the companies, breaking it up. And, we came in and our offers was for 100% of the company. And I think it just got them to put the company up for sale. So we were always a little bit on the back foot. But at the end of the day, Joe, the shareholders own this company. The board doesn't own it. David Zaslav doesn't own this company. And this should be a lot, one of the shareholders are right. This should be a lot more simple than it is. It's very simple. It's shareholder value and it's certainty of
You said the regulatory path is clear. Is that because of the president's relationship with the Ellisons?
No, absolutely not. Look, we have great relationships on both sides of the aisle. The relationship I focus on and that David Ellison focuses on is our relationship with the rules. Okay, and the rules here are pro-competition, pro-consumer. We have, if we come together, Paramount Plus and HBO Max, you will create a 3-horse race in streaming. The North Star on this entire investment is direct-to-consumer and streaming, and we will create a 3-horse race. Netflix, our pro forma company, and Disney. That is great for the entire value chain.
Can you figure out why Netflix wants it so badly in that it doesn't help with what the future competition for Netflix is?
Look, I mean, when I see the elements in the value chain, the talent and the content creators and the theatrical exhibitors, all expressing these concerns, and yet some of them are afraid to raise their head above the parapet, for fear of retribution. That suggests monopolists to me, right? And so, guys who are in this position, monopolies, they want to, kill competition. And look, I mean, that's why we have these rules. That's why we have rule of law. That's why we're going direct to the shareholders. So I can't speak for any of that. All I can speak to is the facts. And the facts, it is absolutely clear. At a minimum, there needs to be a vetting of these 2 offers. There needs to be a discussion on value. There's never been a discussion on value. It's been about all this other stuff. What we did today in this announcement is we took all that other stuff off the table. Not only did we address the backstop and the personal guarantee, there was an issue around the irrevocable trust. And so Larry has also agreed to not revoke the trust during the pendency of this transaction. He's confirmed what the assets are in the trust, anchored by the 1.2 billion Oracle shares, as well as, confirming no material liabilities. We've agreed that we will embrace further flexibility in terms of interim operations between signing and closing, including in discussions with their bondholders and their banks. And we've increased our regulatory reverse termination fee from $5 billion to $5.8 billion, which matches what Netflix's was, because we have absolute conviction in our ability to get through regulatory.
Jerry, a couple questions. One on the regulatory side, there is a question about, given the investor mix and a number of Middle Eastern firms that would be backing this bid, whether CFIUS would ultimately look at it and whether that represents a hurdle. What is your analysis there?
Our analysis is no, we're backstopping it. The Ellison family and Redbird's backstopping. So all of those guys could go away, and we're still moving forward with this transaction. We also the Ellison family and Redbird will be the largest economic owner of the pro forma business. That is the way it is now, and we control the governance. So when you look at all of that, this is very much the way we set up Paramount Skydance. The great thing about the Ellison family, this is the first time since Walt Disney that you've seen a family own, control, and be the largest economic owner of one of the majors in Hollywood. That is a great thing. That is back to the future. That's what we need to see more of. That is full alignment with the shareholders. How much does that David Zaslav and Reed Hastings and Ted Sarandos own of their respective companies?
Let me ask you a different question. Actually, you know what? We have some tape from Tim Piazza, was on the board, obviously, ran this for Warner Brothers Discovery. I want to show you what he had to say last week, and then maybe we come back.
When Paramount showed up, it became an active process. What is said on your show, you had David Ellison here, what's said there, what's said in the Wall Street Journal are nice to hear. What's important is what's on the paper. And now, I think, given our release this morning, our investors can look and see, why did we decide that we were not confident that one of the richest people in the world would be there at closing? And doing a deal is great. Closing a deal is better.
So, Jerry, you heard what he said. This is obviously trying to answer those questions. My question to you is, without raising your bid at this point, are you trying to create a new conversation with the company? Do you think that this will create that conversation? Or is this really more for the shareholders longer term, for them to make their own decision? I imagine what you hope is that the board reevaluates this and obviously goes with your bid, but clearly if you look at where the shares are right now, there's still an expectation that you're going to come back with a higher offer.
Yeah, look, I'm not going to put a seventh offer in when our sixth offer hasn't been vetted. And when you look at these two offers next to each other, our offer is superior, both in terms of value and in terms of certainty of closing. So, all we did today was we took all of this other stuff off the table that they've been throwing, all these obstacles that have been thrown in our way, so that we can finally get a proper vetting and hearing about our offer. No one to date, first of all, no one's talked to us. Secondly, no one's talked about value. It's all this other stuff. So we took all this other stuff off the table. We didn't think we needed to. I think it's, the way we structured this deal with equity commitment papers, with, a guarantee from the trust that holds all of the family's assets, that's standard stuff. I mean, this would never happen in any other deal. For some reason, it's happened here. So we've addressed all their concerns. We've done it through 6 offers. We have a great track record through this whole process. When we started at $19 a share with cash and stock. We've ended at $30 a share, 100% cash, and for the entire company. So we've shown that we will consistently respond to any concerns and issues all throughout the process. For some reason, they short-circuited it after the 5th offer and didn't respond to our 6th offer, so we went to the shareholders. So at this point, I think the question still is on the table. Show us where our offer at $30 a share, 100% cash, with our regulatory profile, show us where that is inferior to what the other proposal on the table. The reality is it's superior.
So when you get off the set, are you expecting to get a phone call from somebody from the board of Warner Brothers?
It doesn't matter. We've gone directly to the shareholders. it would be great, but we've also gone directly to the shareholders, and thank God there's rule of law in this country.
Jared, do you think that, Andrew, I gotta get to my Barry Weiss, there's 60 minutes. They
I
canceled
gotta get to
this.
Barry Weiss too. We
They
gotta talk
canceled,
about that.
they
No
canceled
question.
this, I saw that El Salvador prison on the world's toughest prisons. I didn't need to see the new piece on it. I've seen it. I don't think it's Trump's prison, but don't you think there's a perception that, I mean, the people at CNN, for them to prefer a Netflix deal tells you how scared they are of the new, I don't know, marching orders supposedly coming.
Well, that's not what I've heard. What I've heard is people at CNN are worried about having $15 billion of debt dragging them down
Is
and
that what you
declining
heard?
asset. Yeah.
When the president says CNN's got to go either way, what do you make?
Look, I mean, that's noise. Honestly, Joe, at this point, we're still trying to get to first base on this deal, right? And this is about shareholder value. It really is.
I can remember trying to do that too, back in high school. Andrew, what did you want to ask about Barry White?
Well, I think we should just ask Jerry straight up actually about this, because it's obviously, it's the other big news story of the morning, which is 60 Minutes pulling back on this story about the prison in El Salvador, and the correspondent who pursued that story saying that the piece had been vetted multiple times and then was killed at the last minute. She says, in my view, pulling it now after every rigorous internal check has been met is not an editorial decision. It is a political one. So the question for Jerry is, to the extent he knows, was there any communication between either David Ellison or anybody in the management of the company that's thinking about this transaction, which of course will be in front of the president, and Barry Weiss or anybody inside of 60 Minutes?
Listen, Andrew, I'd say this absolutely with conviction, and, I don't know about this situation, but I'll tell you this. No one is going to question Barry Weiss on being a fighter for independent journalism. Right, and so her track record speaks for itself. David Ellison's track record speaks for itself. So, absolutely, there's no way. And I know this, makes a lot of headlines, and everybody likes to conjecture. The one thing I know, and I know both of them extremely well, is that nobody's going to fight for journalism more than Barry Weiss and David Ellison.
It's not Trump's prison, Andrew. It's not his prison. You can't blame him for the prison conditions, although you'd like to, in El Salvador. Can you?
No, I'm not. The rationale of the piece, of course,
I've seen that prison. I've seen it on
the
some
president was sending people, obviously, who were hopefully
illegal immigrants
to
from
this
Venezuela.
prison.
Exactly.
To this prison, and that's what the piece, I imagine, was about.
That's why he got elected and won all 7 swing states, because he said he was going to do that.
This is a debate for another day. Jerry, we want to thank you for joining us this morning. It is fascinating. We hope that you'll come on back and follow your progress. In terms of just the next steps, though, how do you think this plays out, just as we're sort of thinking about the calendar?
Well, we have a January 8th deadline for our tender, and so we're going to be working through the holidays and into the first week of January to communicate the merits of our offer to shareholders. And we would like to see the board's free to engage with us between now and then. And if they don't, then as I said, we'll go straight to shareholders and we'll see how we do on January 8th. And we can continue to extend the deadline until we get a full vetting amongst all the shareholders.
Okay, Jerry, I want to wish you a Merry Christmas, Happy Holidays. It sounds like your holidays may be a working holiday, yeah. But we appreciate it. We appreciate you being with us, especially right as this news was breaking this morning. Talk to you soon.
He never sleeps. welcome back. Join us now, Walter Isaacson, Torella Weinberg, advisory partner, Tulane University history professor. I can't believe I took Tulane. I thought they could, they
You
got
thought Tulane was going to be...
I thought they were getting like 20 points or something. It was horrible. And Elon Musk, biographer and a CNBC contributor.
We're going to talk about Tulane now.
Yeah, because you immediately sat down and said, don't ask me anything about El Salvador. I don't know anything about El Salvador. All I know about, they just like Bitcoin. You know that much about El Salvador, don't you, President? Anyway, Walter, it's good to see you.
Good, Joe.
So Delaware, I mean, I think this is things coming home to roost in the right way. Meanwhile, he's almost a trillionaire.
Well, and it's moved companies out of Delaware, this notion that you can overturn somebody's pay package. It's interesting that the Delaware court restored it. The weird thing about Musk, we're talking about Elon Musk's pay package for
Yes.
those of us who haven't been following this, is that Musk, it's almost like points in a video game for him. He may become the first trillionaire ever, but it's not because he likes buying yachts and islands and vacation homes. It's because he's almost addicted to scoring the points. And that's what he's done with his new pay package and getting the Delaware Supreme Court, I guess it was, to restore the old one.
Because he obviously, has he bought a yacht yet? I don't think that this is not his thing.
I remember when I was writing about him, this little 2-bedroom house in Boca Chica. And so I don't think his thing is to spend money on himself. It's like he's an avatar in his own video game, and he wants to rack up the points and get to each new level. He also, though, more seriously, especially when it comes to Tesla, really wants control, meaning for him at least 24-25%, because he thinks it will be an AI company. And one of the things he's doing that to me is interesting is it's AI that's physical AI, real world AI. We've gone through a year where everybody's been waving their hands about large language models and predictive generative AI. The more interesting AI will be things that actually can operate in the real world. Cars that drive, drones that can make things, robots that can take visual information and operate the way humans can. That's going to be the next wave of AI. That's where he sees Tesla's future. And because he has this grand fear for the past 40 years that our robots will kill us, he read Isaac Asimov once too often as a kid, he wants to make sure that he has basic control of Tesla.
You think that Isaac Asimov might be too paranoid? Do you think that...
Actually, Asimov's books are very good, and the rules of the robotics, iRobot, and that they won't destroy humanity. Turns out pretty much okay, but it certainly puts some fear in us.
We don't need to talk about El Salvador, but it was in relation to the news that we just had from Jerry Cardinal. And what do you make of that? What do you think's right? I don't know, Andrew. You love talking to Walter. You guys are like soulmates. You're authors.
Yeah, we're authors. Hey, he was #1 author. I'm like number 6.
You've been #1 before, haven't you?
Yeah,
There's only one way.
when I was young.
Only one way to go.
Exactly.
From #1.
Downhill. So, but I'll answer by taking the question you asked. When you have to ask the question, is your regulatory path better because you've got a cozier relationship with the President of the United States? Now, maybe the answer is yes or no, but that's the question that keeps coming into people's minds. And I think that's a problem when you have President Trump or any president doing it, future presidents.
Past presidents. It's just more out in the open now.
It's now more out in the open, which is I'm going to use the antitrust laws to make sure that my people get things. You're asking it. I don't know the answer, but I suspect the answer is yes.
What was Lena Khan's rationale for wanting to block everything?
Lena Khan's rationale, and some
but it was Biden inspired, was it not?
Right. But just like a lot of Republicans,
Or
they
whoever
believe
was-
strongly
Right.
in antitrust,
Right.
and you got to have more competition.
I don't know if it was Biden, but whoever was running the administration at that point. Andrew?
Hey, Walter, well, two things. One, just a side note from that interview we just had with Jerry, which is my understanding is that he misspoke on one issue, which we should just point out, which is that Paramount has now extended the tender offer date to January 21st, so it's not January 8th. I believe he said the 8th on the air. But if you look through the filing, it is January 21st, and that was something that is new and part of this. So just as a side clarification here. My question for Walter really though is, you look at these two bids back to back now, you see what Jerry said in terms of both the idea that the Ellison family is going to backstop this, but also the idea that the value of the quote-unquote stub, the assets that include CNN and so many other of the linear channels, he believes is diminished because of the amount of debt on that, and effectively suggesting that if it's living out there by itself, that's actually going to be bad for people who work at CNN and places like that. Do you agree with that?
I
Do you
don't
think that
know
they're
the
putting too
debt
much debt on the
exactly,
business?
but I do think that, yeah, when you spend something out and load it up with debt, that's a problem, and I think that's why these offers will keep playing out.
And then, I don't know where you stand on it. We were talking with Jerry at the bitter end about the Barry Weiss decision on 60 Minutes, and I think we all don't know the history of exactly what happened, but it is unusual to see a letter, at least, I think it was an internal letter, that the correspondent had written to some of the other 60 Minutes correspondents, suggesting that the piece had been vetted multiple times, and that at least she believed that this was being done on a political basis. Obviously, it comes in the context or in the midst of when this deal is happening. So, even if you believe that the decision was made on the merits by Barry Weiss, invariably there are going to be other people with different political views that think this is not being done on the merits. And given somebody who's run a news organization, how do you run it then?
But it also comes after those on the right and Trump supporters said nothing has changed at 60 Minutes. That was out a couple of weeks ago. Again and again and again, that even after the fine and at Barry Weiss and all these purported changes, that nothing had changed, and it's almost like, okay, it's almost like succumbing to that criticism and then pulling it.
But
I'm arguing your side of things, Andrew. You don't need to take issue with that. I'm arguing your side, okay? Go ahead, Walter.
You know, I've run a TV network before, I've run a magazine before. I don't know anything about this piece, but I do know that whenever an editor or a head of a network decides, hey, let's not run this piece, we don't have it yet, everybody thinks it's because the higher-ups ordered it or their political reason. The problem for this whole deal is that we keep asking, regulatory, is it going to get through only because Trump wants it? Or the news, is it going to be that Trump tries to fix the, tries to put his thumb on the news? And so it would be much nicer if we lived in a world in which we didn't have to worry that the government was trying to do all these things. But I have no clue whether that piece was ready to run or not.
fair enough. That's completely, I think, a fair way to think about it. The thing though that I wonder about, and Joe and I have been talking about all morning. I was making an argument in the 6 o'clock hour that this administration feels different in terms of just, the influence even on the media feels different. I think Joe has a view that the influence on the media under Democrats was just as aggressive.
Yeah.
Okay,
I happen to
both
not
agree
believe that's the
that we
case.
don't need administrations telling news organizations
Right.
what
We
to
don't
do.
need a ministry of truth.
We don't need a ministry of truth.
Your buddy Elon Musk saved the frickin' world by buying Twitter. So, I mean, thank you.
But I do think that we are seeing more, Joe, of the notion that the government is pushing into editorial decisions that are being made, including the type of lawsuits he's thrown up and saying, if you don't settle the lawsuit, you're not going to be able to proceed.
And free speech allows media organizations to present whatever perspective they want, but you can admit that the perspective, or I've even mentioned the Ivy League schools. There was a problem. There was a problem. That's why this is happening right now.
They have the right to.
I know they do.
And
I know.
government
And the government shouldn't try to help media get above 8% approval. You're right. They
It's
should.
right. They should.
I agree.
We can agree.
I agree.
And it's not up to the government to say, we're going to use our
I
regulatory
agree.
powers.
They should let them be, as have 98% liberal guests on every talk, late night show, that's fine. 100% anti.
I can't tell whether you're being sarcastic or not.
No,
but
I'm
the
being
answer
serious.
is
I'm being
yes.
serious. They should be allowed to do that if they want, and they can
The
have
marketplace can decide what it
Right.
wants, but not the
they
government.
can have 600,000 viewers instead of 6 million like Johnny Carson had. That's fine. Andrew, what's up? So, remember that?
At a time, my friends.
So, Walter, thank you. You got another book? Oh yeah, we talked about this. The greatest sentence ever written.
All of these debates we're having right now,
Right.
we're about in a couple of weeks to hit our 250th birthday year. It would be kind of useful. We read the Declaration of Independence again,
Right.
understood what it meant, and not try to make everything as political as these discussions tend to be.
Right. I just think it's rich that Trump is the president during the 250th anniversary. God love that.
Happy birthday.
We'll be right
Merry
back.
Christmas.
The race for Fed chair looks to be entering its final phase. Said this a few, or does it? Because now we're back to 4 or 5 again.
It's 4.
Senior,
You missed the dropping of the 1 when you were out.
no, I was reading it this morning. Both Kevins are back in, Waller's in,
Waller's
and
in.
Reader's.
Reader's in.
Yeah, okay, I saw that. Senior economics reporter Steve Leisman joins us with the details. Say, Steve.
Joe, President Trump's extended search for the next Fed chair reaching the end game with a flurry of both backroom and public politics. And people familiar with the situation say the president could name the next Fed chair by the first week of January, maybe a little bit later, after interviewing the last candidate, Rick Reeder, in the final week of the year at Mar-a-Lago. One question remains a mystery. Where does Treasury Secretary Scott Bessent stand in all of this? Here's a little bit of the tell-it-take. September, Bessent announces the Fed chair interview process, potential candidates. He begins interviews, and then he writes an article sharply critical of the Fed, calling for reform in a way that Kevin Warsh had. October 10th, CNBC reported that Bessent narrowed the shortlist from 11 down to 5 candidates. November 30th, Trump telling reporters, President Trump that is, I know who I'm going to pick, and everyone thinks it's Kevin Hassett. December 2nd, the Fed candidate White House interviews appeared to be canceled. They were back on December 10th. interviews held with Warsh and then another interview held with Waller that we reported on Friday. He said it was a strong interview. So it's unclear how these interviews got back on track. There's been pushback on Wall Street against Hassett, as reported by CNBC, Politico, and the Financial Times that have said in part there's an organized campaign that he was too close to the president, but also appears to be organic pushback. Bassett has, on his own, pushed back to defend Hassett. That criticism could have prompted the administration to put those interviews back on track, leading to some volatility you can see in the Kalshi prediction market. Those are monthly changes you see on your left there. The odds have now steadied with Hassett the clear leader. People familiar with the situation say Treasury Secretary Scott Bessent does not want to favor any candidate because he knows it's the president's choice. Also knows his predecessor is continually blamed by President Trump for the pick of Fed Chair Powell, which he didn't like. Now, one person familiar with the president's thinking told me, this is the most powerful man in the world making one of the most important decisions of his administration. A committee is not going to decide. Joe, having looked at all of this and talking to, I don't know, a lot of people over the weekend, I can't find Bessent putting his finger on the scale for any particular candidate. What looks like he does, he may put his finger on the scale to bring it back to neutral, so the president has a choice between all these candidates, but I don't see him favoring anyone over another yet.
I mean, I had heard about that Waller story that you talked about. To me, it looked totally like a trial balloon, like a market check on what leaking that Waller. Why would they leak Waller had a strong interview without wanting to make the market think
that Waller was a candidate?
That Waller was a candidate and see how it reacted, or what the public.
Having been the person reporting that story, who broke that story, I don't know that I can understand the motive. As much as there were some people that said to me,
when they give that to you, don't you ask yourself, why are they giving this to me?
I do.
And what was your conclusion?
I don't know. I honestly don't know. I don't, do you know? I mean, do you think it's?
I think Hassett was getting hammered. I'm not really sure it's fair.
Right.
And I think they want to say, look, it might not be Hassett. In fact, Waller just had a really strong interview. What do you think of this guy?
I'm interested in that, Joe.
Because he's at wanting to cut 50. So here's another guy who definitely is in the president's, shares the president's thinking on lower rates. Let's put him up and see how that looks. If we're worried about Hassett not looking independent.
You don't have to put him up to see how that looks. You remember our Fed survey that showed 84% think Hassett's going to be picked.
But is he a way of satisfying Wall Street's concerns about Hassett and still getting your 50 basis points immediate cut?
Maybe. I mean, Waller's going to do, look, there's a thinking about Waller that I think is maybe not appreciated, which is that it may be that the administration is beginning to understand the chair himself cannot cut rates. They need the committee.
Right.
So who's your best person to have in that job? If you want to get rates,
them.
it may be Waller in that case. And like I said, the vibe we get from people we talk to say they like Waller. Now, that's a thing that's like normal on Wall Street, where we like the guy we know. And we like the guy we know in the position that he's already been in a sense, right? So that's sort of Wall Street saying, give us something known here.
Thanks, Steve. Join us now. Looks like he swallowed a canary. Counselor to the Treasury Secretary Joe Livornia. You might actually know things instead of just being conjecturing. What you heard of this discussion?
Yeah, I mean, there are four great candidates. I mean, the street is very familiar with all four, and they'd all be very good. And I think Steve is exactly correct. The secretary has done a very thorough process and is going to give the president that list. He's giving the president the list, and it's the president's decision at this point as to who he wants. And whoever is ultimately chosen, I think, will be very effective.
You know, you're going to walk this. You're not going to give any give us any idea how you feel. Let me ask you about Warsh, because you know, in the past, I think some of the credibility that he's built up on Wall Street has been, I guess, the perception that if he had to raise rates, he would raise rates like crazy. And I think he's been critical of the Fed and the recent policy moves, and really how powerful the Fed has become, how transparent the Fed has decided to be. He thinks that's bad. How did he get back in the good graces?
Well, some of that stuff, Joe, is from a long time ago, and I think really in any of these instances, if the Fed needs to raise rates, to look at it holistically. The president wants somebody that's going to be sort of objective and look at this potential productivity boom based on his policies. You've got these supply side
And AI.
policies. Part of it's AI, but also, no tax, rather full expensing for capital expenditures. Now it's permanent, 100% expensing for factories. That's going to create a supply side boom. We're already seeing it in the GDP data. We're going to see it more evidently next year. And the president wants somebody's going to look at this holistically. And the secretary's given a lot of candidates, so I think objectively we'll look at the current situation as is, including Kevin Warsh.
Well, let's talk about the current situation. So you probably think rates could go lower, but at the same time, you probably think the economy is ready to
I think
take
the
off.
economy is very
You
healthy.
think it's 5% next year, like we're hearing?
Well, Larry mentioned 5%. Look,
Carolyn, 11?
what I said to Steve earlier, if you look at the non-financial corporate productivity growth in the last 4 quarters, it's up 3.5%.
Yeah.
I mean, certainly we could have a real big boom next year, but you do need lower rates, so to speak, to grease the skids of more investment spending, especially in infrastructure as it relates to building factories and such.
But you don't think it'll run too hot?
I don't think it'll run too high. No, I mean, if you look at inflation expectations, Joe, they're very stable. The yield curve is flat. President Trump was correct. Secretary Bessent is correct. The tariffs have not had the effect people thought they would. I've made that case myself. And, you need interest-sensitive activity to be stronger. There are pockets of the economy that are soft. And that's reflective of rates needing to come down. And inflation's a lagging indicator. So as you build productive capacity and you invest in CapEx, which is inherently disinflationary, you could have much lower rates and the economy reaches its full potential.
The Journal wrote a piece, where are the manufacturing jobs? And in fact, and this is in keeping with what they've been saying since day one about tariffs. They're saying the willy-nilly tariff assignment is causing companies they're not laying off people, but they're not hiring people because they're not sure what the future looks like, what the Supreme Court does, what happens with tariffs. Do you blame the manufacturing jobs?
Right, so let me just say, but Joe, if you look at the CapEx trend, in the first half of the year, CapEx grew nearly 15% in real terms. Ex the pandemic, that's the biggest increase since 2011, 2012. CapEx leads the hiring cycle.
So you think
and what that will be
you think it's
manufacturing
coming?
jobs. I do think it's coming. Now, what's interesting, this is important. In the one big beautiful bill the president got through in record time, that bill, 100% expensing for factories. The normal shelf life of a factory expenditure is nearly 40 years. You're going to be able to expense it fully in year one, and it's only going to go through 2028. The IRS is just finally putting the finishing touches on the guidelines for that. So next year should see a huge factory boom, and all the equipment that goes in it will also be 100% expense. So it takes a little bit of time for those manufacturing jobs to start to become more evident. And again, lower rates will also help, similar to the point the president made back in 2018 when he said, look, rates are too high, the Fed needs to cut. We saw the ISM survey soft, and then of course in 2019 you had a boom. The economy grew nearly 3.5%.
When we were watching the Biden economy, and people were saying, well, Americans just don't understand how great it is. And the media was singing that too. I always pointed to the notion that real wages fell. That's why people...
Yeah, they were down about 4/10 annualized
fell.
over the
There's
4
a
years.
reason they
were
fell.
negative.
There's a reason people
Right.
felt like crap because of that. Explain now why you're hearing so much about affordability when wages are rising faster than inflation.
So part of it is, I do think the rate story, because look at first-time affordability fell to a record low under the prior administration. Rates at this point are a big driver of why affordability for homes is low. In other words, you need to get rates down. But what's happening, Joe, and again, this comes to the forward, is if you look at the bill as it's written, no tax on tips and overtime, that is going to further lead to huge increases in real after-tax income. And by the way, if you look at the blue-collar workers, through November of this year, we are up 1.6% annualized. That is one of the biggest increases we've had in the last 60 years to start a new administration. So there are a lot of good things happening. Earlier you mentioned oil prices or gas prices being low. I mean, it's going to take some time, but the president clearly has put in place policies that benefit middle and lower income workers. We saw it in the first administration. The markets are reflective, I think, of a boom next year. You're seeing very tight credit spreads. You're seeing the bond market perform very well, the best performing market in the industrial world so far this year. And you're seeing the equity market perform well. I mean, that's just confidence in the policies. We've just got to give it a little bit more time for everything to take hold.
Right, because you could, I can give you a list. I mean, people point to 4.6% unemployment is the highest. That's still full.
Well, no, and you've got rising.
That's basically full
What's very
employment.
low, Joe, and what's important is you've got rising participation and a lot of the jobs.
2.7 on inflation, new highs in the stock market. I mean, it's not an economy where people should be saying, I'm miserable.
No, but the president really, though, is focused on working class Americans, middle and lower tax workers, middle and lower income workers, and this is why they'll get substantial refunds next year. Gasoline prices should go lower. That's money in people's pockets. As rates come down, affordability goes up. I mean, this is really breadth and depth of the president's policies that matter most.
Do you think we're going to grow out of the deficit? Is that your idea?
Joe, if we don't have growth, we're going to have nothing.
Can we raise taxes on the rich?
We need to have taxes in place that allow us to spend and create the economy that we want. The revenue share of GDP is over 17%. The problem has been on the spending side, and the spending numbers have slowed both in fiscal year and calendar year since the president took office.
Right. I think Andrew wants to.
And Joe, just on the tax front, I don't know if you saw that we were talking about this Mitt Romney piece, not just about carried interest, but really at death. Stepped up basis to death. He says it's got to go away. You can't do it this way. There's too much money that's being effectively lost in the system, and creates too many perverse incentives where too many people of great wealth are able to actually effectively live off of loans their entire life for the rest of their life, so that they don't pay those taxes. Where do you stand on that? And at least from my vantage point, I don't think that would actually change the growth story.
Well, Andrew, again, as I was saying to Joe, I mean, we really have a revenue. We don't have a revenue problem. The revenues are actually very robust at over 17% of GDP. It's really on the spending side. If the economy, though, however, grows, Andrew, if we grow at 3%, which to me is very doable given the productivity trend and what we're starting to see on the labor market recovering, even at a 17% revenue share of GDP, we're going to raise about $4 trillion more money, I calculated some time ago, than what CBO was predicting, and that's a huge benefit to the longer-term budget outlook. So on the tax side, I'm all for keeping taxes on labor and capital as low as possible to create the growth, to create the goods and services and industries and jobs that people want. And the other thing we have, Andrew, is the deregulation side is very powerful. This is going to get businesses growing and hiring and expanding. It's just going to take some time, but we are seeing the labor trend improve the last few months. And all the guideposts for 26 should suggest it should be a boom, as Secretary Besson said.
5%?
I would love 5%. 5% would be great.
I love 10%.
If you look at the street, there are many private sector forecasts, some very good private sector forecasters saying 3% real GDP growth. To me, that is very, very doable.
We're used to
the first administration.
We must have been making a lot of mistakes for the past 30 years because we've been unable to get out of the. And we've been doing better than the rest of most of the, like Europe.
Well, a lot of the debt, though, Joe, was in the last administration, a huge increase in debt.
And not great in the first Trump administration either.
Yeah, but we were growing almost 3% in the first 3 years, or 3.5.
I mean, the debt, we did do a little bit too much deficit spending, obviously.
Well, not really, because if you look at the numbers, the TICJA, the Tax Cuts and Jobs Act, effectively paid for itself if you look at what the CBO spread and what happened. On the revenue side, and again, the spending, as I said earlier, is a bigger issue, but these things have been in the making for a while. President Trump's done a very good job, and at this point, the deficit numbers have looked a lot better, Joe. We're 1.77 trillion less. Yeah, so I mean, it's going to take time, but we're moving in the right direction.
All right, I'm going to thank you.
Thank you, Joe. Merry Christmas.
All right, Merry Christmas. Andrew.
Always fun, Joe. We got a lot more. We'll do it again tomorrow. Make sure you join us then. Squawk on the Street begins right now.
Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer here at Post 9 of the New York Stock Exchange. We're going to talk to Faber in a moment on Warner Brothers Discovery. In the meantime, futures steady here to kick off a holiday shortened week. Plenty of news on Warner and Paramount, Nvidia, Honeywell. Got some Fed speak to chew on. 10-year 416 and oil's up to 58. Our roadmap begins with markets going into the home stretch here. We'll talk about it. A Santa Claus rally really is in play. Paramount, of course, Skydance amending its offer for Warner Brothers Discovery, with Larry Ellison providing a $40 billion personal guarantee. And Nvidia's higher in early trade. Company now reportedly aiming to begin shipping those H200s to China by mid-February. Let's begin the trading week, though, on a positive note. M&A continues to be a catalyst for this market, and on that front, Jim, you've got some news.
Yeah, it looks like that Nelson Peltz and the group are buying Janus. Now, this is it's 47, doesn't look like a premium, but you go back to October when we were first talking about it, you get a nice premium. What matters here is this is a democratization play, but people don't want to be, from what I tell people, don't want to be public anymore. They want to make dramatic changes to be able to, get individuals to be able to be in lots of things that they're not allowed in, but you will not know it right now if you are in Janus. Janus had a whole bunch of quarters of being up. I remember all the quarters that they weren't being up. So this is a very significant move from the point of view of, I think it's a trend. I think this is the first. I think people don't want to be public. I think they can't make the moves they want to make. I think that they're going to have to change. A lot of companies have to change the way they do business if they are going to advance. And I think that that's what Janus has to do. Nelson will be in there helping. Janus people will be continuing to run the company. I bring it out just because this is the kind of deal I expect to see more and more of. It's one where you just say, being public, you can't get the job done because you're going to miss too many quarters.
If it does require a lot of explanation and education and patience with public investors, Jim, so you're looking for a wave of take privates in 26?
I am. Look, I think this administration is trying to get whoever wants. It's all systems go, because we're going to talk about the Netflix deal, but when I look at this, I just say, you can't really get AI in there and try to change the whole makeup of a company publicly, because you'll miss quarter after quarter after quarter. Janus doesn't miss quarters. So I think it's a great move. I think that Nelson wouldn't come in. He'd own a stake for a long time. The Janus people continue to run it. I just want people to keep in mind that it doesn't change what's going on at Janus. It does say that they're going to go toward democratization, be able to be in everything. That's something that I've cared passionately about. Whether you like these deals or not, whether you're private equity or not, you have the right to be in them. And the individual hasn't had a chance to be in them. This is going to be something that's going to extend the reach. Congratulations to the guys. I mean, it's just a good deal.
That's big news. Do you think that the expectations for IPOs then are overstated?
No, I think that there are I was someone who's a premier holder of companies that can, I'd say maybe number one or two, that is companies that want to IPO, and it's their time too. I think that what we're missing when I look at what's going on in the market is the exuberance, but not irrational, the ebullience, the notion that you can get deals done, the notion that right now there's lots of pools of capital. I mean, this is like the Michael Semblis story about, look, there's a lot of private equity bounce. JP Morgan strategies.
Unmonetized assets.
Unmonetized
They've been sitting there for years.
Yes, and there's also going to be a lot of new young companies. I think it's going to be the first quarter is going to be the most exciting quarter maybe of our lives. That's how much is just ready to happen. Look, this is a deal. I mean, out of nowhere, here's a company we all know, Janus. It used to be great and then have big outflows, and now Nelson's owned it for a long time. They step up, they get it. Very much what I think is going to happen. Look, we have Cintas today going back, taking another bite of Universe. These are uniform companies getting together.
Yeah.
This is what I expect. Is it going to be Wild West? No, I think it's going to be really exciting.
Some believe it may be the shutdown created an air pocket, and some of those things we would have seen in the fall get pushed into early 26.
Great call. I think that there was a lot of we can't get things done.
Right. Why bother messing with SEC in this period?
But when you go to the people who are on the SEC right now, and for background, when I go, here's what I hear. There are opportunities that have not been able to be availed during the previous administration. That's over. We're gonna make deals happen, deals that you never believed because it's time. We want to have IPOs because we want to encourage job formation. I think it'll be interesting. Job formation of the Paramount bid. I hope David's on this.
We're going to talk to him in a minute.
The Netflix bid. How many people have to be trimmed in the Paramount bid versus nobody in the Netflix bid for Warner Brothers Discovery? So I like the Janus deal. I'm glad that we have the exclusive on it. And I think what matters here, just so people know, is you can't get things done publicly, particularly if you want to reinvent the model with AI, under the scrutiny, because you're gonna miss quarters. So why shouldn't you be public? And that's going to be a big theme of 2026. The IPOs that we've all been waiting for, big theme. And the mergers, where this administration is not saying, stop, stop, stop. It's saying, this looks good, this looks good. Now, media is obviously an issue because the president cares directly. But all these things that I've wanted, which is a really good IPO market, and we can talk about what's going on with OpenAI, mergers that make sense, and they were blocked under the FTC, the previous, and Justice Department, the previous administration, and go privates for companies that can't take advantage of AI because it's going to be cause missed quarters, go privates because maybe you don't want the glare. These are all so exciting, and yet when I read the analyst notes, the strategy is just
the analysts, the consensus for 26 is bullish. You will agree.
The consensus is the numbers are, but how we get there? That we get there through companies that are not going to be in the S&P anymore, takeovers. We get there because we're going to have so much money unlocked, sloshing around.
Yep.
It's just an exciting time, Carl. It's going to be really great to watch.
It is going to be interesting. I know you've been all over OpenAI today in data center.
Yes.
There's a couple pieces about, for example, SoftBank raising cash to meet those funding commitments.
What a low valuation. Look, I think that everything I've heard with the last one, we kind of started at 500. This is going to sound really silly, but it's true. At 500 billion last week, at the beginning of the week, then we got to 750, and then we got to 830 billion for OpenAI. It's an auction. I almost feel like the next is $1 trillion with a $100 billion valuation that they can have. Give it to Oracle, build everything they want, and that's what this market's saying. It's saying OpenAI, don't worry about them. They have it all figured out. Everybody's scrambling to be able to take advantage of it. Remember, NVIDIA's in there.
Yeah,
500.
we'll talk about NVIDIA in a second. Do you agree that at 830 billion, you're basically paying 44 times revenue on a loss of every dollar you make?
Look, the year of magical investing is just going to be the year of OpenAI magical investing. There's no doubt about it. When you talk with them, they are so confident that it erodes your lack of confidence. How about that? My lack of confidence is eroded. My negativity is eroded by when you speak with them, because they have the horses. They have. I love Gemini. I'm on Gemini every day, but they are not as developed as OpenAI. I'm going to give OpenAI.
No, but the debate is really: are you betting on AI with OpenAI, or are you betting on a vertical in consumer devices? Are you betting on a vertical in advertising? Are you betting in a vertical in social media and the cloud?
I think they can tackle all comers. I think that if you look at Meta, a lot of people feel that Mark Zuckerberg's fallen behind. I never like to bet against him. You need to have search. There's only going to be, right now, it looks like it's going to be Anthropic, OpenAI, and then a player to be named later. But it will mostly be Gemini because of how well they orchestrated the Google handoff, and because they can have so much programming. So those are the three, and everybody else is going to have to come up with something, and I don't see them in the race unless they write a check to Apple, which no one else is talking about except for me, which probably means I'm wrong, but they should do it.
Right.
Well, I mean, like, I thought the Googles could do it, and they did it.
Yeah.
This is so exciting. I mean, think about it. There's a big three, and they can own this thing. And OpenAI, for all their hubris, for all their belligerence, they have the horses.
Wow. We're going to talk to David in a second, and I'm sure he would agree. I can't keep track with whether they're the Achilles heel and a sham, or they have the horses.
Well, look, when you call them a sham, and then they say, listen, we're not a sham, here's who we have, you can't keep with the sham.
Yeah.
Their level, like I said, their level of certainty is extraordinary. So they must have something that happened, and they don't talk. They leaked in these various publications and wire services that I think are somewhat legit. But something happened last week. Somebody called and said, you know what, we want to circle this at a $1 trillion valuation. And they didn't have it on Monday, and I think they got it by Thursday.
Wow. We'll get to that more in a bit. Regarding media, as Jim said, these new developments regarding Warner Brothers Discovery, Paramount now amending its $30 a share all-cash offer for the company in response to those concerns at Warner Brothers Discovery about the bid. David Faber is on the phone, has details. David, we know that if you're on vacation, there's likely going to be news.
Yeah, without a doubt. I can't remember the last time it's happened that I haven't called in. Although this may be it for this week, Carl. But thankfully, I'll get to this in a moment. There's going to be news next week. Oh, good. All right. Well, thankfully, there'll be news next week, too, when Warner Brothers has to respond in another 14D9 to the news we got today. So I'm very happy about that when you guys are out and I can sit there and at least have something to talk about. The news, of course, this morning, Carl, as you said, is that many of the objections raised in the first response we got from Warner Brothers to that $30 all-cash tender offer from Paramount in the 14D9 last Wednesday, they have tried to meet, namely around financing. And you guys obviously remember I had the chairman of Warner Brothers, Sam DiPiazza, join me on set last Wednesday to outline some of the concerns the company had. Take a listen.
To be very direct, nowhere in any of these proposals did Larry Ellison guarantee.
And that could have potentially changed the board's decision?
Well, obviously the ability to deal directly with Larry if there was an issue to close would be critical. Otherwise, closing might not happen. And some of the proposals, and you've read them now, some of the proposals gave multiple ways for that equity stack to disappear. Now, he guaranteed it through an irrevocable trust at the last minute. And frankly, that wasn't as good as an investment-grade company that purported strong value.
So now they have, obviously, guys, addressed many of those concerns. It's now an irrevocable trust. He obviously given the personal guarantee. He said they will never empty any assets from that trust. They are giving even more specificity in terms of what's in the trust. Listen, many people never believed that in Larry Ellison saying, I will backstop this, that there was any doubt that he would. But to the extent that Sam DiPiazza, as the chairman, and other board members and their advisors were very concerned about that, it does seem as though this morning, with their $30 all-cash offer still in place, with this new guarantee, that they have certainly met many of those objections. And perhaps this will now become really about value. Does it mean that Warner Brothers is going to come back and say, oh, we deem this superior, and Netflix now has to actually respond with potentially higher bid? No, that probably is unlikely, though I don't want to prejudge it. But it does mean that the board is going to have to respond. And if they are still going to say this is a superior offer we still have in hand from Netflix, they're probably going to have to give us a bit more detail, specifically around the value of the spun-off global networks. Remember, the Netflix bid does not include buying global networks, all the cable networks, CNN amongst them. And so we've had this debate going on already about what that might be worth in the public markets when it is spun free. Is it $1 a share? Is it $4 a share? It's a big gap. We didn't really get a lot of articulation from Warner Brothers about how they see it. With $15 billion in debt, there's also real questions there. If they continue to decline, whether you'd have to reduce that debt load to make it viable in the public markets. And remember, Netflix has told us for every dollar that goes back to streaming in studios, which they're buying, they will reduce their own value of their own bid. So there's plenty of complexity here and things that Warner Brothers is going to have to explain in terms of $27.75 from Netflix, cash and stock, of which has come down a little bit because the stock is below the collar, versus $30 a share that now seemingly, guys, is much safer from a board perspective, at least to the extent it has addressed those concerns.
All right, so David, what is the real price here? I mean, there's a breakup fee. Some could argue that, let's just say that when the cost structure is not as good because we don't know who's running the thing. If you're the government, you might say, listen, there's a lot of jobs that's going to be lost on Paramount that wouldn't be if it was done with SAS and Warner Brothers Discovery. But I need to know the real price when you add in the breakup fee.
It's $30, Jim. There is nothing in that I've heard from the company, from Paramount or its advisors, has indicated somehow they are reducing the price to pay the $2.8 billion breakup fee to Netflix. Right? That would be a liability of Warner Brothers. They would own Warner Brothers. They're paying $30 a share to shareholders to own it, and then that would be their liability. That is my understanding. I will clarify or correct that if that's wrong, but I don't believe it is. So
David,
that's the number.
Okay, what would happen if they just gave Zaz what he wants, which is $34?
Well, first of all, it's not clear to me. I mean, it's what the board wants, or what will take it to move the needle for them to say it's a superior proposal. As I said, if it really is just about value. You could make an argument that $30 all cash for the entire company is better than $27.75 for streaming in studio in stock and cash already. That said, I don't know. But 34 you know, it might be that they choose to go to that at some point if they have to, Jim, but right now I think they want to get this on a playing field where it's about value, and then perhaps they will choose to increase if they are rejected yet again, as very well may be likely. And then the other question is, you're competing with Netflix, and Greg Peters, when he joined us last week, made it very clear that they're certainly not going to say no if they have to raise their bid to compete.
David, the other prickly issue, which will get some pickup in the media, of course, regards this concurrent spiking of a story at 60 Minutes. Pieces in Variety and the Times today, Jerry Cardinal on Squawk today called that noise. But do we think we're in an environment where they can't afford to let a story like that run and risk upsetting the president?
That becomes a key question, Carl, and to whether, in fact, that is sort of figuring into some of the decisions and the editorial decisions being made at 60 Minutes, given the importance of this regulatory review. And, of course, we know how important the president is going to be and figure into this. That is atypical, as we say, but he's made it clear. He's also made it clear of his unhappiness with 60 Minutes and recent social media posts. So I don't know the answer, but, you know, again, back to regulatory, it is that larger question as well. Is Paramount's path an easier one, a quicker one, a more certain one, or is it really equal to Netflix, which is, again, what Warner Brothers said in their 14D9 that they released last week, that they see the path sort of, or the risk for both, quite equal. It's an important question that shareholders also will need to decide. By the way, the tender offer, which is out there, it's somewhat inconsequential, right? They'll extend it, expires January 8th. Shareholders are not going to really tender into it much. It does start the regulatory clock. That is helpful. But this thing could be going for a long time if Paramount chooses not to raise from here and really put the pressure on the value side. You know, as Piazza said last week, they're not going to hold a shareholder vote on this thing until the spring or early summer.
All right, so David, I'm trying to understand the doctrine, antitrust doctrine of this administration. Will it figure in that it's very clear that Netflix will not fire as many people as Paramount does to make things work?
You know, I don't know, Jim. That's a great question in terms of the importance of jobs. I will only say this. The synergies that Paramount is trying to deliver, both from the Skydance merger, remember, which is still executing on, right? I mean, that was $3 billion in synergies. And now they're saying, I've been hearing the number $6 billion in synergies from this deal. So you're going to be trying to deliver on $9 billion in synergies, Jim. You tell me what that means for jobs. I don't know the answer, but you got to believe it obviously does include job reduction. If that perhaps becomes a very crucial point from this administration's perspective, you know, it certainly could become something of importance in terms of the regulatory review, even though not necessarily should become something of importance for that review.
Very good. David, always appreciate the color. Try to enjoy the week, at least to some degree.
Guys.
Yeah.
Talk soon.
Talk to you tomorrow.
Yeah. Keep spinning.
David Faber. Take a look at the pre-market. We'll get to some other movers on a relatively busy Monday for a holiday week. We'll get to Honeywell. There's a call on Oracle, Intel, NVIDIA. I got to get to oil and gold and silver when we return. Walking and watching NVIDIA, the pre-market here, sources telling Reuters the company aims to begin shipping its H200s to China by mid-February. They say initial shipments are expected to be around 40,000 to 80,000 units, and that the whole plan is contingent on approval from the Chinese government. Jim, we've been talking about this for a while now.
Yeah.
Looks like it might actually be starting to happen.
Right, I did a piece this weekend for club members where I just said NVIDIA has been disparaged, knocked down, viewed as being second class for the last 3 months. A lot of people felt this deal couldn't happen. A lot of people felt it wouldn't even matter, it wouldn't be in volume. If they can get these numbers, and it's very important because these numbers are not in NVIDIA's estimates. I think this is the first, I mean, with that, we have GTC, the big conference coming up, but I think this whole notion that NVIDIA is just a chip and it's not as good as everybody else's chips, forget it's a platform, it's a system, everybody wants it, and they can all claim they don't want it, and I'm kind of sick of it, because everybody does want it. The Chinese want it. It's because it's far superior to anything else, and why write your programs on an inferior chip? Now, I know, look, I think Alphabet has great stuff. Absolutely. I've been a little critical of Amazon, but they've got a good chip. But this, you want to be in NVIDIA's Vera Rubin, the next generation, and they're ready. And I just think we have to start talking again about the leapfrog. How much better Jensen Huang's platforms, I don't want to call them chips anymore, platforms are. And this is a good example. They don't put some number out without orders. They don't, because there's only one time that I've seen them in the last decade where they got something wrong, and that was with they got a Bitcoin, they got a crypto. No, they didn't know that crypto was using one series of their chips, and then crypto went away, and they were long, and they had to really take a hit to the numbers. One time in the last, I don't know, 15 years that they've gotten it wrong.
Yeah, I mean, some Blackwell friction.
Well, they didn't have it as ready as I would have liked.
The other thing we talked about Friday was the multiple. And I actually had the booth build a chart of a five-year chart of the forward PE. I think we might have it. Why has it gotten so inexpensive on a multiple basis?
I think that there's a belief that the build-out can't happen that the build-out can't be as aggressive. I think there's a belief, again, that that AMD is better, that Amazon is better. It's all wrong. It's all wrong, and we got to stop. We have to stop making it so that there are 4 companies all in this scrum. There's NVIDIA, and then there's everybody else. And you think the Chinese don't want NVIDIA? I mean, the Chinese want NVIDIA. Why is it like this? Because I think that the whole narrative in the last 4 months has been that NVIDIA's lost its edge. And it couldn't be more wrong. And the idea that all these companies don't need NVIDIA.
Flash as we count down to the bell.
I was thinking about the PE multiple of NVIDIA and how it has shrunk because people kind of don't believe. There's been a lot of aspersions cast. If you want to buy gold, there's two ways to buy gold. You can buy gold through Costco. I do that as constantly as I can. And you can own Agnico Eagle mines. I'm not allowed to own individual stocks, but people have to understand. There's Agnico Eagle, and then there's just everybody else. They drill and have mines in low cost in places that are safe. You're not going to find that people are, going to be kidnapped in the great state of Nevada. And I just feel like people should understand this Canadian company that is so well run and has such low costs that just stop it. If you don't have a safety deposit box, which is what you need for gold, don't want you burning back there, buy this company. They're on constantly and they're great.
As for gold, Jim, 4,400 today. That's going to be a 68% gain for the year.
I'm a gold bug. I've been a gold bug for a long time. I'm not changing. I think people should own gold. If you're going to how to make money in the market, I say you must own it. You must own it. You can own crypto instead, but gold is the ultimate insurance play. Insurance play came in.
One of the best, maybe the best performing asset of 2025. Let's get the opening bell on the CNBC Real-Time Exchange. Of the big board, it's Direxion, celebrating the launch of its Titans leveraged and inverse ETFs at the NASDAQ. Verta Technologies, a personal defense technology company. Jim, some work. CFRA, Sam Stovall, looking at Santa Claus rallies. Usually when you get one at the end of a year, the whole following year has better performance.
Look, one of the things that's happened, having had 40 years at the end of the year, the sellers aren't here. The sellers take a break. They've done what they have to do, and they let things go up. They don't offer stock because what's left, they want marked higher. And a lot of these guys have had trouble beating benchmarks, and they've been having trouble beating benchmarks because so much are Mag 7, and so they walk away. And I remember, there used to be what was known as markups, where you would come in and you have to buy stuff and illegal, and I saw this stuff happen. It's ridiculous. But what I do know is they don't need to do it now because any big fund that is offering stock right now is just an idiot. Just let it go higher by consensus. It will.
Yeah. So you don't have a problem with the view that the next 2 weeks essentially could be a melt up going into.
Unless you've got the Supremes come out and say,
right.
Look, we don't agree with the tariffs. Then everything's thrown into chaos. The president has never really embraced the market the way I thought he would. I think that I remember when I interviewed him when he first came in.
Well, I mean, a year ago here at this.
Right. Then he said, look, I'm not going to do what I used to do, Jim. I'm not going to go and judge it by the Dow. Well, you shouldn't have said that. Dow's really very much in favor of what he's done.
Yes. Yeah, we're on the cusp of another 20% year. Haven't done that 3 years in a row since the late 90s.
Well, I think there are a lot of people who got scared out of the market. There are a lot of people who don't want to pick individual stocks. But I saw Schwab, a nice bump today. Schwab represents, as Morgan Stanley, a resurgence of the individual investor. The Janus deal is a resurgence of the individual investor. They've done very, very well in the last couple of years, many years. And what I feel like that people have to recognize is the individual investor is back. Maybe it is the great wealth transfers. Some people say 100 trillion, some go 120 trillion from baby boomers to younger people. Robinhood stock, which is so great as part of that. But I just think that this is, I'm not talking about levitation, but I am saying that you won't see a lot of persistent selling, but you might see persistent buying.
No, actually, last week Citadel did a nice report looking at the bottom 50% of income Americans. Their participation over the last 3-4 years is way up as a group, faster growth than others, and households under 40.
Yes, and then the Trump accounts are coming.
Jake Paul.
People are talking about a lot more things.
I told you I was here.
With their 401k. There's just a good setup.
You could win all that money without having that job broke if you'd have fought me, bitch.
That this could be a gallop. There might be a gallop here.
You want to fight somebody a little bit bigger than you.
But the belief that things are going to happen very quickly and will go higher, I subscribe to that.
Right. There's a nice piece in the FT today looking at some who are a little more cautious. Apollo in the
64
FT.
years of age, perfect shape, man.
Preparing for some market turmoil, right?
I don't know the man personally. I know my reputation. When I read that, I said, okay, I gotta rein it in a little bit. I'm glad you pointed it out because I
Keep
he's
up.
building an
Yeah.
amazing first-class outfit. If he's a
That
little
happened.
conservative, then maybe I should pull it in. But I know that
That
everybody's
happened.
got a lot of companies on the books that they need to sell. I mean, look, we have these IPOs today, an inverse IPO, and it doesn't create a lot of wealth. They may disagree with that, but then I'm looking for substantive companies that come public big. And I'm also thinking that OpenAI should rush this. Now, they have to come up. I think that they should use all deliberate speed.
What? Go public?
Yes, because I want them to be the first in the queue. There's going to be some gigantic companies. I mean, Musk himself could bring a number of deals that I think people would say, I got to own that. And then in the end, it's like, the money runs out.
Right.
There's only so much money.
Right. Well, you've seen Bill Ackman's post to Elon Musk, sort of suggesting some cooperation through the SPAC front, yes, regarding SpaceX.
I think Musk is kind of a... I think Musk can do it alone. Congratulations.
Here we go again.
Here's my feeling on the pay package, and I've been articulated today. They made you so much money if you were in the stock. Shut up and just count it.
His pay package, $139 billion, restored by Delaware.
$139
activity in
billion.
self-driving over the weekend in San Francisco on these blackouts where Waymos were not able to read the traffic lights. There was limited wireless data.
$139 billion.
The hell Waymos and said, you're talking about the way people go in San Francisco because it's a little cheaper, I think a little safer. So obviously this is something that we have to keep track of. Especially because there were...
Oh gosh, we're already open.
Self-driving. I would hate to see them...
Looks very unprofessional.
Yes.
Sheet.
Yes. To your point though about OpenAI, Jim, this call out of Wells on Oracle today, overweight 280, which is 46% upside. Their
What?
argument is essentially that a lot of bad news has been priced into Oracle.
If OpenAI does its deal and they raise $100 billion that they
Slash ES is at the 200. Pay attention.
and Larry Ellison can both
For the good morning flush.
Can guarantee the Warner bid.
and he guaranteed and suddenly
And cover his lease
well,
payments.
because one of the things that like you talked to Corey, which I think is a very honest broker here. Corey would say, look, it costs a lot more money now than it did even.
Randy loves days like today.
Materials, a number of people know how to do it. G. Vernova, Scott Fraser came here. He'd tell you that listen, you can get in line, but we don't have enough turbines. Which people at home might think of as turbine, but it's it's turbine.
Yes.
I want to correct that.
Every time this comes up, you do the
Well,
turbine.
because like people say, like, oh, what is he wearing?
Yeah.
But I do think that
Open broke out, just like Jimmy said it would.
what people were selling would be
Yes.
reasons why you'd have to buy.
He said
We
it.
didn't really look at a 1 month, let's say, of CoreWeave filling that gap last week, Jim.
What?
It was interesting.
People don't understand InTrader. InTrader is the guy who NVIDIA calls when they want to have these sites
It
managed.
says I don't understand. I don't like it when people tell me that.
But they were.
'Cause he doesn't understand.
Look, they're the best. Everybody's going to have trouble building these things because you just can't.
Goodbye.
Get the workforce. It's like the rest of them. How do we get the workforce in Taiwan Semi? We don't have enough.
Goodbye.
And a good
Ooh.
outlook here for what 2026.
She got
Find out
schoolgirl
what
dress
their
on.
portfolio.
Woo!
Open your mouth. We'll be right back.
Damn. She's dressed for her flirtness. Uh-oh, AMD. As we approach the VWAP, we all are kind of stunned. Jim, would you take it here, or would you wait and see if it wanted to touch the VWAP? I said, if I was to jump in, I'd jump in small. Do-do-do-do-do. I've been doing this for a long time. There it is, right there. He's doing it right there at the VWAP. We're at the VWAP. Ladies and gentlemen, we're at the VWAP. Let's just get this real tight here. Just look at /ES, which will be trading SPX. Can anybody tell me which one I'm looking at on the SPX? You're right. The 6880s. We're at the VWAP. Pay attention. $3.60. We're at the VWAP on the /ES. We're at the 9 EMA. This is the first support. Tweezer bottom on the 1 minute. SPX at $3.70. Can you get 360? That's the question to ask. Or should you just go ahead and buy one now and say I got it on sale? $3.70. She does look like she partied last night. There it is. There it is.
Some markets like Korea, I was hearing another gentleman speak about it, are up 60-70% and Spain and so on.
Tell Nicole that I got in the VWAP at $3.50.
I'm optimistic about the markets. I think
the 6880s.
But I do like U.S. small caps more. I do like international more. Mainly valuation support, weakening dollar, etc. So I'm somewhat positive on markets, but I believe there'll be more action or more upswings outside the U.S. large cap space.
So tech, large cap tech and growth really drove a lot of the gains this year, right? So next year you're looking to diversify more. You mentioned small caps. Why small caps?
Small caps usually do well when the Federal Reserve cuts rates, and Federal Reserve has been cutting rates. It's also extremely cheap compared to large. Also, people forget the gap between U.S. small and large this year was one of the smallest. I know
that's a lie.
The losing area, the losing category versus large.
You're a liar.
Almost a decade now. But the gap, especially if you look at the Russell indices, is very small this year between U.S. small and U.S. large. And I believe, given the valuation support, Fed action, etc., small should have its day in the near term.
Understood. You also mentioned that you like international.
Back him in the corner.
We were pointing out Korea and Spain doing well. Where do you like?
He's a liar.
Where are you going to play internationally?
I would say emerging markets still look very attractive. It's always hard to predict which country will do well, so I take a broader view. So I'm looking at emerging markets. This year has been led by Korea and China. In the past 10 years, EM has been led by Taiwan and India. So to me, I like that mix. Those four countries constitute most of EM index, and to me, they're all at different stages of their economic growth, etc. So I like emerging markets. I also like international. So I would, with some extra dollars, I'll deploy it a bit more outside the US and with US small cap.
And so with the all-weather portfolio, and I want to get to your stock picks next, but what is the recipe for this all-weather portfolio?
disaster.
Nicole, I'm completing 33 years being a quant equity PM. We run about $20 billion now out of the McKinsey GQE team out of Boston. I keep my life simple. All weather core to me means
Keeps his life simple.
At any point in time are either value friendly or growth friendly or
You're coming on here preaching and saying you keep your life
to me,
simple.
the all-weather portfolio means I have all of those styles embedded in my process, roughly in equal proportion.
Who the hell you
I'm
think
not
you are?
exposed being a growth manager in a value period or being a value manager in a growth period. In other words, I have enough quality stocks in my portfolio.
Oh, in other
enough
words,
growth
you
stocks in my
ain't trading.
portfolio, and enough value stocks in my portfolio. Hopefully, which will help me navigate different market environments well. Even though this year has been about growth, if you look at
He's lying, Nicole.
ahead by 800 basis points versus the MSCI World Index. We have had 4
Don't trust him.
episodes where we have each added alpha this year. First quarter was actually about value. The
Meta,
first week
new
was
highs.
actually about quality. Since then it was growth, and this quarter has been more about value. And in each of those episodes, the portfolio
Value.
has beaten its benchmark. That's how our all-weather core portfolio should operate.
You liar.
Yeah, understood. I mean, you have a pick here like Teradyne, for example. The high was 205 recently. It's not that far off. It's close to $200 right now. What kind of upside potential do you see, like, for a name like Teradyne, and why?
You know, as I was trying to give you some names here, I did not want to give Micron, which we also own, but that's at all-time highs. So it's relatively cheap. It's also, like a lot of its peers, has been beating expectations. We also, in the last 10 years, have a lot of machine learning-oriented metrics in our mix, and they predict fundamentals of the company, and our models...
PLTR moved this morning.
Teradyne. We also look at the quality
Google pulled
of
back
our
and bouncing up.
employees at Teradyne, and our research shows that the employees there are happy. So it has a trifecta. It looks cheap on evaluation, has the right growth characteristics, and also has quality support.
Understood. You also have Mondelez and Citigroup. Quick thoughts there, please.
I wanted to give you a contrast. Teradyne is more the growth stock, whereas Mondelez is really a value play. It does not have much growth.
Don't trust him, Nicole.
Those are neutral, but it looks very cheap. If you look at the stock, it's been a one-way street down. And last but not the least, Citigroup is also a good blend. It's cheap on many measures like price to book compared to net interest income.
I'm in the SPX right here.
Beating expectations, especially
This is the /ES off the
also, when we
VWAP.
look at things like support from informed investors or smart investors. There's not much hedge fund activity there, so on, which is a positive for Citigroup.
Understood. Aruk Datta, McKinsey Investments. Wonderful to see you on this Monday. Thank you for your outlook and your all-weather portfolio and stock picks too. Nice to see you. Happy holidays.
Don't trust him, Nicole.
The key levels to watch here, as we're not too far off from record highs, and there's still some talk of a Santa Claus rally. Kevin Green will comb through some of the numbers and levels that we'll all want to write down. Opening bell. We'll be right back.
Her Christmas outfit passes. Barely.
Sometimes, you know, you could...
It barely passes.
Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves,
She's dressed as an elf.
fundamentals shaping the markets in real time. This is Schwab Network.
Jenny Horny is.
SchwabNetwork.com.
And back to even.
Live from Chicago, this is Trading 360.
I love you.
We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy. It's a comprehensive
I'm up.
market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
So far, we've held the orb.
Welcome back to Opening Bell. I want to take a look at some of the key levels to watch. This is, we're seeing up arrows this Monday morning. Joining me right now, senior markets correspondent Kevin Green, combing through all the numbers and the levels here as we are having a
Boom.
holiday trade trading week.
Break it.
Christmas off on Thursday. Your thoughts at the levels this morning. Good morning, Kevin.
Break it.
Good morning, Nicole. Yeah, we are seeing over around 68% of the stocks in the S&P 500 are green so far, and 9 of the 11 sectors in the green. So we are seeing broad participation. It's a pretty decent and healthy mix as to the outperformance to the upside when you're looking at the sectors. But if you're looking at the levels, 68.80 is the first major area of resistance. That is where we saw a significant amount of calls being sold early on in today's session. We got fairly close, around 7 points away from it before we backed off here. But overall, once again, the participation in the volume levels, as far as volume flows, are actually to the positive here right now. To the downside, the first area of support, 68.30, and if we break below that, 6800.
We don't want to do that, Kevin.
We are seeing a 14 handle. We haven't been able to hold a 14 handle in the VIX for very long, usually maybe 2 or 3 sessions before we actually see it re-rate a little bit higher. Now this week might be a little bit different because of the holiday dynamic, but something to keep your eye out on here. If we actually do get news,
come on, brother,
we can see volatility re-rate aggressively higher over the next week or 2 weeks.
You know, we don't need this negativity talk.
NVIDIA, I mean, we continue to watch and see the story about the
NVIDIA.
I know they've been also with the funding of AI, but really just the expansion we've seen in NVIDIA this year has been incredible. What are we watching here now?
It has been. You know, NVIDIA actually has been consolidating here over the last week and a half, 2 weeks. Even though we did see a lot of the mega cap tech stocks fall to the downside here, NVIDIA has been able to hold a key area of support at around that.
NVIDIA.
Now we are seeing the stock move a little bit higher this morning on the back of this news. Up
yeah, we are.
2%, but you are seeing an actual.
Is that why we're doing it?
Upside of this triangle formation.
You sure?
Where we were making lower highs.
Kevin?
We were sustaining the same level of lows here. Now we are coming up, trying to test that 50-day moving average.
We are now at $3.70. My SPXs, you're up $20 a contract.
MACD is looking like it wants
Have you ever thought about selling?
Formation.
No.
Keep your eye out on this stock. Obviously, it's a major weight in the S&P 500 and could be a major driver for our gains here over the next week or 2 weeks. If we are starting to see this rotation out of the value names into the tech names that have been maybe oversold. Or
it's still kind of bearish, but a little sign of bullishness.
And thank you for all those details. Appreciate it. We continue to take a look at the markets here, and joining me right now, Joe Mazzola, Director of Trading Services at Charles Schwab. Great to see you, Joe.
I love you.
Happy Monday and happy Christmas week. And, you know, we're still...
Happy.
I mean, we just had, for example, Douglas Jonas on, who still felt...
About happy Jamaica
in 2020.
having a fair weekend.
When it comes to technology right now.
Well, I think if you want to see all-time highs, it's going to have to lead. I mean, what I find really interesting, Nicole, is that even...
I think it'd be a great idea. I'll meet you there.
Weeks or so,
it's on me.
Much of that churn below the surface. Rotations into industrials, rotations
we're at 4:30.
Financials. Consumer discretionary. You know, these are all sectors that have kind of helped prop up the S&P 500. Now, we haven't broken out. But what we've done is we've maintained, or as you know, kind of Kevin was saying, we're kind of vacillating around in these channels, which I think is healthy because it shows that we can kind of maintain these levels without that big tech. Now, you're getting some of that move today.
Yeah, we are.
You see NVIDIA, you see Oracle. They're all moving.
They're up pretty nicely there, $4.30.
On the Micron news that came out Thursday, which look, when I look at the Micron earnings and the demand that they
what do you see?
Forward, it brought back some life to the AI trade. And that was the same.
It brought back some life, he said.
Concern that we had seen before where
MU.
Are these now all off-balance sheet transactions? Or are we moving away from cash financing?
Will we fool again?
That's what sunk Oracle over the last couple of weeks. And to kind of get Micron back into the fold, saying no, Micron is pretty good going forward. It really gave the boost to that AI trade.
What did it do?
Needed. And if that's the case, right, if we can build some momentum behind that trade, all-time highs are pretty darn close.
What are you trying to say?
How about we get to Tesla? Because I saw that Elon Musk, they talk about him being the first $1 trillion man, right? People are looking to that.
You got a problem with that?
SpaceX next year, but I mean, he's crossed the $700 billion mark. The pay package, the excitement about the robo-taxis in Austin, Texas.
Ooh, Tesla.
30 cities and just continued growth. The stock's at a new all-time high. We think about Mag 7. Tesla's a name that for a while people were saying, yeah, I like the Mag 7, not necessarily Tesla. What are they saying now?
Well, they're saying they like it and they're putting that at all-time highs. Here's the interesting thing about Tesla is, you know, when you think about the Mag 7, like I said, I'm going to go back to that balance sheet idea and the cash flow. You know, real positive cash flow is what really kind of dominated the Mag 7 trade for multiple years, except for Tesla. You know,
This
Tesla
crowd's
was
going wild at the sports arena today.
amount of cash, or if they were generating it, they were putting it back into kind of
Hey,
operation.
Nancy.
It's been, you know, it's one of those stocks.
Do you mind
that I think investors buy because
open up a shot of vodka?
It's difficult to kind of put a valuation on the company as itself, because if you look at it as a company, well, then it really doesn't make any sense compared to Washboardjim. But I think you have to look at it as a tech company and all the other avenues for investment that they offer, whether you mentioned like the robo-taxi, you know, SpaceX, all the different type of ways that you know that Elon's able to kind of monetize.
Jim, you're up $70 a contract.
I mean, if there's
Have you ever thought about selling?
Da Vinci of our time, I think that's
Jim, you're up $80 a contract.
Excuse me.
Have you
Yeah,
ever thought about selling?
This is one of those, you know, you buy it because you believe.
Jim, you're up $567,000 a contract. Have you ever thought about selling? Jim, you're up $100 a contract. Yes. Have you ever thought about selling? You got in these at $3.50. They're now at $4.50. I think, yes. Sell them? Hello? Jim, I was sitting next door here watching your YouTube channel, and we just got cable up again. I live out here in the hick. And yeah, I jumped in them calls. I got them cheaper than you did. You got in a little bit early, Jimmy. But I waited, got in there at 3:20. And I was telling my wife, telling Bernice, I said, Bernice, he did it again. I jumped in these things down here at $3.20 a contract, and I just sold them at $4.50 a contract. I don't know how he does it, but let's give him a standing ovation. Just comes natural. Yeah, man. Say what? Turned down for what? Duplicate that. Put that right there. Take that off. Remove it. Now I'm going to go into the kitchen, begin my water for my coffee. I plan on rewarding myself. Yay. Okay. Santa Claus is coming to town. The crowd doesn't know what to think. Oh. Oh. Jim, did you just get yourself a present? For I'm Washboardjim. I'm the thinking strategist behind the strategy of the sneaky snake trading strategy, where I talk about chart patterns, moving averages, and being square, being dialed in, and not being a sucker. And I'm next to Carl. Okay, as we approach the VWAP here on the SPY, we must ask ourselves our question. We pulled bump from the bottom. We got a V-shaped recovery on the 1 minute time frame. We broke the resistance level, which was the VWAP. Now we're back to gaining respect. Are we going to remain bullish, or are we going to just kind of hover around, come down and hit the 200 and bounce up off the 200 and then retest the VWAP? Or are we going to hold the VWAP, stay bullish, break a triple top, and go up to a double top? That's the question, and I'll be right back. Does anybody want to pay my taxes? Please say yes or no. Don't be shy. Seems like everybody's always been shy. No one's never wanted to do that for me.
I have example trades for Oracle and Home Depot. Oracle's down more than 40% from its recent all-time highs in September.
Randy says he'll pay the taxes.
10% so far in 2026, as the housing market remains sluggish, to say the least.
Randy will do
Let's
it.
take a look at where markets are half hour into the trading day. The S&P 500 up nearly 0.5%. The NASDAQ 100 up 0.6%. The Dow Industrials up just over 100 points, or 0.2%. The Russell 2000 exploding to the upside, up 1.1%, leading the four major indices in here. Now let's take a look at some of the foreign markets here. We've got the FTSE 100 out of Britain down nearly 0.5%. German DAX off fractionally. Nikkei in Japan up 1.8%. And Hang Seng up just over 0.4%. Let's take a look at some of the other asset classes here. We've got the 10-year yield continues to consolidate between 4.15 and 4.2%. That's actually lending some support to equities. U.S. dollar off about 0.3%, and that's been weak over the past couple of months. Gold hitting record highs overnight, and crude oil up over 2% on some geopolitical risk down there in Venezuela. And Bitcoin, also one of those asset classes, risk on mode right now, up over 2%, back above 90,000 as far as the futures goes. To help us break down what's going on, we're going to bring Kevin Green. He's going to join me now. He's senior markets correspondent here. KG, Reuters reporting that NVIDIA expected to begin H200 shipments in mid-February. This is going to be a bonus for NVIDIA and the chip sector in general, just due to the fact that, they're not really reporting any revenue, and they haven't reported any revenue. But this would be a big boon, I think, for this stock.
Yeah, I would agree with you. If China does allow the sale of these H200s into China, that's going to be the key factor here, which is probably why you are seeing the shares up about 1.2% here, but not seeing a massive move to the upside or not getting ahead of itself when it comes to this news story. But you are correct. It appears, based on this report, that NVIDIA has told some of their customers that they aim on starting to try to ship these H200s around February of 2026 here, and this could actually be between 5,000 and 10,000 chip modules, which would be the equivalent of 40,000 to 80,000 H200 chips. So this will have a meaningful impact when it comes to their revenue boost if this is actually going to happen over the next couple of months here, Tom. But once again, there's still a little bit of risk between China and the U.S. and their talks when it comes to not only just trade talks in general, but also when it comes to geopolitical risk events like the Venezuela situation that you talked about. China's kind of interwoven into that. But we are seeing some optimism here. If you're looking at NVIDIA, I mean, it has been consolidating, holding at 170 level as an area of support, and now it is trying to break out of this triangle formation. So from a technical standpoint, let's see if it's going to be able to capture the 185 level. If they continue to have news items like this one that's being reported, you could get a lot of enthusiasm for this name, and maybe some buyers try to step in and get ahead of maybe increased sales to China over the next couple of quarters.
Yep, and you take a look at that 50-day moving average right near that 185 level. It's acting as resistance right now, but as you mentioned, stock now up 3.6% in the month of December, 36% in 2025. So we'll continue to watch that one, and there might not be any headwinds this week in a holiday shortened trading week for a lot of these names if you get some momentum going and some continued momentum. KG, let's flip the script here and get into this discussion about gold, silver hitting record highs. I mean, the appetite from risk on trading in some of these commodities, I get it, KG. It's probably some central bank buying, but do you think like traders are using this maybe as a hedge against this expansion that we've seen in the equity market also? But it just seems like there's so much money out there going into different parts of the economy as far as asset classes goes that there's just no relief in sight to the rally that we've seen in the metals.
Yeah, I think you are still seeing a little bit of a catch-up trade. As you talked about, we have seen the gold move to the upside that has been aggressive this year on central bank buying, but now you are seeing silver really outperform. Silver is up over 130% year to date so far here, and I think this is on the back of not only optimism from a retail standpoint, those buying into ETFs like the SLV and things of that nature, but also the fact that we might be seeing a little bit of stickier inflation in 2026, maybe some industrial expansion, and that's really what's being driving that silver trade. I also think, once again, this is a FOMO trade taking place here. You are seeing it kind of break to the upside here, potentially testing that $70 level. And so this is a very volatile trade, but you're not only just seeing it in gold, you're seeing it in silver, now you're seeing it in palladium and platinum. That catch-up trade is still taking place, still maintaining here, Tom. I wouldn't discount it just for the fact of uncertainty when it comes to Fed policy here in the United States as well as other central banks. There's also probably this excitement around the industrial expansion narrative in 2026, which could also then lead to materials still outperforming to the upside, which a lot of these gold miners, copper miners, silver miners are going to be within that basket, and then still seeing a little bit of outperformance when it comes to the industrial sector as a whole. So the trade continues to be fairly strong, but I think it's signaling multiple factors, not just one.
Yep, throw in the fact that the dollar's been weakening too, definitely helping lift some of those asset classes. Let's pivot over here to crude oil, up over 2% here today. U.S. intercepted another oil tanker in international waters off the coast of Venezuela, Kevin. This feels like it just continues to heat up, even though crude oil's down significantly. Gas prices are down. That's good for the economy. But this just seems like it's going to continue to ramp up and snowball here, KG.
I mean, that could be the case. I think we have two that have been confirmed that we have seen reported, and then one that appears that we might be trying to seize here in the coming days. and this is having a little bit of an impact when it comes to the oil trade. Now, one, this is more probably short covering, geopolitical.
What's a SPY here?
Priced in, but if you're kind of looking at the long term,
SPY's
you're
at the
talking about
200.
maybe 500,000 to 800,000 barrels per day. That could be
It's now 9 o'clock.
Around 80% of that
10:08
Venezuela is going to China. So
Eastern
that's what
time.
I kind of talked about earlier. China's now being
I'm looking at the
brought into
SPX.
this, indirectly, if you will,
68.80s.
conflict, but it is hitting that 20-day moving
Right now they're
average
at
in blue. If you look into the
$2.75.
upside, you're looking at your next area of resistance.
It's right above the
sitting
VWAP.
around, let's say $59.50.
Okay, prepare
There's
ye.
a significant amount of short interest or short position.
I think
when
this
it comes
can
to the
be
crude
done.
trade, Tom. So do we actually get a short covering event taking place? If you're looking at the longer term
serious?
fundamentals
Jim's
of
getting
the oil
into the
market
trade.
just in general and the energy market,
If he
it's
gonna
all
do it, I'm
supply
gonna do
driven,
it, I
not really
promise.
demand driven at this point. If we start seeing demand actually starting to pick up, that's where you could see maybe a turnaround story when it comes to the oil trade here. So seeing a bump today, let's see if it's going to be able to last, but it does appear that the Trump administration is
Pay
really
attention.
expanding their blockade from what they initially signaled when it came to
Pay
sanctioned vessels, now expanding that to potentially all vessels that are carrying either Iranian crude or Venezuelan crude.
Yep, and that's, remember, crude oil last week bounced off of over 4-year lows near that $55 a barrel level at this point. So still at low levels at this point. Finally, KG, let's wrap up.
$2.80.
Platinum, palladium. I mean, these these alternative type of metals, but they're showing a lot of gusto here too.
They are. We do have to put a little bit of a caveat here.
Some people said he didn't have the guts to do it. There it is, 270.
Volume. So if you're not experienced in trading these markets, maybe look at other avenues in order to get exposure instead of going directly in. Spreads are fairly wide. Contract size is very large as well. But you are seeing a lot of these metals moving to the upside. Now, I think their story here is not only that catch-up trade when you're looking at the metals, the industrial expansion story that I was kind of talking about earlier, maybe in China, which is actually raising up their platinum bar purchases here. But you're also looking at this readjustment here in the United States, focusing more on ICE vehicles rather than EV vehicles here. And if that's going to be the case, platinum and palladium are both utilized
Something to
in
drink.
catalytic converters as well as some other products here. So I think this is a catch-up trade. This is a short squeeze for sure. And if you're looking at platinum or palladium, they have been literally compressed or depressed when it comes to valuation over the last 7 years, even 10 years if you're looking at some of these charts here. So a nice squeeze to the upside. Let's see how this is going to last. Very thin market though, so if you're a retail trader just getting in,
Not good.
Be very, very careful.
All right, good little education there, KG. Appreciate it. That's Kevin Green, senior markets correspondent here, helping us break down some top stories here. But coming up, we're going to dive into the market signals to watch for next year.
That's not
Our next
good.
guest believes there may be some policy tailwinds on the way for investors on the tariff front. Morning Trade Live's coming right back after this short break.
We got a double bottom. Straight across double bottom was right there. $69.12.51. You can stay. I'm looking. I mean, I'm looking at AMD. We got NVIDIA. Hell, it hit the 200. We got a triple bottom on Apple quad. Easily, almost a 5, where it takes a nosedive. If you count the wick, make it quick. And I'm in the SPX. And we're at the orb. That's one good sign. And that candle's not a bad sign. Oh, look at that. Tesla. See what happened to Tesla. I bet you some people are stuck in this one, but I'm not for sure. Come on. Tesla looks like it took just a big old slap in the face. And that's the snake. I don't know if it's a trade yet. It hasn't broke out. But if it did and it pulled back, it could be a trade. If you wanted to trade it like that. And I'm in the SPXs. I gotta hold this orb. See what the 5-minute does. 5-minute candles. Come on. Back to even. See, that's where I made a mistake. Not buying a dip. That there was pretty bad. Yeah, I could have went to town here. $2, easily. I could have picked them up and sold them at $2.70 and $2. I'd have bought 6. So I'd had 6 times 70. Yep, that would have been a good one. So, We're at 220 right now. 15. Let's see. I still might get a chance. This is what's the psychological part. I missed the first one. I was in it, but I missed by adding on. Oh, yeah. There you go. Yay. How's he do it? Pretty good.
I'm Diane King Hall on the floor exchange. When markets react, we are live with analysis that matters.
It is.
Now,
That's her.
on SchwabNetwork.com.
How's it going? First day, so.
Sometimes, you know,
Next. Try it again.
you could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support.
Very good.
Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks,
You better make one to move up.
we're tracking the catalyst analysis that move markets right into the close.
Here on the floor, I bring you real-time
Tell 'em,
sentiment
Marley.
from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Back here on Morning Trade Live, Elon Musk's $56 billion pay package from 2018 has been restored after the Delaware Supreme Court overturned a lower court decision that originally nullified
Would you
Musk's
please break out?
compensation. The 2018 pay package is now worth about $139 billion based on Tesla's Friday closing price. Stock hit a new high today, up 1.75%. So extending those gains that we've seen after the nice rally that we've seen over the last couple of months here. Now, let's get into a discussion with the team from Charles Schwab. We're going to welcome in Cooper Howard, Director of Fixed Income Research and Strategy at Charles Schwab Center for Financial Research, and Michelle Givley, Director of International Equity Research and Strategy at Schwab Center for Financial Research. Cooper, I wanted to go to you first here because I wanted to talk bonds here a little bit. I think that's part of the reason we've seen some support in the equity market is that we're not getting any volatility out of the bond market. Yields have kind of stabilized at 10 years, just hanging out between 4.1 and 4.2%. That's probably a good thing, right?
Yep.
You know, if we look short term, I do think that that's likely to continue, given the week that we're going into.
That's not the question.
Very light week in terms of economic data. Obviously, we're going to get GDP tomorrow. I think that that's really what the market's going to be focused on.
Yes.
We'll see if that shows strength in the underlying consumer. So if that does show strength in the consumer, then that bodes
But
well
then
for the economy going
we gotta go through, how many times have we got to go through this?
Term in just this week, we do think longer term yields are likely to remain range bound into 2026.
What did it tell us last
what that
time?
means for the rest of the market.
Oh, God. Week after week after week. Why? Huh? How can we keep relying on the same data week after week after week after week after week after week?
Today, Michelle, when you take a look at the broadening of the rally that we've seen in the overall equity market here, but we've seen strength overseas also. Do you expect that to continue to leak over, or any impact from maybe the tariffs going away? That's going to be a positive, not only for domestic but for international also.
Well, in terms of the broadening of the market, that certainly can help international stocks. Markets appear to shift depending on the day between AI optimism and AI skepticism. But investors might decide to search for growth beyond tech and the Mag 7, kind of broadening out from AI enablers to AI doctors. And, international has a lower weight in tech. And they also have a high exposure to cyclical sectors that could benefit as economic growth accelerates.
Name one.
If we look at earnings, international stocks are expected to inflect from basically flat earnings this year for the Eurozone to 11.5% growth next year. And valuations are still really attractive. Every sector within the MSCI EAFE index trades at a discount to every sector within the S&P 500. So there's some good opportunities overseas.
Yeah, and I think a lot of people have taken advantage of that so far here in 2025. Cooper, when you take a look at fixed income, its impact on the equity markets, I think the long rate's probably going to stay up here. If you saw the long rate start to come down, if you see the 10-year get below 4%, maybe go down to 3.9%, that's probably going to be a warning sign that something else is breaking here, right? Because like I stated before, that lack of volatility in the bond market's actually been a boon here for equities. And do you expect that to continue, or do you expect more volatility to come into play here in the bond market?
I wouldn't be too surprised if we continue to see it range bound. So it really all boils down to a couple of key indices or a couple of key metrics that we look at in the longer term part of the yield curve. And you can really break down movements in the 10-year Treasury into Fed funds rate, expectations of inflation, as well as the term premium. And the term premium is kind of this catch-all, if you will, for volatility. Now, the expectation in terms of Fed funds rates is right now the market's betting between about 1 and 2 rate cuts into 2026. I think that's relatively appropriate. We'll see where the data develops, what happens with inflation, and
okay. Oh gosh. Hogwash.
Certainty in terms of Fed policy going forward, and that should trend.
More hogwash.
Across the board, the divergence is real there from the Fed at this point as far as expectations. But
that's right.
When you take a look at the different areas internationally where things are going well, I mean, does anything stick out to you as far as maybe Japan doing maybe better than the EU? Defense spending starting to pick up over there. We've seen some better data out of the EU recently, but Japan still seems like a winner. But any areas that stick out to you as far as international?
I would note that for Europe, the massive fiscal stimulus program that Germany passed earlier this year really has not gotten started yet. Germany was operating under an emergency budget situation for most of this year. So that spending should pick up next year. And also last week at the ECB meeting, President Lagarde, she sounded pretty optimistic about the forecast for GDP. And she said the reason was not just government spending, but also exports, as well as corporate spending for large and small companies, including on the development of AI. And we're seeing lending pick up in the Eurozone, and that could boost growth as those funds are being spent. And that could also boost earnings, and that's why we expect an increase in earnings growth next year. So that's a positive for Europe.
Yeah, definitely. Earnings beaten across the board this year domestically also and overseas, definitely lending some support to this extension of the 3-year bull rally that we've had. All right, great discussion here, guys. Thanks to Cooper Howard and Michelle Givry, both of the Schwab Center for Financial Research, breaking down international markets and bonds. But coming up, it's we're going to take a look at Oracle. One analyst believes the stock's undervalued right now after this massive pullback that we've seen since September highs. Morning Trade Live, come by right back after the short break.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange.
Yes.
Countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Let's focus on Oracle. The stock's up about 17% so far in 2025, but that doesn't tell the whole story. The stock's gapped up about 35% on September 10th after earnings due to that very bullish cloud forecast and backlog numbers that exploded. But now the stock's down more than 40% from those all-time highs in September. down about a couple percent here in December, but making a nice little pop here today off of those recent lows. Wells Fargo put out a note today reiterating its $280 price target and says that they're more bullish on that. Let's bring in Marley Caden to help us break this down, to host a Market on Close with Sam Vadas, and also a contributor across the network. When you look at this stock, Marley, it's been a pain trade for investors over the last 3 months. But at the same time, we're still up positive for the year. This is just about maybe some outlying catalysts that have driven the stock down, but get a nice little pop here today.
Yeah, it is getting a nice pop off of this note. Like you said, Wells Fargo put out this note. They've reaffirmed their rating, so by equivalent here, they've got a $280 price target. That's about 46% upside from Friday's close. So pretty significant upside, and they've got some reasoning for it. They said that they think investor sentiment around Oracle has turned surprisingly negative recently, and surprisingly being sort of the important word here. They think that market participants are cautious. We've seen this caution in the whole AI trade,
that's a good idea.
Oracle's exposure to OpenAI. That's one of the ones that's really cited. Now, you mentioned that we've seen the stock drop pretty considerably this year, and that's what's prompted some of the optimism from Wells Fargo. They think that the decline has actually created a potential buying opportunity here. The recent struggles have been centered around this AI.
There's the buying opportunity
we've seen, and these cyclical high-profile AI partnerships. Now, Michael Turin is the analyst over at Wells Fargo, and he said that he thinks that this uncertainty surrounding the AI trade narrative and the competition among the bellwethers, particularly as it pertains to Oracle, is somewhat overblown here. And the caution that we're seeing about the potential execution and the financing risks over the next few years may have some legs, but he sees this downturn as an opportunity. We're down 42% from the peak that you mentioned back in September. But Wells Fargo says that the market is really pricing in only negative outcomes right now, while Wells Fargo is arguing that they're underestimating the potential positive developments. Despite the pullback, they say there are positive catalysts here for Oracle. There are some positive signs here. One of the ones that they cite as a big driver here is TikTok's U.S. business, their latest agreement to manage TikTok's business. They're part of the group of buyers that will collectively own 45% of TikTok. And a different note from RBC Capital also noted that their deal could increase revenue for Oracle Cloud infrastructure. So this is another big play here and provide some strategic advantages through TikTok's data system. So we don't have a lot of detail on that yet as it hasn't come to fruition, but a potential growth driver there. And projections say that this OpenAI partnership that they have, that could contribute 25 to 30% of Oracle's earnings for fiscal 28 to 2030. So they see these as net positives and not reasons to be negative, Tom.
Yeah, in the Blue Owl news, kind of pulling back from the investments that they had in the data center in Michigan, that was a concern. Taking on debt's a concern. Their free cash flow fell a little bit. So there are outliers out there, but is it built into the stock? I think the Wells Fargo analyst believes it is built into the stock already after that over 40% pullback. All right, thanks to Marley Caden helping us break that down. But let's now trade it. Bring in Charles Moon, stock strategist at Prosper Trading Academy. Okay, we talked about the downturn that we've seen here, Charles, but at the same time, I think maybe the pullback that we've seen, bear market territory, it's given some opportunities to traders if you're bullish on this one, right?
Right, and in the short term is getting a bit of a boost from the TikTok news. Stock's been going up and recovering above key levels in the near term since that news has been coming out. More importantly, it's starting to anchor at these levels. So I would say 192 is a very critical price to watch here. I love the breakout of potential above 203 for a race to 213. So trying to take advantage of the short-term momentum, I'm going to be looking at the January 2nd 205 strikes. Now, initially, I was looking pretty high at around 420, but you could get a much
think so, huh?
I still believe the risk is going to be 50%, but we're looking to gain over 200%. This is where we're going to say the Santa Claus rally in conjunction with the recent news has to carry this stock up higher. And, you know,
that big bing there, that was me.
Holding up a lot better than, all the other data center names and a lot of the other big tech names. And so it's showing me, at least, and even in short-term bear market conditions, even though we're up today, we've been working lower. Oracle's starting to find some buyer demand. So if we get into a really bullish uptrend and we start ticking up here, I believe that Oracle's going to benefit greatly. I believe that there's great value near-term and long-term. and I could really see this stock hitting 213. You know, if there's great momentum by the end of this week, which is on this short trading,
You gotta be kidding
week,
me.
a little bit optimistic, but more likely at the end of next week here.
Yeah, buying the straight call, we got 420 up here, just as you mentioned, that's where it was. It has pulled back from session highs, but you can get that call for about 270 now, so that would take your break even up to 207.70 to the upside. That's about 5.5% higher over the next 11 days, Charles, when you look at this. And I think one of the keys when you're buying straight calls like this is not a money call. You need to move to the upside of over 5% to get above that break even. But Charles, it gives you some flexibility as far as trade management because you don't have to wait the full 11
Charles.
days. We do get that Santa Claus rally, which typically starts December 24th and goes to the second trading day of January. That could easily get Oracle above that break even level, right?
100%. And again, you know, if we're talking about maximizing our potential, we're certainly going to try and ride it out.
This guy's moving in on George.
You never go broke taking a profit. If you're happy with gains, you certainly should take it and run. You know, you never know with names like Oracle, which has been certainly an underperformer over the last 3 months. You know, and I certainly could totally see a lot of people being a little bit jittery around this stock. But
I am.
I'm looking to play this short-term momentum. I believe that there's enough propellant to certainly carry this name, you know, past this 200 mark, right through this 203 level.
Don't you think we need to get out of SPX first?
There's not much to slow it down to get to 213 here.
Yep, that 200-day moving average, which has been below for a couple of weeks, right, at about that 213, 214 level. So good look at that. And it's risk defined, which we always like here on the show. All right, great stuff. Thanks, Charles. Have a great weekend. Have a great holiday. That's Charles Moon, stock strategist at Prosper Trading Academy. But coming up after the break, we're going to take a closer look at sectors on the move this morning. Morning Trade Live. We'll be right back after this short break.
Boom.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are.
I should sell them right here.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and
180.
news that shape investor decisions.
We're at the 200.
And actionable context, from inflation data to sector rotations,
Marley,
to policy. It's
God,
a
you're hot.
comprehensive view of the market.
But I got to tell you something, honey. Right now, I'm making a business decision. It's either you or ride this out, take profit, $2 contract. Oh, there is. Jim, sell, sell. That's an engulfing candle. Not to do it outside. Crowd's going wild. I heard sports arena. Thank you very much. I think we know what to do. Oh. $3.10. That's it. No. Yes, sir.
Typically, we see that VIX fall on Friday, it rallies back on Monday, that VIX effect, we call it.
$2.25.
You know, holiday shortened week, so there's not a lot of headwinds. We've got some delayed
2:30
data with GDP, durable goods, also here. But this reminds me, Kev, all of our days on the trading floor, people start taking time out, days out of their models and stuff like that because there's not a lot of headwinds. But this momentum trade will actually keep going, and typically that Santa Claus rally doesn't start till Christmas Eve anyway.
It started today, bitch.
Well, I think, you know, most traders in our career time, we consider that December expiration the end of the trading year. Now we're clearly in holiday markets, less eyeballs. The double-edged sword of these markets is machines are still trading.
Exactly.
Machine trading is still trading. They don't take holidays or time off, Tom. So less human eyeballs, but still machines. So they have the ability to move if something to change the overall tone of the market.
$2.35 a contract.
On these half days and holiday days, but
You're up $100 a contract.
shake these markets.
Jim, what have you ever thought about doing right there?
As long as the news cycle and headlines favor it, yes, I think that is the way it could go.
Okay, Kev, when you look at the tech sector, we were jittery last week and the week before. This AI bubble trade rumors and theme was starting to come up a little bit, but now we've got some settled down. You were out on Thursday and Friday, but we saw some solid gains. We're seeing an extension of those today. That could definitely lift markets just due to the impact of how big these companies are and the impact of the overall market, right?
Think about it. You have good news in NVIDIA. Not only
Always clean as Jim.
of that new super sector that we talk about around AI,
Samantha.
but also a name that's frankly been beaten up the last few months. So it may have room to run back up towards 200, especially, remember, Jensen Huang in their earnings report said any sales to China are above and beyond what we're expecting. So the fact that they're talking about in February sending H200 trips to China, that's gravy on top of their normal earnings expectations. So yeah, you could see NVIDIA recover nicely. I think the Oracle news is pretty good news. I think what Wells Fargo's note today on Oracle is really good news. So I think, like I said, as long as the news cycle promotes a bullish tone, yeah, I think the markets could drive.
Yep, I think that's the expectations everybody wants at this point. You mentioned NVIDIA. I mean, that stock was trading $170 just about 4 sessions ago. Now back above 183. So lending some support to the potential for the Santa Claus rally. All right, good stuff as always. Thanks to Kevin Hinks, co-host of Fast Market with me. But coming up after the break, it's going to be time for Inside Out. We'll take a closer look at Home Depot and bring in an example trade when Morning Trade Live returns.
Hey, investors, you know the market moves.
and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
Yep.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward market coverage every trading day.
This is a make or break level for this stock. That could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach.
You sure can.
Interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Well, shoot. What's next?
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots.
Macro
Watch
matters.
live, subscribe free at schwabnetwork.com.
Back here on Morning Trade Live, here are what home improvement retail stocks are doing today. Home Depot, Lowe's, Floor & Decor, Builders First Source, all are down this year as the housing market continues to be sluggish. Let's go inside out on Home Depot. Joining us now is Michelle Connell, President and owner
Michelle
of
Cowell.
First Capital Management. Welcome to the show, Michelle.
For having me.
All right, so let's get into this discussion about Home Depot. Shares are down about 10% this year. Earnings continue to wane here. I know they're a pretty shareholder-friendly type company with buybacks and raising that dividend, Michelle, but the way that I look at it is until we get interest rates down, these stocks are going to be, under pressure, aren't they?
I would agree with you on that, even though, we started to see some improving home sales in October and September. Things look positive. You had 4 million existing homes sold both months. But I think people are just sitting on the sidelines, even though mortgage rates have gone down from 7% at the beginning of the year. We're now for 30-year about 6.2, 6.3. I think people are just waiting and seeing, and until that happens, it's going to be a tough slog.
I think
and
so.
I think that's part of the problem, Michelle, and you make a great point, is the fact that, hey, if we don't see a 5 handle on that 30-year fixed mortgage, then I just don't see any catalyst that can, bring us back quickly. And you've seen that stabilization in the 10-year. That's where a lot of the 30-year mortgage comes off of. It's stabilized around 4.15, 4.2%. Do you expect anything from the Fed to kind of help this, or do you expect long rates like the 10-year to continue to be at these levels? Because that's not going to lend any support to the housing market anytime soon, right?
My opinion on the Fed is probably worth what everybody else's is, right? Everybody has one, but I don't see them taking down rates more than 1 or 2 times next year. And does that take you down to 5%, where you reference where we may need to be in order to get more momentum behind home sales?
Yeah.
I don't think so. I think we're going to see more pressure from tariffs as we're inventory in a lot of companies is being spent. And I think it's actually going to be a little bit harder to expect interest rates and mortgage rates to come down that much.
Yeah, when you look at the update they gave on their last earnings, it kind of gave this rosier outlook in case mortgage rates did come down. I mean, what are your expectations for a stock like this? Is this one of those stocks that you can maybe hold for the long term, but or do you stay away from it until you do see a change in interest rates?
I think I'd want to see a little bit more proof in terms of existing home sales continuing to do well and mortgage rates come down a little bit more. I found it amusing that on their analyst day, they had two scenarios, right? They had their base case scenario where your comp sales were going to be basically flat. And then they had their best case scenario, which would take them to revenue almost pre-mortgage crisis. I don't think we're going to have that kind of momentum. And so for their best case scenario, they saw comp sales going up 4 to 5%. I think that's beyond being optimistic. I think that's, I'm not going to use the word, maybe I shouldn't use the word delusional, but it's way too optimistic. And I would sit on the sidelines with these stocks. And Home Depot has done a really good job in terms of acquiring companies on the professional contractor side, and now that has been fully integrated, and 50% of their sales comes from that area. If you really want to own something in this space, I move to the other side and do Lowe's. They're still in the process of becoming more of a professional contractor one-stop shop.
Yep.
Lowe's.
So wait and see, I guess, is the takeaway here. All right, great stuff.
I shop in there.
President and owner of Porsche Capital Management. Thanks to her, and have a great holiday. But now let's trade it. Let's bring in George Tillis, senior markets correspondent here. George, you got an example trade for us here in Home Depot. You heard Michelle's take. What do you got for us?
Well, I think, this whole concept of wait and see on Home Depot makes sense considering what's going on with the stock in the last year. And in fact, if you just look at today, it's just drifting slightly higher, but it's doing so on low volume. So if you look at the technical position for Home Depot, it actually came and tested some area of support that it hadn't seen in March. This just goes back a few weeks ago. I did notice also that there's a rising 200-week moving average for Home Depot, which is approximately around the $330 area, give or take a few dollars. So considering that there's low volatility right now, maybe the stock will find that area of support right around that 200-week moving average. I'm going to place a simple trade, essentially going out to January expiration third week, and I'm basically going to sell the 34 Delta puts. That's the $340 put option, and altogether you could essentially earn about $4.50 a share or $450 a contract. So by selling this cash secured put, you first have to be able to post margin just in case you get assigned shares at the 340, but your cost basis is $335.50, which again is approximately that advice 200-week moving average. And again, the whole premise behind this trade is it fits with the price action, but it also fits probability-wise. That 34 delta does imply about a 66% probability of profits between now and expiration.
Cash secured put, neutral to bullish. You mentioned that higher probability of success.
You can do better.
But you mentioned the capital that you're going to be required to have. In case the stock does fall below that 340 level, you have that potential to get assigned on this short put. So capital intensive, but if you expect some consolidation, and it's a twofold type of trade, George, as you mentioned, hey, you either get to keep that $450 credit that you collect on this, $450 per put that you sell, or you've got to be comfortable owning the shares if the stock falls below 340 and you're still short that put into expiration on this neutral to bullish cash secured put. They're looking for some consolidation, maybe a little bit higher markets, but if it does fall, be prepared to maybe own the shares. All right, great stuff. Thanks to George Tillis for joining us, breaking down that example trade in Home Depot. That's going to do it for us today here on Morning Trade Live with Tom White. Download Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Don't like risk.
Actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey Bob. Hey Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim is my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. It makes a huge difference when you have someone that actually cares.
Good morning. We're 90 minutes into the trading day, and welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what we have coming up on today's show for you. With the new year right around the corner, we'll take a look at the ETF landscape and what to expect in 2026. That's coming up in our 360 Spotlight. And Deutsche Bank sees Tesla's Q4 deliveries falling short. We'll bring you the news and an example trade in our disruptor. Then for our 360 round, we'll highlight NVIDIA, take a look back at some of the biggest stories from the chipmaker that we've seen so far this year. But before we get to that and more, let's take a look at how the markets are faring on this Monday morning. As we take a look here on our big board, we do have green across the board. The S&P trading up 0.5% right now at 68.66. The Nasdaq trading up 0.4 higher, 25,446. For the Dow, we've added about 188 points this morning at 48,323. And the Russell 2000 is up almost 1.5% at 25,65.69. The 10-year also higher today at 4.17. The dollar just slightly lower, 97.91. Gold is trading much higher, 1.75% higher at 44.65.40. Crude oil also higher, close to 2% at this point, 57.60 a barrel. And Bitcoin trying to get back to that $90,000 level, up almost 2% as well at 89,750. I do want to welcome in our first guest, so joining us now, Kevin Green, to talk about the saga that continues to be this Warner Brothers, Discovery, Paramount, Skydance never-ending built for Hollywood story, KG. Update us on what's the latest here. They're amending their what was a $30 per share all-cash offer. What's happening now?
Well, they're still keeping the offer of $30 per share for Warner Brothers Discovery here, but they're providing a little bit more guarantees when it comes to this deal. In fact, Larry Ellison agreed to an irrevocable trust of around $40.4 billion in order to secure the deal. Now, this is in order to ensure that they have proper financing, as well as kind of putting a commitment up stating that they are ready to purchase all of Warner Brothers Discovery. It's a little bit different from what we have seen for the Netflix offer, where a lot of the assets would go into Netflix, but Netflix does not want to own the news outlets, at least for now here. This also is including a higher breakup fee for this deal in the event that it does not go through. So overall, we are still seeing this saga continue as we talked about, and we are seeing maybe some adjustments to this deal in order to ensure that everybody is able to actually complete this deal and that proper financing can be done in order to get it across the finish line.
Really interesting. We got the first announcements and Warner Brothers came out and kind of said they felt they had been perhaps misled about some of this financing. Now, clearly, this is the response to that commentary. I suppose the question here is, KG, we're seeing a favorable response for Paramount Skydance today. They're up, 7.25% right now. How long is this going to play out for, realistically? I mean, what's the timeline here? The analysts tell me anywhere from 6 to 18 months.
Yeah, it can be a long time. It depends on what they're trying to acquire. If you're looking at the Paramount deal, they're trying to acquire all of the assets. So that would also then require regulatory approval, especially if you're looking at the news organizations. If Netflix is able to purchase this company without the news organizations, then they don't really need to have the licensing component added to that. So that's where this is going to, the timelines are going to differ. And yes, this can take 16, 18 months, even 2 years for that matter, if this back and forth continues. Now, we actually have seen the fact that looking at Warner Brothers Discovery, they could actually kick out the offering time for a lot of these companies to submit bids. That can also delay it. So a lot kind of going into this, but I think the regulatory headwinds that they could see is really going to be dependent on the news organizations as part of this portfolio more than anything else.
Kevin, we appreciate you being with us for the latest on this story that I am certain we will continue talking about into the new year and maybe perhaps through the entire year. That's Kevin Green, our senior markets correspondent. Now we'll move on to get some insights on the broader market, what's shaping markets right now. For that, we'll welcome in Eddie Gabor, the owner of Key Advisors Wealth Management. Eddie, always wonderful to have you with us. We've got green on the board here in this shortened holiday week of trading. I'd love to know that if you think in addition to a visit from Santa later this week, if we'll get a Santa rally after we see him.
I do. I think we're going to see a lot of folks trying to do what we call the catch-up trade and some window dressing for year-end. Unfortunately, many money managers have underperformed their indexes, so I think you're going to continue to see buying. And a lot of the bad trading is behind us. We've had some carnage in the AI trade where some real frothy names lost a lot of value in a short period of time. And you're starting to see those names actually catch a really big bid. So that's a very good sign that we're back into a risk-on environment. And I think this is going to carry us well into January before we have to worry about the AI trade being overbought again and seeing a sizable drop in tech. So we're very bullish here. We're seeing a broadening out in the market. When you look at small caps today, they're having another big day. So these are all very positive catalysts, but it won't be as easy next year, especially for those that are overweight tech. We certainly won't be one of those in 2026.
So I know you are not going to be overweight tech. I know you started repositioning a bit earlier this month. What signals told you that the risk reward in tech was changing and that it wouldn't be the same setup as we saw in 25 and 26?
So one of the things that has us the most concerned is the bar is set so high for earnings. When we look at earnings next year, for these companies to surprise to the upside, I think is going to be very, very challenging. And you started to see some signs of that post-earnings where names would lose 10, 15, 20% of their value. So we still own a good amount of tech right now, but we anticipate rotating and being extremely underweight sometime in the first quarter next year. January or February right now is what we've kind of guided to our clients is probably the highest probability of timing. But we'll let the technicals kind of tell us when it looks like there's exhaustion. But I think when you go to the first quarter next year, especially when we get the Santa rally that we're expecting, tech is going to be extremely overbought, extremely crowded, and be very, very bullish sentiment. And so the risk reward there, in our opinion, will be very poor. So we're going to rotate out and then look for a better buying opportunity later in 2026 in the tech trade. It's been an amazing year and last year. So we certainly don't want to give back a big chunk of the gains in the big year we've had for clients.
So as you follow the technicals and you start to see that they're giving off the indicators that make you want to rotate further away, where are you going to look outside of tech for these opportunities in 2026?
So at the beginning of this month, we started to go to the more economically sensitive areas that have really underperformed. And the reason for that is we're going to go into 2026 with a very accommodative Fed and GDP that we expect to accelerate. So we want anything that's going to be interest rate sensitive or economically sensitive due to what the Fed is going to be doing. And that doesn't help the AI trade. That helps other areas like financials, like industrials, like small caps. And so when we look at small caps and financials, those are probably the two most benefiting from this major pivot with the Fed in regards to their bond purchasing. The other thing too in regards to small caps, it's been a long time since they've broken out. They've kind of been dead money since the fourth quarter of 2021, and we're just now breaking through new highs. So when you start to see that, a lot of times that momentum will pick up. It's very under-owned, and I think you're going to see more and more folks rotate into that trade as tech fizzles out in 2026. So that's our playbook for next year, and we'll change if the data tells us to change. But we think this economy is going to boom in the first quarter and surprise to the upside from a growth standpoint.
So Eddie, if investors watching want to follow your thesis here, what data outside of GDP, which you just mentioned, would be most important to supporting your thesis?
The price action itself will speak for itself. You know, you have seen an outperformance and you're starting to see a bid relative to tech. And when you look at crowding in regards to sentiment, AI bulls bears spread, as well as earnings. I mean, fundamentally, we've seen about 20% year-over-year growth in small caps. So when you take a look at where they were 12 months ago versus now, and you look at the comparables, it's a much easier hurdle for small caps to beat on earnings going into next year versus tech where the bar is already set really high. So it's a contrarian play and rotating from the most crowded area that's owned into an area that's under-owned. So, and again, we've had a really good run in tech for the last couple of years. So some of this, frankly, is just common sense to kind of rotate, take profits, and buy the things that haven't caught a bid. Because unless we go into a recession, which we don't think we're going to, we're not seeing this big bear market or recessionary environment. We're just going to see a major rotation out of an overly valued and overcrowded trade, in our opinion.
All right, so let's talk about the picks that you sent over for 26, because one of them is a big tech name. It's Apple. It's your favorite tech play for 2026. Because the expectations are so low, what specifically do you think the market is missing when it comes to
$3.30.
So Apple checks off every...
These are the 6880s. Washboardjim has a $130 entry on it. They're now at $3.40 a piece.
2025 is going to help it in 2026. And the other thing with Apple is the bar is set low because of those AI expectations. And we're seeing a real increase in sales with iPhones in China. So with our U.S.-China relations getting stronger heading into 2026, the global demand for their product line should surprise to the upside. So Apple is a defensive tech play, which is why it is our favorite in 2026. And if you were to ask people who the best Nat 7 name of 2026 is, they're probably not going to say Apple. So again, another contrarian play. But it has quietly been outperforming since August a lot of the big semi names. And so we think that momentum is just getting started.
All right, and you said you want to go into economically sensitive areas, which we certainly know is the housing market. I see you've got a pick here for the U.S. Home Construction ETF, ITB. Walk me through that thesis, because I've heard mixed commentary on housing.
This is probably our biggest, I'll call it, gamble in regards to, from a technical standpoint, they haven't really shown the strength that we would like it to see. But we entered the position because going into 2026, we think the Fed's bond purchasing is going to put a cap on the 10-year. And the Trump administration has really stated the fact that they're going to try to do certain things to get housing revived again. That's one thing that we're looking at as a bullish catalyst for home builders. So they have been beaten up. They have been big underperformers. They play on mortgage rates getting better, as well as an administration that may be putting policies in place that we're not aware of yet that will stem home builders. So this is our biggest contrarian play going into 2026, because I know a lot of people are very bearish on housing, and I understand why.
I appreciate you being with us. I wish you a happy holidays to you and yours, as well as Eddie Gabor, the owner of Key Advisors of Wealth Management. We've got plenty more for you to come today on Trading 360. Next, of course, we've got the big three stocks, 3 charts, and 3 trades. Richard Cat will be here to take us through the technicals, and Tammy Marshall will take us through the trades for Roku, Qualcomm, and SLM Corp.
Boom.
That's next on Trading 360 on Schwab Network.
I'd say SPX just hit my resistance here, the orb. We're now $4.10. Woo! Well, everybody knows, everybody in the room knows that I told Jake Paul, I said, do not step in the ring with him. You'll get your frickin' jaw broke. Jump in the ring with me. I won't make it look as bad. In fact, I'll give you the win. I won't break. I'll just break half your jaw, not double break it. So, but you had to go with the younger guy, the bigger guy, and again, you made the mistake and got your ass whipped. But I tried to tell you, you could have made it an easily $100 million fighting me instead of him. I mean, I don't know what you were thinking. I'll be right back. I got coffee brewing. It's just something I wanted to get off my chest. And I think everybody here agrees. Even Marley.
On this shortened holiday weekend, if you think we've got potential for a Santa rally.
Yes.
Well, absolutely, I do. We're still not to those targets that I'm looking for.
We do, baby.
SPX, which goes over 7,000. So I am looking for us to continue this rally up.
All right, so let's go right into the big three here. Your first pick is Roku. They've gotten some really bullish sentiment from the sell side community of late. Walk us through this pick and why it popped for you for your first pick on the big three.
I tried to tell her. Roku, because it is a streaming platform and a lot of people are leaving cable at this point. The other reason I like it is because it looks great technically. It has all of the moving averages on the side of the bulls. We're above the 200, we're above the 50, simple moving averages, and I look at those. I also look at the 5 and 13 EMAs in order to let you know, of course, those are Fibonacci numbers because I'm the Fibonacci process. And we're not to larger swing targets. So whenever I see something that has a pullback within a larger swing and we aren't extended and haven't met targets yet, that looks like a great opportunity to get bullish to me. The larger swing targets are 124 and 132.
All right, so,
And,
go ahead.
I'm sorry, go. I was just going to say, and so what I'm looking for is I am looking for a call debit spread with a 30th of January expiration. And the price has moved around just a little bit this morning, but right now I'm looking to risk 173 to make 327.
All right, Rick, so when we take a look at the technicals here for Roku, are you seeing the same bullish sentiment and setup here that Tammy's seeing when she takes a look at the charts?
Whoa.
There's some pretty interesting
How dare you.
here that you could consider. Just to backtrack a bit, if you were to
No
look
guessing,
here,
Tammy.
105 roughly is where we had a high point, all the way back here at our red line here. That's about where we encountered resistance.
I signed up with a woman.
We broke out to the upside, but there was a period of high volatility. The intraday highs were far beyond our best close. Our best close was more around 106. The intraday highs were around 117.
Descending flag.
So then we retreated. We hit our
Triple
support
top.
zone here. 93 was our darker green line, a low point several times. Then you can also see 91 was more lined up with the extreme lows. So 91 to 93 is a supportive area
Another
to watch
pullback.
going forward. But we have seemed to have moved beyond that area right
Yes,
now.
we have.
You could draw this short-term trend line here as well to give you one potential short-term breakout point to consider here. So if we were to look at our moving averages,
68.80s are now at $4, $5.10.
What we have here are the 21 and 63-day exponential
Say what?
moving averages in yellow and orange respectively here. The 21-day EMA in yellow matches up with the 105 level, so a bit more emphasis on that as a potentially supportive area. Tiny amount of bearish divergence here in the RSI, but this could be a consolidative phase before we get another push to the upside here, because we are hanging on above our old high closes, and for the most part, things seem to be holding on. RSI is still quite high. Finally, if we were to look at our volume profile study, we are in a relatively light trading area. All the volume is down here from 95 or so, but we do see up here +1 standard deviation channel comes in just above 115, so pretty close to our old highs near 116. That would be the next potential hurdle.
Oh my.
We're trading just below those old highs right now at about
$5.30.
2.25% today, but year to date we're up about 50% for Roku. This next one we'll talk.
Sorry, we have breaking news here. A reporter out there in retail traders land, Washboardjim. What are you hearing right now? Well, what I heard here, we were sitting down here on YouTube watching Washboardjim called out this here trade, and everybody kind of laughing at him. I said, no, we got a snake down here on top of the orb. The SPX, triple bottom. Pay attention. And everybody's sitting there laughing and shitting up the spooting up the chew. And I said, no, SPX calls $2.70. I think you need to go ahead and jump in these trades right now and see where they can take you. And you don't have to go in a lot. And if you do, you could add on. And I know you did, Jim. You added on some at support level. Is that the 1 minute time frame here? Yeah, it is. They're now at $5.40. Have you ever thought about selling? You're up over 100%. I said, well, yeah, I did. Should you go ahead and sell them in? Yeah, I think I should. Come on, Rick. Don't fuck up the market. I hate when these rookies try to get on here and start talking smack. Jimmy called the bottom on Tesla. We're at $5 on business decision. These are the 6880s. We don't want it to go below the 9. We want it to hold. Come on. $5.10. You ready to have another drink of coffee? This is my last cup of coffee. I gotta go to the store and get some more. These are the 6880s. Come on. We're still above the 9. Now, you know, it's that time of day where it's 10:24 and I'm getting a little nervous. What should I do, Marley? I told you Jim's selling there at $5.20. Now I want this to be a, don't let this be a bad lesson. Women are always right. So we'll just wait a second here. Right now I should be out of the trade. But I'm still above the orb. Is that your ding-a-ling going off? Yes. Okay, I've got a picture here. I'm going to see if anybody can tell me who it is. Woo! This is going to be funny. Today's game, can you tell me who this is? Be glad he didn't jump in the ring with me. I'd done a lot more damage. Come on, motherfucker. think you know what's best, man. Okay, we're squeezing. Something's going down. Okay, here we go. Any second. Educate. Pollinate. Escalate. Hydrate, breakout rate, see we have the 9 and the 21 as a eyewitness to the moving average Godfather, that the 9 is above the 21. Which tells me that this could be stronger than if the 9 was below the 21. So as it starts to move back up, I have to make a business decision. Do I want to sell it in the heat? Look at Hot Lips Marley. And she got this guy on here, this Todd. Marley, you need to interview me, not him. Here we go again. That's nasty. Oh, yeah. Oh. That didn't sound good.
How do you see that influencing flows in 26?
Good question.
What we saw a lot in 2025 was that people stuck with their cryptocurrency ETFs despite the volatility. And we also saw some
Gonna be another good year, Marley.
So firms like Neos and Calamos are two firms that launched options-based strategies to get exposure to the crypto world. So either downside protection or enhanced income. That's exciting to me, is that brings some of the best of the ETF world by making complicated strategies simple to be able to have access to. And so I think that's another emerging trend, is that options-based strategies have gained a lot of traction, and we've got some of these leading firms that are helping to bring those best ideas. So I mentioned Neos, I mentioned Calamos. Goldman Sachs bought Innovator ETFs, or announced they're buying it for 2026. This is a really exciting time to be in the ETF industry.
And with how much of an uptick we've seen in ETFs, more on the market offer than ever before, if someone is trying to take a look at investing in the wrapper for the first time, how would you tell them to approach looking at the ETF space, and what kind of due diligence?
Good question.
Yeah, so the ETF marketplace has become a lot more crowded. As I mentioned, over 1,000 new ETFs already this year. I would keep it simple. If you've not invested in ETFs beforehand, low-cost, broad and diversified strategies tied to the S&P 500. SPLG is a great example of that. That is a State Street product tied to the S&P 500. Just 2 basis points. That can serve as a great building block to build your portfolio. And then you can add some other asset classes. If you wanted to add crypto, you want to add international equity ETFs, there's a number of products that are available. But keeping it relatively simple, there's a lot of noise, there's a lot of new products that have come to the marketplace. Get your feet into the ETF marketplace with something you're comfortable with, like the S&P 500 or other broadly diversified U.S. equities.
Some great insight there, Todd. Thank you for being with us to talk about the ETF space and its rapid rise that we saw in 2025. That's Todd Rosenbluth, the head of research at Vetify, and happy holidays to you, Todd. Coming up next, we've got Disruptors. We'll be taking a look at Tesla after Deutsche Bank is predicting its Q4 deliveries will fall short of expectations. Stay with us.
Oh. You think so, huh?
Stay connected to the markets with the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's
That's right.
interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden here at our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets. Welcome Nicole Padalides, host of Opening Bell and the Watch List. Good morning to you, Nicole. We're about 2 hours into the trading day. I'd love to know what stories or action or theme has caught your eye so far on this nice day of holiday green we're seeing.
Yeah. Santa Rally.
Market breadth is pretty good here. You see different sectors, materials, financials, energy. Many of these sectors are in the green. Most of them, in fact, are in the green. I mean, you do see one lower, and that is consumer staples. But other than that, the other 10 sectors have green arrows. Now, of course, we're kicking off a shortened trading week. We do have 25th off. That is Christmas. And then on Friday, back open once again. As far as the trends that we're seeing, there's a lot of excitement about the possibility of the Santa Claus rally. You do have 10-year bond yield right now at 4.16. We continue to see gold and silver and copper at or near records. So that play for precious metals has been an exciting one, and there's many reasons why people go to the likes of these precious metals. We continue to follow the battle for Warner Brothers, where now Paramount Sky has updated its bid, really showing the commitment of the Ellison family, not only now, but also right to the closing, and that they'll be there to have that commitment. And Netflix is now falling while we have Paramount and Warner Brothers higher. We'll talk about Oracle in a moment. NVIDIA has also had some good news as they are now ramping up the 100 chips to get those off to China. So that's a big deal as well. Those are some of the stories we're following, but I think the big picture here is a shortened trading week. But people are here and showing some commitment. And of course, the Fed always in focus, who will be the Fed head, and some comments from Beth Hammack, who is a little more focused on inflation, less on jobs. She's a voting member next year and will likely say no to a cut in the near term.
Yes, and of course you mentioned Oracle there. They are seeing a move to the upside today. They're trading up about 2+%, 2.5% right now. On this note from Wells Fargo, can you walk us through the bullish sentiment we're hearing and why we're seeing this move in the price action today?
Yeah.
Yeah, I mean, there's a lot of excitement about a name like Oracle. I'll also note, and I'll get to it in a moment, the power inflow alert was triggered, and I'll explain what that is. But Oracle has come off with its high of 345, and now it's trading around 197. But I'll tell you, Wells Fargo here puts a 280 price target. That is a 46% upside potential from Friday's close. and they have an overweight rating. And some of the reasons are the
What
pullback
you
that we've
think?
seen. They think it's overdone, that the stock is undervalued, that the AI worries were too much, and that we're in the early innings of AI. So that's number one. They also said they
You think so, huh?
really can grab some meaningful market share gains in cloud, and that was another reason why they were on board. And lastly, back to the AI story. that we're in the
Because you're over water?
innings, and there are some folks who are worried about Oracle's investments into OpenAI. In fact, the stock has dropped below those levels before the OpenAI days, but Wells Fargo did note that even OpenAI could represent a good portion of earnings going forward. For example, it could represent 25 to 30% of Oracle's earnings fiscal year 2028 to 2030. So that was some positive news. And I'll leave you with the last bit. Of course, TikTok. That's the other thing. Don't forget, we got a nice surge on the stock when it was revealed that Oracle will run that deal here for ByteDance for TikTok's portion of the USA business. That's likely to go through January 22nd, and that gave a boost. Last but not least is this power inflow alert.
Can't complain about that, baby.
90.55, and it can be a bullish indicator of the interest of institutions and retail investors, and it shows a possibility that at that
Come on,
level,
Nicole.
when it hit that level and trigger that power inflow alert, that it represents that may be a
There's
level
a bit
where
of
traders
spice,
are more
baby.
interested in entering the stock, and so that too could be a bullish indicator. Marley?
Yeah, certainly, and echoes, what Wells Fargo was saying about the pullback we've seen may represent a buying opportunity here. Nicole, we appreciate you breaking that down for us and also for the market update.
Oh gosh,
Nicole
don't
Henley.
rub it in.
And now it's time for the disruptors. We've got George Tillis, our senior markets correspondent, here with us now with our company we're talking about today, Tesla, of course. As George says that they see Tesla's fourth quarter deliveries falling short. which
George.
frankly, I don't know that I see as all that surprising.
Tell him to stop.
But still, Tesla 2.5% higher on the day, George.
Yeah, this has been a great story for Tesla, or at least the price action as of late, Marley. I mean, recently the stock broke out to a new all-time high. It actually has not performed well this year relative to the other mega cap names. So for what it's worth, there's a lot of activity going on at Tesla.
George.
Deutsche Bank's call here is really about some of the Q4 delivery numbers, which they suggest are going to be around 405,000 units. Down about 14% year over year. That's to be expected considering that in Q3, that was the final EV tax credit quarter that was available for buyers. They were offering, of course, $7,500 in tax credits for new ones, but also $4,000 for used vehicles contingent upon some income restrictions. If you look at last quarter, Q3 deliveries were close to 500,000 units, 497,000. So they are suggesting here, Deutsche Bank is that there's going to be a little bit of a lull, and that's to be expected considering the big rush in purchases in Q3. But nonetheless, the story really for Tesla, as of late and always has been and maybe continue to be, is robotaxi and robotics. And that's really where Deutsche Bank still sees promising potential for Tesla. They essentially maintain a $500 price target on the name. And recently in Austin, there was a declaration by Elon Musk and company that essentially they will be, providing unsupervised FSD driving in that city, plus again in other cities to compete with Waymo. So right now, there's a lot of promising aspects for Tesla going forward. Price action suggests that as well. Irrespective of the fact, again, valuation is still quite high at around 293 times forward earnings, but it's not trading based on valuation or based on fundamentals on a trailing basis. It's really about the future.
Yeah, and that's the conversation we always have about Tesla and why there's such mixed feelings about it too, is what is their future and how do you value this kind of company? So knowing that they've had mixed performance, but still year to date, even with the mixed performance, trading more than 22% higher in 2025, how would you structure an example trade here, George?
Yeah, so one thing that I noticed, the stock on a weekly basis did, like I say, move higher relative to highs going back to December of last year, right around that 485 level. One of the things I also did notice in that regard is that volume wasn't very high. So the FSD news recently was a positive catalyst, but I do suggest a lot of the price action in Tesla as of late is really a share shift from the other mega cap names. For instance, there's weakness in Broadcom, in NVIDIA. So for what it's worth, again, the short-term momentum is still positive, but there's a lot of volatility in the near term. options. So what I'm going to do is I'm going to structure a bullish trade with some volatility in mind, and also with a couple holidays coming up in Christmas and New Year's, we could essentially earn some additional theta decay or time decay in those expirations. So I'm going to structure a long call diagonal spread. What I'm going to do is I'm going to sell an out of the money January with 11 days expiration weekly contract, the 510 call option. I'm going to use those proceeds to buy an in-the-money July monthly contract for 90 option. So this is a $20 wide spread, and altogether it costs about $17 a share or $1,700 a contract. So in essence, if the stock moves to 510 or higher between now and 11 days, the profitability is capped in this trade to $3 a share because essentially you're paying $17 or $20. But in essence, if the stock stays below the 510 between now and, of course, the expiration of that weekly contract, that will roll off and expire. Then the January contract is unencumbered for unlimited profits. But again, the break even on that position is 517. 507 is the break even on that by expiration in January of the third week.
And that would mark another all-time high for Tesla if they can get to those levels. But every guest I've had on so far in this show today, George, has said we have a Sand rally coming. So we shall see. Appreciate you being with us, George, to walk us through the latest note and the technicals of that example trade on Tesla. That's George Tillis. Coming up next, we've got our 360 round. We're going to talk about NVIDIA, their breakout 2025, and where the stock can go in 2026. Trading 360, we'll be right back.
That be said.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Moore. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for the stock.
And that could certainly be short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only from Schwab Network. Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Jimmy's in these at $1.30. Should he sell them?
It really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren planning
Dad,
college.
I got a question to ask you. How come Grandpa don't spend much time back there in the barn with me anymore?
Built for traders who want more than just headlines.
We used to milk old Melly all the time. You don't do that no more. You don't milk me like you used to.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Yep, that's what I thought. $3.40.
Welcome back to Trading 360. I'm Marley Kate.
Woo, Marley.
The 360 round.
Let's go.
Bring in our panel to discuss NVIDIA. We'll take a look back the year it had in 2025.
Schoolgirl dress, very good.
Joining us, Ben Beharin, the CEO and Principal Analyst at Creative Strategies, and Dan O'Brien, the President at Futurum. Dan, we saw NVIDIA in 2025 pretty much
NVIDIA.
more than a chip maker. It's become very central to the AI trade and the AI economy. What's your single biggest takeaway from NVIDIA's performance this year?
Oh, good question.
Really the market recognition that we moved beyond a chip maker really into a platform company that is driving an ecosystem around it. It's not just the hardware,
Do you understand her
it's the
question?
software, it's the partnerships, it's the full stack capability. I mean, to me, that's really kind of the big change that we saw this year.
And Ben, you say that you don't see any slowdown in demand on the horizon for NVIDIA as it ramps up its Blackwell and Rubin.
I think she was trying to insinuate that NVIDIA really doesn't matter about you anymore. There's better chips than you. Is it true?
You hear frontier lab companies, so
The answer is no.
they don't have enough compute. You've got startups out here in the valley who are fighting for GPUs, hand over fist, and willing to pay premiums for those. So I think there's enough evidence that we're a long way off from compute demand. And as you're continuing to see everybody build out their power capacity in terms of new data centers, and more importantly, new data centers built primarily for AI, which is a new thing that we have not had that before. It's been general purpose data centers.
Very good point.
Compute, and now you're seeing a whole host of data centers built just for AI that are going to be filled with all of these new next generation products and GPUs, not just Blackwell, but Rubin as well, which really changes the dynamic for how much compute we have, and more importantly, the types of models, model quality, and future model trainings that will be built on this new GPU cluster era of AI.
And Dan, as we watch NVIDIA mature in 2026 into more than just a chip maker and evolve into its next stage of evolution here at this stage in the AI cycle, what do you think investors should be watching most closely? What metric matters most here?
Yeah.
Yeah, let's see. I mean, I think Ben hit on the demand side dynamics. I mean, on the supply side, I think they're going to continue to be constrained in the short term, really around wafers, packaging, memory. On the longer term side, I think really power becomes the constraint. And so, we're not really very worried about an AI bubble because we do feel like the demand is just up and down the supply chain, consistent message that it's just far outstripping supply. And we've got supply constraints that will kind of keep a little bit of a lid on the build out for the next several years here. So I think the things you're really looking for is, on the demand side, how are the use cases trending? A lot of what we've seen to date has really been large language model build out for generative AI. There's a lot of other different types of models to allow a lot of different other types of use cases. I really feel like physical AI, those seeds got planted in a big way this year by NVIDIA, thinking about the robotics trend, and I think that's going to be, really a second half of the decade, kind of second wave, second winds to the AI cycle. I think we're going to continue to look for how those partnerships are maturing. You've seen some really interesting partnerships, both across the neoclouds, the hyperscalers, more recently with Synopsys and around, EDA. I think the ecosystem is getting kind of far and deep. You see a lot of NVIDIA's free cash flow going into private markets investing, public markets investing, in really kind of building, kind of the next generation of companies that are going to take these LLM, kind of advanced wave applications and really take them into a new place.
And Ben, last question's coming to you here. If we're having the same conversation at the same time next year, is NVIDIA's dominance still intact, or do you think it will have started to crack?
Yeah, I mean, we're going to be in the same conversation next year. I mean, I think if you just look at the sheer size of the TAM expansion that's coming because of this AI accelerator, you've got, these little mini super cycles across memory, across wafer equipment, across storage, across GPUs. Like I'm calling it a gigacycle, which is far bigger than just a super cycle.
Well, Marley, if we're having the same conversation next quarter, next year, that means the video wins.
$600 and $800 billion for accelerators by the end of this decade, which is much larger than it is today. So one, there's just a lot of room for growth for everybody. There will be some pockets of competition. I mean, obviously, the hyperscalers doing what they're doing.
Good answer.
Is fine. But that doesn't really change the shape of the demand for a general purpose compute platform, which is the GPU, in light of that large TAM expansion. So I'm not sure much changes next year. I think we're going to be in the same part of cyclical part of this cycle where you've got a tremendous amount of demand outstripping supply, and I think, like I said, we'll be pretty much
now we're at $3.70.
Appreciate you both being with us to talk about NVIDIA, a year that was trading up more than 36% higher so far year to date. That's Ben Barron, CEO and Principal Analyst at Creative Strategies, and Dan O'Brien, the President of Future Room. I want to thank you all for joining us today on Trading 360 as well. I'm Marley Katie. You can download our free Schwab Network app in the Apple App Store and tune in 24/7 on SchwabNetwork.com. Fast Market, the Dining Hall.
If you get 380.
Schwab Bank Investor
Boom.
Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years.
We don't know how he does it.
Investor Checking, you get the award-winning features of our checking account. Plus,
He made it
cash
for
benefit
$4.
solutions, all
Can you
designed for investors
bring in
like you,
Fred
with
Johnson
unlimited ATM fee
for
rebates
double top?
cash withdrawals worldwide. No overdraft.
Inverse head and shoulders, head and shoulders.
To keep your money safe. Also,
We got head and shoulders here.
is linked to
Double
your
top.
brokerage account. You can manage your checking and investing in one convenient location.
6880.
Cash moved to your brokerage account is available.
The SPX.
That means you can stop waiting and start investing in stocks, bonds, money market funds,
Okay.
and get more with Schwab Bank Investor Checking, the checking account built for investors.
There you go. Just like that. And the video's pulling back.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
I'm going to double top on SPY.
Get inside the
Double
minds
top
of
on the
those traders.
The point is that they're getting
Double top
higher
on
rate of change in sales based on
IWM
the same rate of change on EPS.
and the 200
Headlines, live analysis, breaking news, and sharp
on the
trade
QQQ.
ideas minute by minute.
With shows built for action,
We're now at $4.10. Is anybody in this trade with Bobo? Say yes or no. Anybody in it? Say yes or no. That's what I did to him, Randy. Anybody in it? Yes or no? Okay. Well, you know what I do when I make business decisions? I go $4.90 freaking cents. Are you serious? And all-time high, $4.60. And you're at 130. What do you mean? Woo! $4.70. Damn Jim. I can't believe this. I'll be right back. I'm gonna go warm my coffee up. We're at 470. I should make business decision. That's how you do it. Want 'em? 2 bits, freebie. Want 'em? 2 bits, freebis, and Forbes. Beautiful. I mean, it's really beautiful. $4.60. Look how beautiful that is. I always wondered why Granny said, Jim, how come, why is it you don't learn how to count to 3? $4.90. 1, 2 bits, and a freebie. One, 2 bits, and a freebie. I know how I felt when that was down there. I felt like not again. No. Because I was green. I said, well, screw it. I can count to 3. Boom.
It's gold hitting record highs, silver hitting record highs. It's oil up 2.3%. So this isn't a stock-based story about the markets.
It's a Trump story.
More of a momentum. All this, capital on the sidelines going into risk-on trading, whether it is Bitcoin, whether it is equities. So you've got to take that into consideration.
Where is PLTR?
That's hard to fight against, especially when there's not a lot of potential catalysts that might derail the momentum to the upside here. I think that's the key. And as Kevin mentioned, most of the gains in December are late, right? The last week or two, and we're getting into that arena now in this holiday shortened week that's kicking off in positive territory today.
Again.
Okay, so the Grinch is out of here. Kevin, when you look across markets, what's your take?
I think the broad-based market rally that we're having right now is indicative of a holiday market, spurred by a little bit of good news. A little bit of good news in Oracle, a little bit of good news in NVIDIA. I think that's enough
to move the
overall markets higher. Remember, Tom mentioned no earnings. All the delayed is delayed. I don't know if it's even going to mean anything.
Probably not.
We don't have a lot of economic data. We have virtually no earnings. And so now we're tied to, number one, the headlines and the drift, right? Rallies are going to kind of run out of gas on the upside. Like you see, we're up here, we're a bit stalled now at these levels. But holiday markets it's a double-edged sword, right? People are taking off, eyeballs are going off the market, but the machines still watch. The machines still read news and economic data, and that they still move the markets with high-frequency trading. So the question is, how much does it move, right? You can still get good-sized moves during these markets, or during these holiday weeks. It's just not heavy volume. Like I said, I think one of the big news stories today, other than the headlines we're getting from stocks, look at the VIX below 14.5. They're taking almost a week, days of volatility out of some of these index products. So we got to watch that, because the further you get out, the VIX kind of recovers back up to reasonable levels. So buying implied volatility short term at these levels, it's just, you may not get the move that you're looking for. So I think there's a lot of things going on, but welcome to holiday markets, Diane. It's kind of a different animal than a market where a lot of eyeballs are watching.
Yeah, it's not fully thin on the floor today, but it's getting more thin compared to last week. Let's talk about the move in NVIDIA. Those shares gaining ground today. You mentioned headlines, Kevin. There's a Reuters report saying that NVIDIA plans to start shipping its H200 chips to China by February of next year. Obviously, to me, the market's reading this as a tailwind. Tom, what's your take?
Well, this is just going to be a bonus for NVIDIA, because all their data doesn't have any revenue based on chip sales to China, because those have been restricted. So this is definitely going to be a benefit. Remember, just last week, the stock was trading around $170 a share. We're trading above 183 right now, so we've seen a nice bounce, up about 3.6% so far for the month of December. So, if they're able to sell these chips, the Chinese government maybe pulls back from some of their anti-rhetoric about U.S. companies selling chips into China. If they kind of pass that and they actually get more orders, it's going to be a small order to start with in February. That would be helpful at this point. But then you start looking at valuations on NVIDIA, forward PE around the 30 level. I mean, it's actually cheap compared to what it's been over the last couple of years, since May of 2023, when this whole AI expansion started for NVIDIA. So if you look at it on a valuation basis, and everybody keeps on talking about an AI bubble, right? Or how to monetize AI. Well, NVIDIA's already monetizing AI, and they've got backlogs of orders for this year, for next year, into the Rubin cycle, and they continue to out-innovate all their competitors in here. So I don't think any demand is going away. Justin Wong, the CEO, continually states that. And when you've got a fair valuation compared to maybe some other names in the tech space that are still above them as far as a valuation, I think everybody's just waiting for that shoe to drop where, orders start coming in a little bit or margins start to shrink. But right now, that's just not happening.
All right, Kevin, you called this earlier. You said NVIDIA was going to move higher today. What's your take when you look across this?
Yeah, I think you got some key levels here. Remember, this stock traded over $210. The highs are just over 212 actually. So with good news coming out, with extra revenue and earnings coming from potential sales to China, you've got NVIDIA that could easily, the 50-day moving average is 165.66. Watch that price. If it closes above there, it could turn this thing loose towards $200 as long as the news flow stays positive. And today's news flow, fairly positive on NVIDIA. So remember, early in January, and we're going to talk about this in the next little piece here. This Consumer Electronics Show, CES in Las Vegas, that could be a big deal this year. And it's January 6th through the 9th. So watch out for that. NVIDIA's going to be there as well. So I think there's a couple things on the calendar that could be real catalysts for NVIDIA to get back over $200, Diane.
Maybe we should get the bosses to send us to CES and do fast market from there. But you got Marvell getting some love today from Citigroup. Speaking of that, it's Citigroup's adding Marvell to its 30-day catalyst watch list. They're citing the upcoming Consumer Electronics Show, CES. Citi also thinks those concerns about competition are overblown. Marvell's been an underperformer this year. Tom, what's your take?
Yeah, down about 33% from those all-time highs that we saw in January. Remember, this past earnings quarter, just a couple weeks ago, the stock popped on the results and then immediately came down, and a lot of that is based on competition. Did they lose an XPU customer to the ASICs, the ASIC competitor for its next generation platform? Did they lose that? Well, Marvell seems to be coming out, and a lot of the analysts are coming out saying they're not going to. And part of that, conjecture that the stock's gone through and the volatility is based on that. Is it Amazon with their Trainium 3 that's coming out that's going to start beating back on some of these rivals, whether it's Broadcom, whether it's Marvell? And then you've got Google with the, with their TPUs, the specialized type of chips. But if you read the note on this one, they're going to go to the CES. They're going to talk. Marvell's supposed to meet with management there. Increased conviction that Marvell will see accelerating sales growth in 2026, 2027, driven by those artificial intelligence data center build-outs that we're talking about. But you know what? This isn't a stock for the meat just because the news flow is positively and negatively affected the stock over the last year. And it just is really choppy trade. But at least for the next 30 days, the Citigroup analyst likes it.
That's a good point. Kevin, when you look across Marvell, and especially the competitive landscape as well, which Citi thinks that, right now it's overblown recently, I should say. What's your thought?
Yeah, they think the sell-off post-earnings is overdone. And like I said, the key part of this story about Marvell stock is the fact that they're going to be at the CES and some really positive catalysts could come out of that. So watch that. Remember, this stock, right after earnings where they had a really nice beat, was as high as, between $102 and $97. It's now $85. So it's down substantially. You can see it on the chart from post-earnings. So yeah, if the problems that everyone's forecasting aren't true and they call them misguided, then this stock is probably on the cheap side. I don't know that, right? We'll see how it plays out, but there could be a big catalyst to this market with news coming out of CES in January 6th to 9th. That could really drive the market, Diane.
Okay, and speaking of some headlines swirling and driving things, You've got this Game of Thrones over who gets to own Warner Brothers Discovery. It is not done yet. Paramount's back at the table. It's got an amended offer. Shares of Netflix are lower today, down 1%. Tom, what's your take about this, chess match that is showing up here?
Chess match, soap opera, you call it what you want. It's getting exhausting here as far as the news flow on this. But hey, remember,
that's cool.
Just last week, Warner Brothers Discovery came out, they had interviews, and they basically stated that, hey, we got no conviction from Larry Ellison. That was one of the big thorns in the side why the board recommended they go with the Netflix portion of the buyout, was the fact that they didn't have any assurances that this all-cash deal was going to be backed up. And they were basically hinting at Larry Ellison. Well, he came out in this amended 14D9 filing that they put out on the 17th that basically says, hey, $40.4 billion of the equity financing for the offer and any damages claims against Paramount. He's agreed not to revoke the Ellison family trust. And then they also raised the breakup fee, the reverse termination fee, from $5 billion to $5.8 billion. And they're going directly to the shareholders on this as opposed to the board, because it's a head scratcher to me, guys. I'm not sure if you guys have an opinion on this, but Paramount, Skydance is going to buy the entire company, right? And not just the streaming side of the business. And there's something going on behind the scenes that we're not seeing or not hearing where, hey, here's a better bid, it's all cash, now you've got the backing of Larry Ellison. Why are they pushing the Netflix bid as opposed to the Paramount Skydance bid? And eventually this soap opera will continue. We'll get more clarity on it.
That's a good point there. I know that I had watched an interview with David Ellison on CNBC. One of the things that I know that he was frustrated with is because initially they got no answer, no response. So I think there are personal egos that come into play here as well. And so, when the answer, they're essentially, to me, just not taking no for an answer. So it's okay, well, we've got now the personal guarantee from Larry Ellison, according to reports. To me, it's a lot of gamesmanship, and I think you're right calling it like a soap opera. Kevin, what's your take?
To put it in layman's terms for our viewers, I think this is a young man going out to buy a new car, and it doesn't get approved till Dad co-signs the loan. And I think that's what they were looking at here. We like you, David. Is your dad around? Can we talk to him about this? And now Larry Ellison has stepped up, put $40.4 billion, including the Ellison Family Trust, and it's got $250 billion in it. I think it's a whole new game now, frankly, because of that. The biggest worries were the Ellison family wasn't personally behind it. They are now. He co-signed the loan, Diane. I think that's what this whole thing is. I think it's a game changer.
What an analogy. That's a mic drop moment right there, Kevin. All right, you got us. That's you. We concede. Love that analogy. All right, we got Bull versus Bear coming up. The guys get their example traits put together for Microsoft. Longtime AI bull Dan Ives says the street will be surprised by the tech titan in 2026. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. There's Microsoft up double digits this year, but the stock is not at the top of the leaderboard within the Max 7. Notorious AI bull Dan Ives of Webbush says expect a bigger growth story in 2026. Ives says the street is underestimating the Azure growth story and the AI-driven shift set to happen in Redmond. Ives says that makes Microsoft one of Webbush's favorite large-cap tech names to own over the coming year. Webbush has a $625 price target on the stock over the next 12 months. All right, time now for the tug of war on Microsoft. For that, let's welcome back in our co-hosts, Tom White and Kevin Hings. It is bull versus bear time. Before we get to your example trades, you got to get your thoughts on Microsoft. Kevin, I'll start with you. I don't know if you have the mic drop moment for Microsoft here, but take it away.
2 quarters ago.
Yeah.
2 quarters ago, when Microsoft came out with earnings that hit the high of 555, you can make a case. It's down $70 from that level with a lot more earnings. Their last earnings, stock sold off after earnings pretty hard. Down to where it is now. Dan Ives now coming out pounding the table on Microsoft. Why?
Upset, huh?
Because like all the key players in this, they have, just like Amazon, just like all these companies, they have so many good working businesses. And Azure is becoming a dominant player in cloud. And they keep remember, they were one of the first ones to invest in ChatGPT and OpenAI, and they were one of the first ones to invest in energy. That's going to be the need going forward. So I think Microsoft in general is an underappreciated name because they are the first movers in so many of these key areas. They always seem to be ahead of the curve. Stock's not getting any love now, but Dan Ives, this was a table-pounding report from him.
It is. When you look through that, he says that he believes the stock is yet to price in what they view as the next wave of cloud and AI growth. He talks about the strong competitive cloud edge that they see in the installed base and talks about some recent partner checks. Tom, what's your take?
Well, I think you take a look at the growth rate in cloud, right? And I think that's what he was focused on in his commentary was the cloud growth is still there. They're outpacing, as far as the big leader in this space, AWS. They had nearly 30% growth in cloud last quarter. I think a lot of the concerns have been based around investments, right? And that CapEx spend, they continue to ramp that up. Now, we talked about the investment into OpenAI. And it was over $13 billion. Right now they own about 27% stake in OpenAI according to that $500 billion valuation. And that's worth something now. So that's, money on the bottom line for them at this point, because that was a lot of the uncertainty, a year ago was like they keep plowing money into OpenAI, but we don't know how they're monetizing that. 90% of the Fortune 500 companies are using Copilot, their AI chat engine on their Microsoft Windows and stuff like that. So there's areas where Microsoft is still probably going to be able to monetize AI. I think one of the biggest concerns for investors recently has been the fact that when you look at the CapEx spend, is that going to equate to further growth and margin expansion? And I think Dan Ives believes it is, and if they can keep these growth rates going as far as cloud computing goes, they can keep digging into that big lead that AWS has.
Let's get into the example trades. Kevin, why don't we start out with your approach?
Yeah.
Yeah, so if you notice,
No, I
the
didn't.
200-day moving average on Microsoft is about $10, $10.50 below where it's trading right now.
Oh,
so
it
what
is?
I looked at for a trade over the holidays is very short term, only going out to the January 2nd expiration, and I just set my short put vertical, my bullish to neutral short put vertical right at that strike. I sold the January 2nd 475 put, and then I bought the 465 put. Now, I realize, like everyone, that Microsoft spent the early part of the year below its 200-day moving average, so it can trade below there. So I'm defined as I always am, but I'm making a paper money trade right around that 200-day moving average, selling the 475, 465 put vertical, Tom, collecting about 130 credit. I think it's trading about 125 now, so it's really close to that. Dan Ives, note today, stock not moving at all, Tom.
Yeah, it's basically flat on the session. We're at 485 level, but let's break this one down because Kevin used technicals and I use technicals in my example trade, so we'll get to that one in a bit. But going out to the January 2nd weekly options, so just 11 days to expiration, really short-term positioning, selling the 475 put right at that 200-day moving average, and then buying the 465 put short $10 wide neutral to bullish. Put vertical, you're collecting roughly about $1.30 credit. That's what you can make, $130 with $870 in risk. You got a lot of risk on this one, but it still is risk defined. You know exactly what your downside is going into this position. If you collect that $1.30 credit, takes your break even down to $473.70 over the next basically week and a half, nearly 2 weeks on this short put vertical. Using that those technicals as a base case for this, where you think the stock might have further support, because if you look at the chart, the 200-day moving average has held for the last basically a month, since that steep downturn in the middle of November. So it's held there firm on this neutral to bullish put vertical. You're just risking a lot. That short 475 put, about a 76% probability of finishing out of the money at expiration over the next 11 days. So there's the neutral to bullish stance. I flipped it, and same type of concept, but I went neutral to bearish and used an out of the money call vertical here, Kevin, to give myself some exposure to the downside here. Even if the stock consolidates, you can still be profitable, or even goes a little bit higher. But I went out to the January 9th monthly option or weekly options, Kevin. So I've given myself an extra week in this position, basically 18 days until expiration.
We can catch it off to 9.
50-day simple moving average, Kev, which is right about that $500 level.
Yeah.
And that might act as an area of resistance, which it had earlier in November. So, but I did make some changes compared to what you did. You did a short $10 wide neutral bullish put vertical. I'm selling the 500 strike call in the January 9th options, buying the 505 strike calls. So just a $5 wide short call vertical, collecting roughly about $1.15 credit on it. That's about where it's trading. That's what you can make, $115 on this one. But your risk is $385 on this one because it's only a short $5 wide neutral to bullish call vertical on here. Neutral to bearish, excuse me. Now, your break even if you collect $1.15, going to be 501.15 to the upside on that one. And my probability of finishing out of the money on that 500 strike where you don't want it to go above, basically about 75%. So equivalent to about Kevin's, but Kev, this one's got an extra week in it, but I'm still using technicals like you did.
Yeah.
Yep.
Yeah, I mean, frankly, Tom, this stock hasn't moved a lot lately,
Nope.
if you look. It's been relatively in a tight range. Now, Ben Watson will tell you that eventually that's going to break out one way or the other. We just don't know which way. But right now, we're both playing for a limited move. Mine on the downside, Tom's on the upside, Diane.
Oh.
Okay.
Low blow.
Comment on that?
Oh, no, I mean, I think it's a good point that Kevin made because the stock has consolidated between that 200-day moving average on the downside around that 475 level and the 500 level on the 50-day moving average. So both of these trades want some consolidation Both of these trades could potentially be profitable, Diane. One's got an extra week in it, the short call vertical.
I think Kevin made a great point, though, about not a lot of movement around it after this note from Ives, and I wonder if that's because, I mean, maybe investors may be numb to the being a long-time AI bull, especially. All right, good stuff, guys. We've got cash checks coming up. The team from Lightfolio will be along with new sentiment data on Tesla. That's talking on the move higher today off the back of
interesting.
the latest with regard to Elon Musk's pay package. Stay right here on Schwab Network. Fast Market will be right back.
It's kind of funny. Woo! Fire and Schwab.
Hi, I'm Alex.
I'm Dean. And I'm his mom.
Oh, God, mother.
Same goes for where you invest.
My first chance in months.
I'm Sam Lattis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
My mother.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical
SPX is back at the
options,
orb.
futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Kevin Hinks over at the SIBO. Time now for our Cash Tag segment. For that, we want to bring in our next guest, and that is Andy Swan, co-founder of Lightfolio, taking a look at Tesla today. So Andy, it looks like Elon Musk is back in the driver's seat. The way shares are moving today off the back of this, the news with regard to the Delaware court reinstating his pay package. When you look across some of the data that you all have compiled, what does the what does Tesla look like? The landscape for Tesla look like?
Yeah, it continues to look like a binary bet, just like it's been for the past 5 or 6 years, and that bet's been paying off. I think Elon Musk in the driver's seat, as you put it, so aptly, is a great sign for Tesla. Everybody's betting on this company to be more than a car company, and that's really what this comes down to. If you believe Tesla is just an EV, just a car company, then it's wildly overvalued. But if you believe that Tesla is an AI and robotics company with autonomous driving on the horizon, then it could be wildly undervalued. So that's the binary bet that investors are faced with. When we look at Lightfolio data, everything points to continued dominance out of Tesla into the future. They have the biggest vision probably of any company in the world, and they have a history of executing not on time, but in time, and in a very big way. When you look at Tesla autonomous driving, full self-driving data, it is safer than people driving themselves. It's safer than Tesla's normal safety features simply being on. And so when you look into the future, you can very easily see a future where it is not only cheaper, but also safer to ride in a Tesla vehicle than anything else. And when it comes down to, the finances and safety, I think most people will pick those two options rather than
legacy automakers. And so we think Tesla could be still significantly undervalued even at these price levels.
Andy, the answer to the question, why should Elon Musk watch Fast Market on the Schwab Network, is because of the data that you're putting out today. And I want to focus on the safety data, right? If Tesla itself was putting out these data points like Folio is, I think the world would understand that automated driving is safer than humans driving. And your numbers really show that. I mean, it's double in terms of the next metric. It's incredible to me. It's eye-opening how much safer full self-driving is than a human being making decisions. And your data that shows that, as well as the other things that Tesla has going on. One of the big parts of the auto, the EV part, is the safety. People, their fears, it's the safety. And your data shows that it's not worse, it's way better, Andy.
Oh yeah, it's phenomenally better, and it's amazing to me that Tesla at this point really hasn't gotten onto the mountaintop and screamed this out. They barely do any marketing at all. Almost everything that they get is word of mouth.
Yep.
That's very effective to a point, but when you're trying to change the narrative of what this is all about, and is Tesla just an EV company? Can self-driving really be safer? Unless you've ridden in a Tesla for hundreds of miles that's driving you around like I have, there's really no way to drive that home. The stats are incredible. I wish Tesla would get out in front of this and start, like I said, really marketing this angle as Tesla as the safety vehicle. When I think about my parents or my kids driving around, either one, at some point, safety is the number one driver of decision making in terms of which automobile to purchase. And if you can show people that by pressing a button and letting 8 cameras and an AI ecosystem built into the car drive you around is 2 times, 4 times, 6 times safer than you driving yourself, that's a decision maker difference. And I think that's what takes Tesla over the finish line in 2026 and 2027. It's just a better way to get around. And Elon's proving it out in terms of execution. I think now it's time for the messaging to take hold.
So Andy, let me ask you this, speaking of the messaging, so when the outage happened out on the West Coast that affected Waymo vehicles, Elon Musk obviously was on Twitter X, basically pointing out that Tesla's robo-taxis were unaffected. But I want to also go back to the point that you made earlier where you said not on time, but in time, because that's been one of the challenges with Tesla. Yes, Elon Musk is a visionary, but sometimes he gives these targets that are just they're unattainable in terms of the timeline. How much does that matter in terms of, the recent tailwind or continuation of the tailwind for Tesla into 2026, just hitting those timelines?
Yeah, I think if you've been around long enough, and most of Wall Street and most of the investors in Tesla stock have been at this point, you understand that when Elon Musk puts out a target date, he's putting out something to push his team, push himself, and push the world towards his vision. And invariably, it doesn't happen in time, but it does happen. It does happen eventually, and it does change the world. And I think that's it. That's just a big difference between how we tend to look at stocks that make promises or give guidance for the next quarter, and we're doing that every 90 days for a lot of these companies, and they're sweating whether or not they're going to make their number to the penny. It's a very different ballgame with Tesla. You're in it. I think you're in it again for a binary bet that this could be wildly overvalued and totally flop, or if you're a believer, you're in it for several years, if not decades, because you think this is a company that can change the world and that can benefit its shareholders tremendously by doing so. So that's the whole thing with Elon Musk. It's we take him seriously, but maybe not literally. And so I think when short sellers, the Tesla Q crowd likes to take him literally, but not seriously. That's when they get into trouble. It's clearly got to be Elon gets the benefit of the doubt because eventually he delivers game-changing, world-changing technologies and products.
And I got one more quick question for you, but Diane, I think we just had our second mic drop. Tesla, not on time, but in time. I think that's the new theme that Tesla has going forward. But Andy, Diane mentioned the Waymo issues over the weekend in San Francisco. And what came out from this on the Tesla side was that they, Waymo reads a down stoplight or a blank stoplight as a four-way stop, and it does its best to navigate the traffic. Tesla measures eyeballs and inflections of drivers and allows it to greatly overachieve. Remember, the one key thing that I think is going to come out over time, Andy, and I want your thoughts on this. Tesla is not Waymo. It's two different technologies driving these companies, and Tesla, though they may be slower coming out than Waymo, is clearly the superior technology here, Andy. Your thoughts?
Yeah, no, I agree. I think the biggest thing is that Waymo is trying to create the perfect car for a perfect world. And so they need everything to be mapped out. They need, the LiDAR system to be functioning. They need the power grid to be on in the city. Whereas Tesla is trying to replace the human driver with a superior human-like driver. And so what that does is it makes Tesla vehicles behave like a really, really smart, very good human driver would. And so other cars on the road are much more likely to understand what the Tesla's doing, to react to it as they would a human driver. It just happens to have 8 cameras looking in all directions, 360 degrees, and computing every single thing it sees in real time with an AI super chip inside rather than a human brain that might be distracted. So that's where the benefit of Tesla full self-driving comes in, is that it's building towards the future of this car runs as if the world's greatest team of human drivers is driving it, no matter what else is going on in the outside world. And you could plunk it down in the middle of nowhere, and it understands what a road is, what a sign is, and what other drivers are doing.
All right, thank you, Andy. We'll leave our conversation there for today. That's Andy Swan, co-founder of Lightfolio. All right, let's bring in Tom White back into our conversation for some final thoughts on Tesla before you guys get into the example trade. So Tom, you heard the latest data that they brought on Tesla, and one of the points that Andy made was that, in terms of execution, it may not be on time, but it's in time. What's your take?
Yeah, I think, that's been a lot of the issues and the bifurcation that we've seen in this stock. You either love it or you don't, and analyst community is the same way. I mean, there's Wells Fargo guys with $120 price target on it. There's price targets under $50, and then you've got price targets of $500, $510. UBS just came out with a note, and they said that Q4 deliveries are going to be below their anticipated expectations, down to 415,000 from the prior 429 in their view, as EV sales continue to contract. That's not a positive, but at the same time, as Andy mentioned, this thing is not priced on the EV portion of its business at all. It's priced on what's going to come in the future, FSD, and the humanoid robot. So you have to take that into consideration. But Kevin, you look at this stock, $495 a share, hit record highs recently. How do you want to look at this one from an example trade? I think the key thing here is you better know your downside, whichever way you go on a trade like on a name like Tesla.
Yeah, I looked at something in the calendar spread family, Tom, as if you look at the implied volatility, they are down to extremely low levels. On today's option stance page, their current IV percentile is a 7%. That drives me. That means my strategy is going to be something in the calendar family, Tom. So what I looked at is pretty simple. Only went out 3 weeks, bought the January 9th 510 call, sold this 510 call, just a $15 above the market call calendar. That's inside the expected move. It's trading about $11. It's trading about 1140 now, as it's done nothing but rally throughout the daytime. But this one gives you a chance to extend duration into that January or the January 2nd expiration, which will really chip away at that net debit, Tom.
Yeah, let's break this one down. 2-week wide bullish call calendar. Going out to the January 9th weekly options that expire in 18 days. Buy the 510 call. That's where you want it to go. And then sell that same 510 call in the near term December 26th weekly options that expire in just 4 days here. Pay an $11 debit. Trading a little bit higher than that, but the debit you pay is going to be your risk. So if you pay $11, $1,100 per spread. I think the key here, as Kevin mentioned, you want it to go at or near 510, but you've got a range probably between about 492 on the downside and possibly up to 530 on the upside to potentially remain profitable on this trade. And as Kevin mentioned, as you get closer to expiration over the next 4 days into the end of the week, you have that opportunity or potential to roll that short option one time, collecting pretty big credits on those. At the money credits right now for the first week are over $7 at this point at the money rolls. So that could take away a lot of the risk on this type of trade. But the idea here is positive time decay or theta on this one. As you get closer to the end of the week this week, you have that potential to either close or roll that trade if the market's open, creating credits on it, decreasing risk, or just closing it if it starts to expand in price. And Kevin mentioned that IV percentile rank at 7%. What does that mean? Well, over the last 52 weeks, we're in the bottom 7% of where implied volatility levels have been. So lower implied volatility when you initiate a trade like this means the cost of it and the risk of the trade is going to be lower in a low volatility environment on this type of trade, Diane. But kind of sets up with Lightfolio's data here, giving you some upside exposure in Tesla over the next few weeks.
All right, good stuff, guys. Thank you. Coming up, we've got the breakdown. We are taking a look at Oracle today. Wells Fargo staying bullish despite the recent sell-off. The shares are higher today. We'll be right back.
Whoops. Right, moving a little bit. Boom. Profit takers. Unless they'll run. Bad for me for not paying attention. Shit. Shoot. Shramra. He's watching it.
Raised their Tesla price target to $500 a share. So not as optimistic as Wedbush's Dan Ives, who I believe had that $600 price target. But still, even with a negative headline story from Deutsche Bank, the news is still that they raised their price target. So goes to show the appetite feels like has swung a bit with the momentum we've seen in shares. So I completely agree with you there. And actually, Tesla's story somewhat ties into the Alphabet Waymo story we saw over the weekend, as we did hear from Tesla's CEO Elon Musk, of course, posting on social media platform X saying that their robo-taxis were unaffected by some of the power outages that did, of course, impact Waymo. So walk us through that story.
Yeah, Jamie, I'm not sure if you've seen the movie Leave the World Behind. It's on Netflix, I believe, or it came out a couple of years ago, but it's kind of crazy because they had a situation where these self-driving vehicles were kind of driving themselves and then creating traffic jams, and it seems like exactly what San Francisco experienced with Waymo. Their driverless service obviously had some issues across San Francisco as power outages kind of impacted the overall region in itself, and you did see a problem when it came to traffic, and this might be one of those concerns when it comes to the self-driving application for a lot of these vehicles, as well as
interesting
within Waymo's operational framework that may need to be addressed. But obviously, this has been a kind of a black eye on the company that has been taking a lot of market share and expanding their market share when it comes to the driverless ride-sharing business here. And maybe this is going to be a short-term setback. Maybe Google Alphabet's going to have to make a couple of adjustments here when it comes to their business. But overall, kind of scary when you think about the impact that these vehicles can actually have on traffic and disrupting overall flow within communities if power goes out.
I mean, especially because it does feel like some of these technology inconsistencies, like we need to be able to say this is fail-proof. This is not something that's going to necessarily then impact an entire fleet of vehicles. I mean, I completely agree when you think about the fact that so many of these vehicles will run on not only just data centers being up to par, but also just power being up to par. We know that the grid is something that remains fairly constrained right now as it stands. So it does raise a lot of questions about the feasibility of rolling these out to other larger cities, which frankly, I'm not saying San Francisco is a small city, but probably part of the reason we haven't seen the full rollout in these huge cities like Chicago, Los Angeles, New York. So the pilots of these types of programs, I think, are hugely important to iron out some of the issues, but it does then, I do think, create a bit of a consumer fear with just the overall reliability of this technology. But our last day of today, a bit of a stray away from the Mag 7 stocks, but Rocket Lab, which is taking off today, no pun intended truly, as we did see they disclosed the successful launching of their 21st Electron rocket of the year, but also just seeing this widespread strength across a lot of these space-focused names. So Kevin, is this all tied to some of the Trump administration, or is this a Rocket Lab specific story?
I think there's a lot of optimism when you're looking at this name. I think, a lot of traders and investors are looking at the space theme for 2026, and it does appear that the Trump administration is obviously putting dollars to work in order to expand space exploration operations, as well as maybe even putting some data centers up there. Rocket Lab appears to be one of the front runners there that could actually capitalize on this space here. What's also kind of very interesting is the stock. I mean, the stock's up, I believe, 50%, if I'm not mistaken, over the last week and a half or so. So it's a smaller cap type of business and type of company. It doesn't take much to move the stock higher, but there's a lot of optimism around the space race just in general, and there's only a couple of names that actually have that exposure. Now let's see how much enthusiasm a lot of these shareholders have, Jenny, next year if SpaceX actually does IPO, but at least for now, this seems like one of the bigger growth companies that a lot of investors and traders do appreciate. And with the lower dollar value, as well as the options positioning that's within this name here, you can kind of make the case why people are optimistic around this company.
I mean, absolutely can. I do think that they still need to fix up their balance sheet, but I know that that's the growing pains of this entire business. But I have seen space specifically called out more and more by analysts as a bullish narrative to watch within the broader AI autonomy push. So I'm excited for that sense. I think that space exploration is fascinating, and we haven't seen our country really ramp up the efforts in so many years that from that perspective it's exciting. It's also a little bit frightening in the same sense, but space definitely what we're watching as we head into, of course, 2026. But so appreciate all of the commentary to help us kick off our show today. Kevin Green, Senior Markets Correspondent for the network. Now, coming up next, we'll be sticking actually with our broader theme of transportation. We'll be diving into two of the ride-hailing names, those being Uber as well as Lyft. Both with some news, and both right now actually seeing some degree of lift from their partnership with Baidu, testing out these driverless taxis now in the UK beginning in 2026.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl,
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
Welcome back to Next Gen Investing. It's now time for our Chart Master. And today we are talking to two of our ride-hailing players, those being Uber as well as Lyft, with, of course, our Chart Master, Rick Ducat. So, Rick, let's start off here, with all things Uber, as we are seeing both of these names benefiting a bit from the partnership with Baidu, an unexpected player. But we've heard, of course, not the first time we've heard basically whisperings and some sort of confirmation that they're expanding these partnerships overseas. But Uber's chart, I know we've pulled back pretty substantially from highs, has been actually fairly resilient this year, and Lyft is the same case as well.
Yes, and for now, we are hanging on near a supportive area. If you were to backtrack a little bit, look at our green line here, 82. That was an old high point here. That was subsequently supportive as well, multiple times, and once again more recently. However, we did break through to the downside during the past couple of weeks here. Now, 77, our lighter green line here, that was a high point repeatedly during this time, and also a supportive point once again. So that would be the area to watch out for to the downside if we do fail to recapture this 82 level. For now, though, we did not actually touch down near that point. So perhaps if the bulls can regroup and push back above 82, we could reassert some kind of upward trend here. For now as well, though, our blue trend line has given way to a steeper, more sharply sloping downward white trend line there, going across our highs. When we do look at our moving averages that we follow, we can see that our 21-day in yellow and our purple 252-day EMA come together right around 85. So that's a notable confluence point here of these two indicators here. That could be a potential stopping point or breakout point if it is breached to the upside. RSI, our measure of momentum, a very mild triangular shape here, gradual trend line going down across those highs. We can also see a bit of bullish divergence here, though. Notice that the RSI was in oversold territory, but during its most recent decline, the momentum indicator here, the RSI, made a higher low while price made a lower low. So that could be a sign that there's some bullishness building up in this name here, that momentum did not look quite as bad as it may have at first. We can also see now our volume profile study shows that this area here that we slipped below near 84 was an important trading area. There's heavy volume there. To the downside, then we also have 74. That one sticks out as well, where things start to pick up once again. But we can see 77 lines up as well with our -2 standard deviation channel. So 2 standard deviations down from our teal linear regression line. That's a relatively extreme point. It lines up with a notable low.
Okay, and all this to be said is, of course, Uber today, we are up about 2.3%, so a pretty strong session to kick off this short trading week, of course. But when you think through now trading Uber for example purposes, how do you think about a name that has been, yes, a pretty nice upswing, but has also experienced some degree of some more modest price activity just as of late?
Right, so if you had a more bullish outlook here for this name and you were looking toward the February 20th expiration, about 60 days out here, you'd be looking at roughly a 13% move plus or minus here. That's our yellow box. So if we had our bullish outlook kind of based on this plus our technical information, one example trade, +1 February 20th, 85.90 call vertical at a 140 debit here. So why did we think about these prices these strikes, well, 85 was our confluence point that we mentioned earlier of our two moving averages, and then 90 is roughly the boundary of the upper edge of our expected move right there. You can see that that's where things start to thin out. That's where the volume starts to increase notably as well. So that would be a point where you might look for price to kind of stall out a little bit. But a bullish trade, max loss 140, our debit paid, max profit 360 here. As I said, 60 days out, you would need a move of about 6.7% to the upside to break even on this one. So well within that expected move.
Okay, yeah, now to shift into our next name, and of course the smaller player in the ride-hailing market, that being Lyft, which is actually making a bit of a stronger bullish move today. We're up about 2.8%. Lyft, I've seen various analysts have different opinions about their role in autonomy, but at least today's move, of course, with the Apollo Go from Baidu is definitely providing a decent, of course, pop and lift, no pun intended, to start off the trading week.
Right, so what we've seen here in Lyft was a bit more of zigzag type price activity between our two boundaries. First, 19 here, you can see this was a low point many times here. 23 was a notable high point, roughly speaking here. That was around where we topped out. We did have earnings produce a breakout that took us to those highs near 25.54, but it was not to be. It did not last. We rather quickly retreated back down to that supportive area here. So we can also see 17 stands out as long as we are looking at our price activity and horizontal levels. That's about where we topped out here, here again, and then it became supported after the breakout to the upside. So another downside level to consider. When we look at our moving averages, the confluence in this case is our two shorter term moving averages. So much like our last chart, we have our two moving averages lining up together. Our 21 and 63-day EMAs come together right around 2050. So that would be another level to keep in mind here. Meanwhile, our purple 252-day comes in near 17. So a bit more emphasis on that level as well. RSI trending lower. We are below the 50 midline, suggesting more of a bearish lean right now, but we are also testing a resistance area in our moving average confluence today. So if we were to push to the upside, the bulls would want to see RSI break above the 50 midline. Our heavy volume areas include 20 right here, that's about where we are right now in the thick of this node right here. And then up here, 22 to 23, this area also stands out as a potential slowdown point if we start to push above our confluence.
Okay, and so would it be fair to say that these names do trade with some similarity? And I know they oftentimes were seen as a target for like a pairs trade, but do you still see that from a technical perspective when you look back at the 2025 price activity?
That would be one way to think about things for sure. They're affected by similar factors. They're very heavily involved in this autonomous driving race here, so there would be many things that could contribute to that. You maybe wish I put a correlation study on so we could actually look at it for sure here. But when we do think about Lyft and Uber, certainly they are not interchangeable here, but intertwined is what I mean to say.
Yeah, and I mean, I think that even just from assessing like their trends this year, you could see that there are some similarities, also some differences though, as Uber has become a much larger, more diversified business. So when we now think through trading Lyft here for example purposes, again, a pretty nice pop though to start off this week for both of these names.
Yeah, so this one here we can see our long-term chart. Lyft has had a pretty severe fall to the downside here, but we can also see the heavy volume accumulation here down at these lower levels near 13 suggests that we have perhaps formed a pretty important lower level here. So if we were to also think of a bullish example trade, in this case we could do +1 January 16th, 20, 23, 24, call butterfly at a 75-cent debit here. So this would be another bullish trade here. Max loss would be our debit paid of $75. Max profit would be if we were to expire at that short strike near 23, that would be the sweet spot. 225 would be the profit there. However, this trade is kind of a little bit different from a conventional butterfly. Instead of having a return to unprofitability at the top edge of the trade here, in this case, we also also include another long 24 strike here to make sure that we don't slip back into unprofitability. The profit would be capped at 125 if we were to expire above 24 here. So this one would need an 11% move to the upside for the expected move here. That's what the options market would be looking for. Break even will be 3.8% to the upside here in this case. So again, well within the potential expected range.
Yeah, and left, of course, again, very similar, but also has very different, somewhat, I think, more cautious tones as we get into the new year, because frankly, they're pushed into autonomy. Yes, well, it could be accretive. It could also then dent their business model, which frankly, it's been a two-horse race between Uber and Lyft for ride-hailing. I guess taxis as well, but they've fairly well disrupted that space. So who knows, we'll be keeping on our radar, of course, as we approach the new year, but appreciate it too, Rick Ducat, our chart master, for all of that technical help. Now coming up next, it's time for FOMO. We'll be discussing Oracle as it starts off this week on a bit of a brighter spot than where we were discussing things last week. Got some favorability from the sell side, as well as Larry Ellison throwing his hat into the latest drama of Paramount, Skydance, and Warner Brothers Discovery.
Very good.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X.
SPY came back and touched 200
Connect with me, Nicole
for
Petalini,
support.
on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of thinkorswim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platform to
The SPX,
with nearly endless
2 to
customization.
235 right now.
Market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trade brilliantly.
Live from Chicago, this is Trading 360. I'm Marley Hayden. We track macro
Marley.
forces, market trends, and company news that shape investor decisions, all with
Perfect.
analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad, I have a question for you.
Oh no.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
Trading at Schwab is powered by Ameritrade, unlocking the power of thinkorswim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Next Gen Investing. It's now time for FOMO, and joining us is Marley Hayden, host for the Schwab Network, to help us break down all of the news on Oracle, as we are seeing this pretty favorable Wells Fargo note here highlighting that they're undervalued. And so Oracle's recent pullback has been notable. Of course, there's been a lot of scrutiny over debt and then that TikTok deal last Friday, but at least seeing some upside from an analyst perspective to start off this week.
Yeah, certainly, and a big move along with it, about 3% right now, so pretty sizable move to the upside on this note from Wells Fargo. They've seen their stock drop sharply. Jenna just hinted at that over the past year, but Wells Fargo says that that is actually the reason that they have renewed optimism in Oracle is because they think this decline has created a buying opportunity here. Their recent struggles have centered around concerns about the AI sector and bubble talk, and also some of its high-profile partnerships, and if they will actually come to fruition, and if they will come to fruition in a way that is profitable. But their recent struggles, have sent shares down. Still, overall year to date, they are up more than 18%. So they are performing in line with the market, but they did give up a lot of their gains that they had made. Speaking specifically to the Wells Fargo note, they are saying that investor sentiment has turned negative recently, which we know with this broader tech pullback, largely due to the uncertainty surrounding the AI trade narrative and competition among the bellwethers. But they think that the market participants are cautious about this exposure to OpenAI and the financing risks of the debt that Jenny just mentioned, but Wells Fargo views that as an encouraging sign and thinks that much of the market is only pricing in negative outcomes while they are, what they say, underestimating potential positive developments here. So they have fallen about 42% from their peak that they hit back in September, so we have seen a pretty sharp move to the downside this fall. But despite that, they're still encouraged, particularly by one of the things you just mentioned, TikTok. They think that the company's latest agreement to manage TikTok's U.S. business is perceived as a catalyst and should be viewed as a catalyst and not something viewed with caution. Oracle was already known to be part of a group of the buyers who will collectively own 45% of TikTok's U.S. operations. RBC Capital also put out a note on Friday saying that they felt that deal could increase revenue for Oracle Cloud infrastructure and also provide some strategic advantages through access to TikTok's data centers. Now, for OpenAI, we've obviously had some unfavorable headlines in terms of Blue Owl with OpenAI and Oracle recently, but projections are showing that this OpenAI partnership with them by fiscal 2018 should contribute about 25 to 30% of Oracle's earnings. So, I mean, that's just 2 years from now.
I mean, that's a pretty substantial amount. And I know that some of the real fears, it seems like, around Oracle's narrative have been more long-term. Like, they're not saying that this is going to be next week. They're saying it's going to be years from now. I mean, to speak to that failed Blue Owl financing deal from Michigan's Stargate Center, that has been an area of skepticism. I was reading also some of the other recent bearish thesis takeaways, like CapEx explosion, cash burn. Oracle's CapEx forecast is surging to $50 billion now for fiscal 2026. So that was up from just $15 billion mid-year, resulting in that negative free cash flow of just about $10 billion in at least the first half of this now upcoming year, and high interest expenses, which could be at around roughly $1 billion per quarter. And per the more bearish skepticism, that's the high end of some of the fears. Their debt load also, they've raised roughly $18 billion in debt. Of course, that right now carrying $80 billion of debt, of long-term debt, and $248 billion in lease commitments over the next 15 to 19 years. But again, these are long-term targets. These are not talking about central concerns that could change the narrative anytime soon. So I do acknowledge the more recent analyst favorability that has said, hey, perhaps these fears are overblown. But I think that one thing is clear, that Oracle is the epicenter of this high-risk, high-reward pivot into AI and cloud, but it's going to be highly costly.
I mean, I think that that's the point that a lot of the coverage is trying to make in some way, is that you have to pay to play. And they are. They're paying. They're paying more than pretty much any company I can, cite right now in terms of how they're being scrutinized for how actively they are participating in this potential AI build-out. But we're also seeing pretty strong moves, like volatile moves, off of any major headline for Oracle. So, I mean, shares dropped about 12% after their earnings, which is an even bigger move than we saw for most of the other big tech names. Whether or not the earnings were favorable, that's still a pretty sizable move. Then we got the reports that Blue Owl, their capital funding had stalled for just this one plant in Michigan. It's not all the plants, it's just this one particular plant. And they say they have other investors, potential investors that they are also in talks with. But just for this one plant, we saw them drop another 6%. So we're seeing a lot of these headline moves, a lot of these very volatile moves in this name, I think in part because they are carrying more debt. They have a much bigger capex than some of the other companies that we're talking about. And you mentioned they went from 15 to 50. I mean, it is a very outsized spend here, but there is always a possibility that that pays off. It's just that I think we're now entering, at least the guests that I've spoken to have said, we want to see it start to pay off in 2026. And so I think that is the thing that could potentially change the narrative for Oracle. If we start to see the spending pay off in some meaningful way, even if it's not big, because like you said, this is a long-term story, if we start to see some sort of payoff that what they're doing is potentially going to work, I think we could see a real pivot.
And I'm surprised, frankly, that we haven't seen that same degree of caution also echoed with names like Microsoft, Alphabet, Meta, who I tend to think of those four being really right now like your CapEx giants, the ones that forecasted such substantial spend without real promise of monetization. And I mean, to Oracle's credit, their backlog right now, which is of course measured by those remaining performance obligations, it has surged to roughly $520 billion. That is up 440% year over year, but that also includes that $300 billion contract with OpenAI. So that could have multi-year revenue visibility. That could actually be a bright spot for Oracle, depending, I guess, how you frame it. But I'm curious your thoughts on like the broad tech analyst space, frankly, as we go into this new year. Do you think that this will be a trend we consistently start to see amongst just the sell side that says, hey, you can show me, you can put up these numbers all day long for CapEx and guidance and push into AI, we're losing our patience with the ability to monetize how quickly that leg of the next component really comes.
I think we're definitely exiting the hype cycle. I mean, we've been in this hype cycle where it was all very excited and it was all very headline driven and there's so much potential. And we're moving away from the potential and now people are going to start demanding performance. Investors want to see performance. And that is going to be the thing that really solidifies who the winners and the losers are going to be here. I was just looking at a report from Morningstar that they released after the TikTok deal was announced, and it's very interesting what you just said here. Their fair value estimate is 277. Right now, Oracle's at 198, so a big upside there. They've got a 4-star rating. They have their moat. They're rating at a wide moat, but their uncertainty rating, which is unique to Morningstar, is very high.
See, and that was very interesting, especially because I know Larry Ellison has been busy. I mean, we hardly even got to some of the news with him, of course, now backing his son's venture into trying this hostile takeover bid for Warner Brothers Discovery. And I'm talking to so many Ellisons today, I'm like mixing them up, but of course, Larry Ellison backing David Ellison's hostile takeover for Warner Brothers Discovery, and what continues to be truly like a Hollywood drama between these entities as they do try to then, basically push out Netflix's bid for Warner Brothers Discovery.
And if that's muddying the water, could also be a question, right? Are there too many Ellisons in the? Are we saying it too much when it's not tied to Oracle? I mean, that is also something that could be considered here. I haven't seen it mentioned in any notes that I've read in the last couple days that any of the sell-side analysts think that there's too much confusion or too much widespread discussion about the family. But we're not. There are also retail investors involved in this, and they look at very news-driven headlines, a lot of them, when they're trading. And so who knows? You just don't know what some of these moves are seeing. Yes, most of it's like tied to the AI trade, but there could be people who just don't like seeing the names floated that regularly.
And I would like to see at least some conclusion to that story so that we don't have to see David Ellison thrown into the mix. I know, and I do not think that we're going to do that anytime soon, at least as we are just right now in very holiday trading for the next several weeks. But hey, Oracle's down 43% from its highs on the back of its last reported earnings. So it's been a volatile several months for Oracle shares, but appreciate it to Marley Caden for all of that insight on what could perhaps be weighing on sentiment, although not today, of course. We're up 3% for Oracle. Now, coming up next, we'll discuss the solar energy outlook and some of the strength we've seen in a lot of these solar equities, actually, as well as gold, silver, a lot of more commodities focused into the end of this year.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out of here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to discuss the latest move we're seeing with Honeywell, which is now down about 1.3% on the session. Joining us now is Dan King Hall, the host of Morning Movers, for some more insight into this guidance cut. So, the one I've gathered, Dan, they have a $470 million FlexJet problem. So, walk us through this update.
Yeah, this is a thorn in the side of Honeywell. And earlier they'd shaken off worries about that, but now shares are under some pressure off the back of this company flagging this one-time legal charge. And with it affecting its outlook, now you have shares under some pressure right now. Honeywell down more than 1% at the moment, extending its year-to-date loss down to more than 7%. On a year-over-year basis, that stock is off by more than 8%, approaching 8.25% right now. Honeywell says they expect to take a roughly $470 million one-time charge in the fourth quarter. It's tied to potential settlements in this long-running litigation it has with FlexJet, the private aviation firm. The company also cutting its full-year profit and revenue guidance. It says it says the legal charge, though, will not impact its non-GAAP earnings. It reaffirmed expectations for underlying organic growth. It's not helping the stock right now. Essentially, it has investors recalibrating their expectations around this. This is again tied to this ongoing legal dispute with FlexJet. FlexJet has said that Honeywell failed to repair aircraft engines on time under a maintenance agreement it had with the company. They're seeking damages for the delays that they say keep adding up each month. Honeywell now taking this multi-million-dollar charge. It's not a recurring problem, so that is one thing to keep in mind, but it is a cleanup of a long-running legal issue that it has. So it's lowered its outlook. Now Honeywell, in terms of its updated numbers, it says full-year adjusted EPS will now be between 970 to 980, which is down from 1060 to 1070. Q4 adjusted EPS, they're projecting that now to be between 248 to 258. That is roughly in line with expectations, but again, it's not helping the stock at the moment. Organic growth, the outlook does stay strong there for organic growth between 6 to 10%, but again, right now, investors focusing on the negative. Jenny?
They are, and I will say that despite some of the revised guidance to the not sounding so positive, I'm actually impressed that we're only down about 1.4% here in real time. So all that to be said, it doesn't seem like the street is giving this too much credit, but I mean, pretty substantial revision for some of their guidance. So we appreciate that, Dan King Hall, for all that breakdown in Honeywell, one of our movers to the downside today, actually in the slew of green. But now to shift gears into the broader energy space, specifically into the world of solar, I'd like to welcome in Max Jackson, Managing Director at Ballast Rock Asset Management. Max, thanks so much for joining us on, of course, this shortened holiday trading week, but solar is where we're focused today. So I want to start off with your broad thoughts here on solar and, of course, its role in the U.S. energy build, which is facing some capacity concerns as we head into the new year.
Yeah, absolutely, and thank you for having me. Moving into 2026, we'll still see solar energy be the dominant new energy added to the grid. It's going to be the majority of new capacity, and that's despite some of the regulatory headwinds that we saw during this year with the One Big Beautiful Bill.
Okay, so how does solar remain competitive, even as tax credits, of course, begin to sunset fully?
Yeah, absolutely. So it really comes down to the core fundamentals. The levelized cost of energy for solar, even unsubsidized, is still the cheapest form of energy that we have. And so, the tax credit sunsetting will create a bit of a ripple in the market, There are safe harbor provisions where projects that are underway will get to, remain eligible under the old regime for tax credits. So you'll have a lot of projects this year still earning tax credits under the old policies, and you'll have some projects toward the end of maybe this year that don't have those credits but are still very strong, fundamentally. And then all of that is driven by demand, right? Like as you said, there's going to be a huge rise in energy demand in the U.S. in this year and in the coming years, largely driven by AI and data centers, as well as electrification of the vehicle fleet.
Okay, and I feel like nuclear has been the star there. And so tell me about the dynamics of solar. I mean, I've heard various things like the mass adoption of solar has been difficult, and I know not necessarily always favorable under the Trump administration. So, I mean, in terms of the energy build, is it one of those spaces where you could see something successful like nuclear energy, continue to build in its own right, then solar is building? Like, we just frankly need the capacity right now, correct?
Yes, we do. We definitely need the capacity. Nuclear is also a great solution, and it's definitely going to be a huge part of the energy mix alongside solar. I mean, looking at just, though, the next, 12 to 24 months, the develop and build timeline for nuclear is significantly longer. I mean, it's probably 5 years at a minimum, and it could be even longer than that to go from an undeveloped plant to a completely functioning nuclear power plant. Solar is much shorter, with timelines as short as, 2 years for smaller plants and maybe 4 years for larger plants, but even that is just a quicker turnaround to meet the need. So nuclear will be a part of it, and a lot of different energy sources have a part to play. And I think it's the timeline piece that puts solar in the forefront this year, and then maybe they'll be more balanced in later years.
Okay, and how will the sunset of some of these solar credits impact the developer margins or, say, project economics? And some of these are more long-term questions, but how do you see that playing out now in 2026?
Yeah, absolutely. So I think that all of the different players in the space will bear the brunt of these sunsetting credits in different ways. So I do think that developer margins will shrink, but there also will be the engineering, procurement, and construction firms will have their margins shrink as well. It currently costs significantly more for equipment, solar equipment, panels, racking, etc., in the U.S. than it does in Europe and other places where the tax credits have already begun to sunset in various ways. So I think you'll see a balancing of prices and cost to build as well. So it's really more of an ecosystem with all the different parties taking little pieces of it, and then the rise in energy prices should offset a lot of that impact throughout the space as well.
Okay, and I know, correct me if I'm wrong, but that Germany is like the solar capital of the world, and I've just been fascinated by their push and their build into solar. Why has the U.S. lagged some of these European counterparts? Is it just like a lack of need to develop? Well, right now we obviously do have that need that is clearly evidenced by the capacity that's needed for AI, frankly.
Yeah, so, I think that some of the lagging relative to competing nations is a bit due to some of the politicism of it. I think the politicism of solar is unnecessary, and having it be mixed into that has created more head-to-head that creates kind of a ripple effect that we're not seeing in some of the other European nations, but it comes down to the fundamentals economically are really strong, and they're there. And so that's going to continue to move forward. But, I think with some of the politicism, that just creates more uncertainty that is definitely not, critical, but, it could be streamlined to improve deployment of all energy, not just solar, but all the different supply that we need.
I was going to say, I feel like that statement could also be applied to the vast energy, even just the broad economic world, frankly, where things are politicized that perhaps shouldn't be. But really quickly before we let you go, what regions do you see being the most critical in some of this deployment? As, we again see a different tax environment, but also a very different energy environment I'm sure we'll be witnessing now in real time into the new year and into the long term.
Yeah, absolutely. And so this kind of does all tie together. One, there's a national demand, but as the credits start to sunset, you will see solar being focused in areas that have a more favorable weather environment with higher irradiance. I do think that the existing credits breed solar in certain areas that are not the perfect fit. Really far north and the Northeast are not the perfect fit energy-wise, but all through the Midwest, the South, the Mid-Atlantic, California, of course, has been a front runner in solar for a long time. The majority of the United States still will have solar as the cheapest source of energy today. And so I think you'll see a little bit of shifting, and that's driven a lot by the credits going away. But on a national level, you should still see the aggregate amount of solar to grow.
Yeah, and I'm excited to watch how this further develops in real time, because there's a lot of the energy bill that needs to, of course, occur for some of these massive AI projects that are just thrown out there without, I mean, any real energy backing, any grid reforming. So it's going to be an interesting environment to watch, I'm sure, as we head into 2026. But so appreciate it for all that breakdown on what is a critical part of the alternative energy story, and that's solar. Max Jackson, Managing Director at Ballast Rock Asset Management. Now coming up next, last but not least, it's time for Under 30, and we are discussing some further details on that Paramount Skydance bid for Warner Brothers Discovery, and now being fully backed by the Ellison families we've discussed throughout the show. But we'll dive more into those details coming up next.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets, with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Okie dokie.
Welcome back to Next Gen Investing. It's now time to discuss the latest with Paramount Skydance, and of course, it's hostile takeover for Warner Brothers Discovery. But here to bring some more clarity on that story is George Tellis, senior markets correspondent for the network.
You've seen nothing
and
yet.
so, George, as far as I was concerned, reading the story today, nothing has really changed about the process. The Warner Brothers.
Okay, they're still into that. Prepare ye, we're almost there. 200 EMA, 6871. So Washboardjim, where is it? 68.80s. Written out 120 and are 5. Mm-mm. It's like that. There's the 9 and the 63 and the 21. Or the 200. That's the 200 right there. Oh, uh-oh. It's like that.
trusted financial journal.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Uh-oh. Well, it is now 1:01 here in Missouri, which means it's 2 o'clock. Up more hours. Kind of see how the market's behaving. Uh-huh. Very tempting.
Hitting a new 52-week high today. Among the stories is the Musk pay package. Tell me a little bit about that.
Hello, Nicole. Yeah, you know, Elon Musk, a lot of headlines about the $1 trillion pay package that he's got in store for him going forward. However, a Delaware Supreme Court just reinstated his $56 billion pay package from 2018. Here's what the court said. We reverse the Court of Chancery's recession remedy and award $1 in nominal damages. The judge wrote in their opinion. In the decision, the Delaware Supreme Court judge said a lower court's decision to cancel Musk's 2018 pay plan was too extreme a remedy, and that the lower court did not give Tesla a chance to say what fair compensation ought to be. So the pay package from 2018 that Elon Musk has been fighting about, this should end the discussion, and it's reinstated of about $56 billion.
Understood. What about, look, I mean, it's been an incredible story. We had all
Very understood.
Some good news on Tesla. It's hitting highs. You've had Dan Ives. You've had so many people excited about the robo-taxi story. Also,
I understand.
IPO coming. A lot of people who just believe in Elon Musk, period. So, an interesting story and some highs today on Tesla. How about we get to Oracle, where Wells Fargo reiterating the overweight rating, right?
Yes.
You know, Oracle, the Ellison family, they're all over the news headlines today, but one that really caught our attention was this note from Wells Fargo where it said they believe that recent weakness tied to the worries over the AI trade has left Oracle undervalued, and the bank reiterated overweight stance on the software stock. Its $280 price target implies an upside of 46% from Friday's close. They basically said the AI pessimism that surrounded this company because, you know, let's face it, free cash flow dropped in the last earnings report and CapEx expanded in the last earnings report, but they punished this name down severely. It's up today on this report and other things about the Ellison family, but yes, a really bullish note from Wells Fargo has Oracle recovering today, Nicole.
Yeah, it is good news there. So that 280 price target is about the valuations and that they have opportunity when it does come to AI and more. Good to see you, Kevin Hanks. Thank you. Let's take a look at the bigger picture. Jason Betts is with us, Private Wealth Advisor of Ameriprise Financial. Your thoughts on what's going on with the market overall? Is it a fundamental thing? Is it an excitement at the end of the year thing? What do you think is happening here?
Yeah, I think best guess is it's just an excitement at the end of the year thing. We're kind of this like no news is good news environment right now. We've got a little bit of a positive acquisition data point today that could be involved in pushing markets higher. But, you know, over the past few weeks, we've kind of been stuck in range bound in this, you know, 5% up to down trading range. And so in order for us to really break a lot through that, I think we need some more material economic or financial data to support that. I might do it and get it done, but I think it would be short-lived if we don't see the fundamentals follow after that. So we'll see if we get to Santa Claus rally or we don't. Regardless, my biggest piece of advice to investors as well as our clients is it's the end of the year. We want to take a look at concentrations. We want to make sure that we trim some high flyers and that we're properly rebalanced and exercise in certain disciplines as we go into 2026 so that we're not sticking our necks out, but obviously also making sure
Here we go.
in sand and poised properly with our overall allocations.
Are you
Do
sure?
you think that the path here is more for a cooling phase between now, year-end, or first week of January, or more of a Santa Claus rally?
It's a fallen wedge.
I'm totally not afraid to say that I don't know. I think that given the circumstances that we have right now, if we get continued no news is good news, and we get good whispers of consumer spending here through the holidays, that could paint a good backdrop for the for a Santa Claus rally here as we go towards the end of the year into early 2026. Having said that, we've had a market that is very, in my opinion, for this year optimistic. We're all thrilled at the broader market compared to last year where the S&P was led so firmly by the big technology players. That sector leadership has really broadened out here through 2025. And we've had, if we finish the year today, we've delivered another strong year in the equities market here, 23, 24, and 25, and have all been material double digits. And so if I look at this as a realist, and I look at this in terms of mean reversion, one could make a case that 2026 is a little bit more boring. And I wouldn't be surprised, actually, if the hype did not continue, but we finished the year in 2026 maybe, higher or lower in the single digits. It would be my best guess.
What about tech overall? When people ask you about the Mag 7, we've seen that be the driver. I was just looking at some of the funds and how well those, when you look at, the market up, whatever you're looking at, 15 or 20% or so, or 25%. But some of the funds are up 40% plus when they have a tech-heavy balance. Do you think tech is a driver next year? Do you stay heavily invested in tech? Or no?
I personally would be measured with how much I have invested in tech at these levels. Valuations are stretched. There is definitely continued opportunity in the technology space. At the rate at which things are developing and improving rapidly, it would be foolish to not note that. However, a lot of investors are actually more overweight in technology than they realize. For instance, if you just own the S&P 500 and then you own a smattering of other big technology names, you can find yourself in a position where you unknowingly actually have more than half your money tied to that space. That's probably too much to have in that space at these levels on a risk-adjusted basis, in my opinion. So there's opportunity. Valuations are stretched. Obviously, some of the CapEx, depreciation schedules that have been used on some of these expenses have been called into question on these companies recently, and so time will tell if that plays out into a hit into earnings over the next 1 to 3 years. But in general, stay sobered, invest in technology, but don't be overweight in technology at these levels.
Right, and where you talked about small cap briefly, is that an area you should be in? And also, what else? Because you talked about international too.
Yeah, absolutely. I think, coming off another year of very, very solid, large company U.S. stock growth, if we don't take a step back and look at some of the less loved, less sexy, less shiny types of investments that are out there right now, I think we're doing ourselves a disservice. U.S. small caps have materially underperformed their large cap peers over the past couple years. I think the small caps are also poised for better growth moving forward, just in terms of an overall valuation basis. The Fed's cut rates here a couple times this year, which should be good for U.S. small caps. Certainly, small caps are leading the major indices today. Whether or not that continues remains to be seen. But I think in general, there's opportunity in small cap. International, I like actually, because really up until this year, until 2025, the dollar's just strengthened like crazy, especially the last few years in relation to broader foreign currency. And so that finally shifted in 2025, and we see the dollar weaken, in my opinion, in a healthy way. Given the current climate and given the current backdrop, I'd probably make a better case for the U.S. dollar continuing to weaken. If that's the case, then we own international stocks as U.S. investors, owning those companies in the broader foreign currency. If the dollar weakens, then the foreign currency is going to gain strength, and that underlying strength will also then play out in the underlying asset that we own in that currency, which would lead to then additional capital appreciation if that plays out. So, again, the less popular stuff actually looks a little bit more appealing to me right now.
Yeah, understood. So you said just keep rebalancing and rebalancing. Don't be in a wait and see mode to see if the tariffs or the job situation or the costs, to be really, looking at the fundamentals and rebalancing off. And Jason Betts, thank you. Private Wealth Advisor of Ameriprise Financial. Coming up, Options Corner, and Tom White joins us. He'll highlight unusual options activity from the day, how investors are looking to trade on recent news of PepsiCo, NVIDIA, and Lam Research. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com. Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. We welcome in Tom White, host of Fast Market right here on Schwab Network. Good to see you, Tom White. So you have a couple of names here in the news. We were watching names like PepsiCo, for example, and you found a bullish trade that you're going to explain.
Yeah, Nicole, the stock's been under pressure so far this year. It's negative by about 3% in 2025, but it has bounced about 15% off of those
sell-off
that we
coming
saw
in
June. And this might have been on the back of that $4 billion investment that Elliott Capital Management took in the company. They're supposedly supposed to have a settlement with Elliott soon. That's the rumor there. But then PepsiCo's management in a mid-quarter update gave some guidance that was probably a little bit better than what the street had anticipated. They expect EPS growth about 6 to 7%, organic growth about 2 to 4%. They're cutting costs. They're changing up some of the innovation on the Frito-Lay side of their business, which, you know, if you went back to 2022 and 2023, that was the big driver of their business, but that's come off recently. So they're making some innovative changes there, and they continue to cut costs at this point as they try to reset the company's goals here moving forward. On the 19th, B of A raised the price target to 164 from 155. They kept the neutral rating on the stock, but they basically said that the largest unresolved question for Staples remains consumption growth, and valuations remain dispersed across the group. But we have seen some better analyst commentary on the company recently. And remember, the overall market rally that we've seen has kind of broadened out a little bit, so Staples have been pulled into that, which had been underperformers. But like I said, still negative on the year. Did see some unusual option activity. This is out in the January monthly cycle. So 25 days to expiration, traded about 10,000 of the 155 strike calls, paid an average debit of only 68 cents for those. Not a lot of option premium in these options. So the break even of 155.68 over the next 3.5 weeks, that's about 6% above the current share price in PepsiCo. They did sell out of a position that they had. They were their big open interest position in the 160 strike calls. Sold out about 30,000 of those to buy this 10,000 lot. That's closer to at the money. Call volume about 10 times normal daily average volume on these purchases and sales within that January cycle. But this trader thinks over the next basically 3.5 weeks that we're going to see some more gains for PepsiCo.
All right. Well, you know, it's great to see that, and the investment and interest, too, that we've seen in that company, too, from the activist investors. What about NVIDIA? I mean, NVIDIA, we continue to talk about the H200 chips and the optimism that, you know, expanding into China. What are we seeing here? It's at 183 today, and you found a bullish trade. You'll explain.
Yeah, you mentioned it's 183 today, but last week, at its lows, it was about $170 a share. So we've had a nice little rebound here in NVIDIA, up over 3.5% so far in the month of December. And valuations are relatively low, comparable to what we've seen over the last couple of years, even though the growth rate's over 60% for EPS and for revenue. So they've got good parts of the business. The valuations come down a little bit. Today there was some news that Chinese customers plan to begin shipping their H200s over there to China in mid-February. Now remember, they don't take any revenue from China's sales because they don't have any, right? Because of the restrictions. So this is all going to be bonus for them. CEO Jensen Huang, he basically wants the U.S. to allow him to sell wherever, and there's still some restrictions in place. But this is, opening that door to maybe get some more sales from overseas. Truist on Friday raised the price target to 275 from 255 on the company. And basically, you got to remember, this is the picks and shovels in AI. There's always that concern about an AI bubble, monetization of AI. Well, they're already monetizing AI, and they're already completely sold out of Blackwell into the early half of 2026. Rubin's going to come online. They continue to innovate there, and prelim sales for that chip are pretty robust. Competition's coming down on some of these specialty chips, whether from Broadcom, Google Alphabet with the TPUs, and then also Amazon with their Trainium 3 chips that they just released. So there is competition, and that's probably stunted the rally here a little bit in NVIDIA. But we did see some bullish activity in here, and this was all the way out in the March monthly options that expire in 88 days. Trader bought 50,000 of the March 160 strike calls, paid a pretty hefty option premium, a debit of $30.30 for these calls because they're deep in the money. So the break even for this trader is above $190.30 over the next 3 months. That's about 4% only above the current share price. So they gave themselves plenty of duration. And this was another one of those trades. Traders sold out of their long February 170 strike calls in there. About 50,000 of those were sold. Big open interest on that. So they sold those, reset their strike at the March 160 strike calls deeper in the money. But this is definitely a big bullish position with the expectations that, hey, over the next 3 months, we're going to see some more gains here for NVIDIA.
All right, and last but not least, I don't want to leave out Lam Research, but in this case, you found a bearish trade that you'll share. Tell us more about that, LRCX.
Yeah, stock hitting all-time highs today, up over 140% so far this year. So it's been on a parabolic move to the upside recently, benefiting from that booming demand in AI, data center chips, memory chips. Remember, advanced fabrication technologies is what Lam Research does. So as these AI infrastructure gets built out, these data centers get built out, Lam Research right in the mix there as far as their high bandwidth memory and advanced packaging technologies that they have. They're expanding manufacturing in Asia. That's helped them lower costs, improve their margins. Also, operating margin rose 35%, up 410 basis points last quarter. So they're seeing some improvement on their financials here as demand continues to expand, whether it's on the AI chip side, whether it's on the memory side also. So demand's kind of driving this one. But we did see some bearish activity in here. Maybe somebody thinking that this rally to all-time highs is going to maybe come back down to earth here. This was out in the March monthly options also, 88 days to expiration. Trader bought 20,000 of the March 160 puts, paid an average debit of just over $10.30 on those, so the break even just under $150 a share over the next 3 months. That's about 14% below the current share price on these. They did sell out of some long existing puts that they had in there in the February 150 put, so resetting this position at the 160 strike puts, and they buy in 20,000 of those. Put volume is about 7 times normal daily average volume that we've seen over the last week of trading. But I don't think this is a hedge maybe against a long stock position. It could be, but they're paying a pretty hefty option premium for these over $10.30 per put that they bought. This might be somebody speculating that, hey, we're going to run out of steam over the next 3 months here in Lam Research. So this bearish, unusual option activity, Nicole.
Okay, Tom White, great to see you. Thank you so much. A good look at 3 key names there for Options Corner every single day here on the watch list. Coming up next, if you wanted to get into an IPO or look to a private market to diversify your portfolio, we have the answers for you. Maybe 2026, this might be a great opportunity for you. We'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. Let's welcome in our next guest, Howie Eng, Chief Strategy Officer, Forge Global. I'm so glad you are with us, and we take a look at the private company landscape overall and the overview of the secondary marketplace and how folks can actually access some of these high growth private companies. They're an important part, right?
Yes, they are definitely an important part of today's innovation economy. We see a lot of value creation in this part of the asset class.
So it's not just a path to an IPO, which we'll get to the IPO part of the story, but how does the pricing work, the valuations? How do people actually have the mechanics of getting into one of these private companies or being an investor?
Right. First of all, I think it is important for someone to have some sort of exposure to the private market today. When you think about asset allocation strategy, the way people should think about it is that having some sort of a allocation to private exposure would definitely help the growth part of the company. And when it comes to accessing the private market at Forge, we operate a marketplace which allows buyers and sellers to come in, buying and selling private company shares that actually provides products and services to all types of investors, from accredited investors to non-accredited investors. We also provide data solutions as well. We have something called Forge Price, which we think of as a pricing standard for VC-backed late-stage companies, which can actually guide the pricing discovery in the space.
And what are the specific requirements? Who can invest? Is there a minimum? How do you get involved here with Forge Global or trying to get into the private company landscape? What are some of the specifics and requirements?
Right, so the market is definitely broadening, access is definitely broadening, and at Forge we're actually at the forefront of providing that broadened access. So historically, only accredited investors with some kind of a sort of like minimum net worth and criteria can only access, they are the only ones that can access the private market. And they can access it through direct shares by sitting directly at the company's cap table or through one of our fund offerings. But we're seeing an evolution of things that are opening up even for non-accredited investors. And for non-accredited investors, typically with smaller ticket size, now there are actually products out there that provide low-cost, diversified exposure in a basket kind of an approach. So think about it as your index investing in the public market. That is actually coming to the private market. I think that is actually a very good instrument, especially when it's being presented through a registered fund structure. We have recently found such a product. It's called the Megacorn Fund. It's a 40-act interval fund that will be launching shortly after the new year. That would actually provide investors with diversified, low-cost exposure to household private market names like SpaceX, XAI, Databricks, and whatnot.
Right. Oh, we have to have you back for that fund launch. That sounds very interesting, Howie. How about also a private market update over the last 1, 2, or 3 months? Some of the interesting aspects, or a monthly sort of look back. What stood out in the private markets that folks would find most interesting?
Yes, like I said before, I think the companies are staying private longer, and when you sort of think about it from a return and growth perspective, actually, if we were to go back longer, between 2019 and 2025, for all the unicorns that actually went public, the median appreciation for those companies was 66% a year before the IPOs. And at Forge, because we have data solutions, we also actually are tracking the private market by our own Forge Private Market Index, which tracks the top 50 VC-backed companies, household name again like SpaceX, Anthropic, XAI. That index actually in the last 12 months have outpaced all the public market indices. Year-to-date return on the index was 94% as of December 18 versus S&P, say, 16%. So that is definitely a trend momentum to watch.
Boom.
Yeah, you talk about the trends. I mean, for example, we've talked so much about AI. What could be a trend in the private markets in the new year? Does it correlate to the equity market? Not necessarily. I know there's a lot of IPOs in the pipeline, too.
Yes. When you think about, 2025 definitely was a better year from an IPO perspective with 19 VC-backed IPOs so far. We think 2026 is going to be a better year, all else equal for the IPO market. You have things like SpaceX, OpenAI, and Anthropic. Those 3 companies have rumored or reported to go IPO in 2026, and that's totally over $1.4 trillion in implied valuation. Right, so I think these are massive IPOs that actually, if they were to come online in 2026, it would be really good to sort of test the public market sentiment and appetite for large IPOs like this. But the other thing to remember is that they go public only if all the conditions are met. Companies actually might choose to stay private longer if funding and momentum continues to hold on and to get traction in the private market. So we're watching both. Pre-IPO, the pre-IPO landscape is equally, if not more interesting than after IPO, especially now that access to liquidity and data transparency are made possible by a platform such as Forge and some of the others.
When we gauge investor appetite, it'll be very interesting to see which company comes to market first, because they may have a bit of an advantage for investors, right? Whether it's OpenAI or SpaceX or Anthropic. You said getting out first may make a difference.
Yes, because they are such large sum of money. These are such big IPOs. So one is testing to see how much capital is actually in the public market. So for those that actually get out first, especially for these really hot sectors such as AI. So when you think about SpaceX, OpenAI, and Anthropic, you basically have 2 cohorts. You have space exploration, which is SpaceX, and you have AI, which is OpenAI and Anthropic. They're very different kind of sectors. So I think it does make a difference from a sector perspective, the sector leader that goes first. And across the board, the high growth companies, I think getting out to the market first probably would have first advantage when it comes to getting the most sort of like capital and momentum from the public market. That is if the public market continues to go up. Yeah.
You talked about data innovation driving transparency, actually using Forge price, Forge indices. Tell me more about that. Why is that an important part? Because investors,
it's very important.
You also provide education to folks.
You didn't know that?
So this is a wonderful opportunity.
How dare you?
To hear more about the transparency, the price discovery, and how it all works.
Yeah.
Yeah, so I think, for all the investors out there, private market data historically has been pretty opaque, pretty fragmented, and at Forge, we actually want data to drive transparency, improve price discovery for all market participants. This will lead to greater liquidity and access to the asset class. So when it comes to Forge price, the way we kind of think about it is that we want to provide a daily pricing standard on about 160 base stage VC names, right? Then you actually have price per share information. You also have implied valuation information. Very similar to if you go to look up a public market name today, you would be able to see the price per share as well as the market cap. We want to do the same thing to provide depth and transparency for investors who want to come into the private market.
You also mentioned IPOs in 2025, 19 IPOs backed by VC, 16 ready to come in 2026. And the look back to the 2025 year, or even earlier, but we always think about companies that are top traded companies. I know there's risks involved always, but what are some that jumped out at you that folks can take a look?
For 2026, I do think that the three names that everybody's watching right now, it is that SpaceX, OpenAI, and Anthropic, and because I think not only that would actually set the tone. I think they're big enough and they're marquee enough to set the tone for the IPO market for 2026. But I also think that those will be the one of the highest performing cohorts of all the IPOs that are actually in the pipeline.
Yeah, well, now we've given people a little better understanding of how they invest, who can invest, and some of the metrics here. Howie Yang, thank you so much, Chief Strategy Officer for Global. Look forward to seeing you again. Thank you so much for joining us on the show.
Correctamundo.
Why strategists do see a Santa Claus rally and some Fed cuts. And hey, S&P 7,000, let's see.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on @Sam_Vardas and connect with me on LinkedIn or Instagram for more.
Trading Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalese. Mark Gibbons is with us, CIO of Gibbons Capital Management. We want to take a look at the S&P 500. It has been an exciting year for sure. We're not that far off from record highs for the S&P and the Dow and the NASDAQ, right? We're at 1%, 3% or so. Even while everything was thrown at the market throughout the year, including Liberation Day, we made it through. At this point now, some folks are even saying, hey, S&P 7,000 or Santa Claus rally. What do you think, Mark?
I am in the camp that we are headed above 7,000. So we have, Fed cuts, more on the way. We've already had some this year. Economy's growing at 3%.
Yeah.
Earnings growth looks like it's going to be in the mid-teens next year for the S&P 500. So everything's looking pretty good. And on a typical year, right, it's about 75% chance we're going to get that Santa Claus rally. And this year, I think it's going to be one of them.
So what are some of the catalysts for Santa Claus rally, and does that continue into 2026?
Trump.
Yeah, I think it really, I think it has to do with the fundamentals of the market. So
Again, we have solid earnings growth. We have an economy that's growing really well. We have regulation coming into the next year. We have easier monetary policies. Not only is the Fed lowering rates, but they're also buying securities. So pushing more liquidity out of the markets and definitely kind of driving risk on assets. So that's the outlook, at least coming into 2026, and it looks pretty good.
When we talk about AI, are you buying dips thinking there's opportunity, or do you see that as some warning?
What's the trader's market?
I do not see it as a warning sign. So I am buying dips. You know, there are some great companies out there on sale.
Oh, God.
Nvidia's off about 12% or so. Broadcom's off about 20%. There's some really great values out there. You know, in the past few weeks, there's been lots of talk about the financing associated with the AI build-out. But I think that's going to eventually die down, and I think this trade resumes its upward trend.
Understood. So if the trade has an upward trend, how do people capitalize on the upside?
Yeah, how do you do that?
What's your advice?
Well, my advice would be to look for names that are in an uptrend that have been pulled back. They're solid quality companies.
Name one.
So, you know, when you're looking at names, you can
Name
look at
one.
names, like I said, you know, the big AI juggernaut, Nvidia, looks looking pretty good. It's trading at about 26 or so times earnings. That's pretty cheap on a historical basis with a company that's, you know, obviously very impressive, continues to put out chips for that AI build out. I also like Broadcom. So again, it's a custom chip maker, custom silicon. It had a great report and it got smacked down, so it's down 20% from its high. So again, I would be looking mainly at companies, companies that have been kind of smacked down in this recent tech off trade, if you will.
Understood. So you mentioned Broadcom. I mean, this is a name here. People have been loving tech. Is there more upside opportunity for a name like Broadcom at this point? I mean, when you pick it, how much upside do you see?
Yeah, well, I mean, quite a bit. I mean, I think it could run at least, you know, back to its all-time high. So I'm thinking, at least a 20% run. But honestly, I think it can do better than that, you know, over the coming year, over the full year. So, but yeah, it just takes, you know, a couple more weeks here, maybe, kind of like settling in. I think this AI trade is already beginning to turn around. So, I think we're already kind of a little bit on our way there.
Okay.
Well, what about Nvidia? I mean, I know Nvidia has pulled back from the highs, but a lot of talk and excitement about, well, you know, with Nvidia's numbers, they really didn't count anything China. Now we're hearing that we have the H200s as a possibility to go to China, and of course just demand for Nvidia chips overall 2026. Do you see Nvidia hitting new highs and beyond?
I certainly do. And the H200 chips going out to China, I mean, that is icing on the cake. So obviously the demand is strong, basically worldwide, and if they're able to sell those H200s into the Chinese market, which they're going to be doing, hey, icing on the cake, even more room to run. So it is really hard to bet against this company. Has solid fundamentals, and even the price is coming a little bit. To me, it looks like you're getting at a steal right now.
Understood. And then we turn our attention to the financials. You said, look, you think that the Fed cuts are tailwinds to a certain extent. Do you think we get more Fed cuts, and why JP Morgan as your pick?
Well, I do think we get more Fed cuts, probably 2 to 4 next year. I'm ballparking maybe 3. As far as JP Morgan itself, you know, it is a large, obviously very large, largest in the world by market cap, stable bank. But again, it's going to benefit from that separation from the short end of the curve to the long end of the curve, and obviously the Feds are dropping the short-term rates. So again, that should allow for expansion in net interest income. There's also that capital market activity. So you were just talking to your previous guest about IPO market heating up next year. So we got more IPOs, maybe more M&A. So again, that's going to benefit a money center bank like JP Morgan.
Right, understood. Do you like some of the other financials? Do you like them all, sort of, the big cap money center banks, or no?
JP Morgan is our only really large money center bank. We do have a large regional bank, PNC, but the story generally, as long as their operations look good, the story remains the same. So it's economic expansion. Obviously, banks are cyclical. Again, catching that net interest income is obviously those spreads are going to widen out. So we really like the financials along with tech.
Right, understood. What about anything else? Any other groups or sectors that you might like?
We have a fairly large position in gold so that plays into the debasement trade. We like it. It obviously has performed very well in 2025. We may not get 2025 type performance, we might. But we like the outlook from here. We think it does well in an environment where the Fed is, cutting rates and there's easy monetary policy out there.
Right. Thank you, Mark Gibbons. It's great to see you, CIO, Gibbons Capital Management. Really appreciate it. Thank you. Still ahead, we bring in our panel to talk all about looking at trading, how to restart the global risk trade across crypto, AI, equities. All you need to know. Be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close. Here on the floor, I bring you real-time sentiment from traders driving the action. And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings. Live coverage of the close every single day. This is Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vladis, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the Washboard. I want to bring in our panel. We have Ray Salmon, Head of Markets, Cointelegraph, and David Seymour, CEO of Wave Digital Assets. All right. Ray, I'll start with you. We look at the global bid coming back, in your opinion. I mean, whether it's crypto or more risky assets, what do you think?
Yeah, what do you think?
Well, Can you hear me?
Yeah, I can hear you.
What are your thoughts on the global bid? Are people excited
Hurry
about
up.
investing?
Yeah, I'm really excited for 2026, but
Well, we're
the actual demand
Friday's low.
in terms of volume from market leaders like Bitcoin, Ethereum, and Solana, that's going to set the mood in the industry. So in 2025, we saw net flows into these Bitcoin ETFs reach 57 billion, and the total net assets across the ETFs, I think, reached like $115 billion. So the real question is, can the pace of institutional and corporate and government level adoption, which are critical price drivers in 2026, can these be replicated in 2026? Since October, we've seen these inflows taper off and in some cases turn into sellers markets. And this was followed by a 30% correction in Bitcoin and 50% in Ethereum. And we've seen the same thing happen with these digital asset treasuries, which popped up all throughout 2025 where publicly listed companies went out and bought a whole bunch of Bitcoin and issued stock or raised cash in order to buy Bitcoin or Ethereum. And we've seen their kind of NAV or their net asset value of their stock fall below the value of their crypto holdings. And it's possible that in 2026, they could also become net sellers. So I think what's going to set the tone for the start of Q1 and Q2 going into this next year is what sort of demand do we see in the spot markets and also in the ETF markets for Bitcoin, Ethereum, and Solana.
Here, David, thank you for that, Ray. We look here to crypto builders, capital markets, the positioning for 2026. We have the 2026 Clarity Act passage. There's been regulatory support for digital assets. David, do you think people will be more risk on in 2026 for this group, and how so?
Yeah, no, we definitely do. I mean, as other panelists have kind of mentioned, there's been a lot of unusual forces in the last few months. We did all these digital asset treasury companies come out. They bought a lot of digital assets in the open market. Then they went below NAV, so now they are not buying digital assets. I'm not too worried about them selling a lot of assets. Just it doesn't really work for their business model. But there's been a huge lull in the market. This administration has been a huge, powerful advocate for crypto. There's a lot of big things coming. Obviously, a little bit listed there. We are very, very bullish going forward that we'll see much higher asset prices. It's hard to say what will happen in the next few weeks, but in 2026, just with how all the large institutions are kind of lining up to support these assets, JP Morgan, finally allowing people to, borrow against digital assets is a big deal. It's amazing, all they're doing is treating it like every other asset, but it's still a big deal they're finally doing those things. And I think that will continue to drive a lot of adoption, but I think it'll be more institutionally led, probably a little less retail led, which is probably a good thing.
So as we see, obviously we've had more regulatory support here, Ray. You talk about new narratives that will kickstart whether it's price or investing. How so?
The crypto market's always been driven by narratives, whether it's corporate adoption, whether it's some sort of new wallet, which is going to build infrastructure globally, whether it's stablecoin demand. It's always a narrative which is boosting sentiment. So I think really what is going to be the driver in 2026 is the impact that AI has, the expectations that investors have of AI and also Mag 7. So the AI build out, the valuations, the fundraising, the IPOs, whether or not data center hyperscalers continue to propel the equities markets higher alongside the Magnificent Seven. I think that's really what's going to be at the front of everybody's mind, because that has a direct impact on equities, and then the performance of equities has a spillover effect on crypto. So I think that's really the main catalyst that can either lead to upside in price or downside in price in the short term. Beyond that, there's things like the strategic Bitcoin reserve, the digital asset treasuries, whether or not the Clarity Act leads to some sort of DeFi bull run or leads to offshore crypto companies returning to the U.S. where they can sandbox and offer new goods and services to consumers. And of course, what is the actual consumer uptake of those products? So I think the primary narrative that investors might be keeping an eye on going into 2026 is what happens with AI.
Yeah.
Right, understood. David, when you think about the big picture here, do you think there's any risk, whether it's in digital assets or equities, or are you positioning more defensively or aggressively?
Right now, we're positioning pretty aggressively on the digital asset side. We're positioning pretty defensively on the AI and equity market side. Markets are really high. AI is incredibly high. Not necessarily predicting it's going to crash, but there's how much further up can it possibly go is, it seems a little bit, a little strange that it can go that much higher from where we are today. So I think digital assets are currently undervalued. We've seen, a huge run in gold, other commodities. We have seen the opposite in digital assets. So we're very overweight for our clients in digital assets right now at these prices.
Understood. And Ray, as we look at this, what will you be watching for, whether it's more legislation or more of an international footprint? Will that help?
That both help.
beyond what happens with the AI build-out, I think inflation and the Fed's policy shift and President Trump's 2026 Fed chair selection
You sound scared to death.
markets. So the kind of base expectation for 2026 is that there may be 100 basis points in interest rate
Don't be
cuts,
scared.
which crypto investors view as bullish for crypto and for risk assets. But we've kind of got a tale of two cities scenario where this data collides with the most bullish perspectives. The job market is softening, and this cooling trend is predicted to carry on into 2026.
Here we go.
The transitory impact of the Trump tariffs resulted in elevated goods and
There you
services
go.
costs. Health insurance premiums are expected to go up. So, will rate cuts incentivize retail investor confidence? Will further layoffs in the economy have a negative impact on disposable income, and we also see consumer debt rising. So that's one side of the picture. But then on the other side, there's plenty of investors that believe that Fed rate cuts are going to lead to lower mortgage rates. It's going to compel banks to loosen the purse strings on lending, and it should lure investors to get out and buy more stuff. And there's also a view that the rate cuts is essentially the U.S. kicking the debt bomb down the road, and that Bitcoin benefits from that environment where there's easy money policy. So yeah, I think inflation and what happens at the Fed is also going to play a key role in Q1 and Q2.
Okay, Ray Sell and David Seymour, thank you both so much. Really appreciate it. Of Cointelegraph and with Digital Assets. Great to see you both, Ray and David. Thank you, friends, for being with me here on the watch list. I'm Nicole Petalides, every day here at 9 a.m. and 2 p.m. right here on Schwab Network. Thanks for being with me. I'll catch you tomorrow. And Market on Close is next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell.
2 more minutes to power hour.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing up houses, opening up our business, having children. They've always been there for us.
I want to invest with a a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are. Monday. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters. And I'm Jenny Horn, filling in for Sam Bottas today. Let's take a look at what's coming up on today's show. We'll look ahead to 2026 and see what could drive stocks higher next, and we'll see if the Santa Claus rally perhaps has begun. Later, we'll fill you in on all of the latest details on the bid for Warner Brothers Discovery, which now has Paramount backing and guaranteed by billionaire Larry Ellison. And in Options Corner, we'll look at options activity on Micron, which we're seeing another new all-time high this year, which could continue into forced 2025 rally. But Marley, take us through what you are watching today.
Well, Jenny, we're seeing NVIDIA stock up today as it's reportedly preparing to send as many as 80,000 of its H200 chips to China by mid-February. These processors offer roughly 6 times the performance of NVIDIA's H20 chip, but still need Beijing's approval to enter the country. And Alphabet is acquiring Intercept for $4.75 billion in cash, in addition to the assumption of its debt. Google says that the data center and energy infrastructure company will stay independent in terms of its operations, but that the acquisition will help bring more data center and operation capacity online faster. And Honeywell shares are tumbling after it revealed that it will take a one-time charge related to its settlement talks with FlexJet. It will take a hit in the fourth quarter, and it's expected to lower its GAAP sales by $310 million and its operating income by $370 million in the quarter. Now, let's take a look at where the market stands as we head into the end of the day here. We are still holding on to all of our green that we see here. The S&P trading 6/10 higher at 6877.16. For the NASDAQ, we're 4/10 higher at 25,458. The Dow has added 267 points, up about 0.5% to 48,402. And the Russell 2000 is our winner on the day right now, up about 1.33%. The 10-year trading at 4.17. That is higher on the day. The dollar a little bit lower at 97.96. For gold, we are touching another record high today for gold, up close to 2%, 44.7020. Crude oil is trading higher as well. We're up almost 2.75% at 58.04 a barrel. And Bitcoin still can't quite hit that 90,000 mark, but it is inching closer at 88,050. Now, I do want to send it over to Jenny Horn to talk about some of the top movers we've seen today.
Thank you so much, Marley. And of course, Kevin Hicks is standing by at the CBOE to help us break down some of today's top moving stocks. And good place to start is where we typically start, and that's diving into all of the headlines surrounding NVIDIA. So NVIDIA, we do see some reports that it told clients in China that it does expect to begin shipping those H200s. So Kevin Hicks, of course, coming to us here from the CBOE. Kevin, walk us through some of the developments we're seeing with NVIDIA and of course, hopefully making some strides to improve that battered relationship with China.
Yeah, hi, Jenny. Hi. I think this is important because of two things. Number one, remember, in NVIDIA's last earnings report, they said any sales to China would be additional, would be gravy, would be extra income coming in. So the fact that they're now increasing capacity so they can send these H200 chips to China means a whole new chapter for NVIDIA. Remember, this stock was under pressure when sales to China were cut off, and then negotiations started. Now it looks like they're going to be able to start sending these chips to China, and that is just more of the abundance that NVIDIA has. I think Jensen Huang's close relationship with the administration, the fact that they're not selling the most powerful chips to China, they're selling the H200s, this is nothing but good news for NVIDIA. It may, remember, this stock traded over $212 a short time ago and had a great earnings report when the stock sold off as low as $170. Now rallying up today, JD, about 1.3% on the day. So good news, good momentum for NVIDIA shareholders.
Okay, Kevin, you have a great read on some of the geopolitical fray. Do you think this also gives a positive signal for the relationship between the Trump administration and China?
Well, it's a negotiating tactic, right? Remember, China wants U.S. chips. The rumors are that the first two in line would be Alibaba and ByteDance in order to buy. They were the alleged first customers from China that want to get in. Remember, I think the Trump administration thinks everything is a bargaining chip. And for two things are going to happen, right? NVIDIA's going to sell these chips to China.
Oh, China, China, China.
To the United States, to the government, and then the Trump administration is going to want something from China in trade for this. So yeah, I think it's a pawn.
We want your rice.
In the big chess match between China and U.S., Jenny. I certainly do.
I do too, and I think it
And your chicken.
on it that, at least as far as some of the price activity has been concerned. But now look at another Mag 7 player, Tesla. I mean, has been on a really nice run in the month of December so far. Also getting a note today from Deutsche Bank that wasn't so optimistic, but hey, they still raised their price target to $500 a share.
Right, exactly. Well, it's interesting. With everything going on with Tesla right now, this note focuses on EV deliveries. And he thinks they're going to, Deutsche Bank thinks they're going to be a bit light. Well, okay. We all know that the EV market's going through a bit of a down cycle right now. It's, Ford is basically exiting the business. GM is scaling way back. Tesla's also probably seeing softer numbers, although they've been doing the right things, ratcheting down the overall selling price of their cars. But that's not why Tesla's rallying, as you know. Tesla's rallying for all the other things that they do. Full self-driving, taxi, robotics. That's why Tesla stock has been moving higher, because the perception is right now that the future that Tesla's been talking about is actually coming fairly soon and in the year 2026.
Thank you very much.
So as far as Elon Musk is concerned, I know that there's also been some momentum tied to the SpaceX
Tesla baby
potential IPO and of course all his other business entities. I mean, do you see right now just Tesla is serving as a proxy for all of his companies, even though of course we might actually see the public offering of SpaceX coming in the next year?
Well, Jenny, you've hung out with me enough to know I'm a big watcher or monitor of the news flow. And the news flow in Tesla can be awfully negative at times, but right now the news flow, with full self-driving, with everything going on with Tesla, seeing a SpaceX IPO in 2026, people talking about linking Tesla shares and giving those shareholders opportunities in SpaceX, there's just nothing but positive momentum right now surrounding this stock. Eventually, it's getting up near $500. It's going to start getting oversold, and then it gets a little more fragile to news headlines. But right now, it's all systems go on the upside, Jen.
Okay, another name that's been all systems go has been Alphabet, now buying Intersect for a price tag that's just shy of $5 billion, which I know is actually relatively small for a company as massive as Alphabet has become. But walk us through the latest with Alphabet here, because actually, as it stands, it's leading our Mag 7 performance for the year.
Yeah, they're acquiring Intersect. Now, if you're watching Alphabet stock, they had a rough first half of the year and a spectacular last few months as the stock is rallying. Now they're buying this company, Intersect, which provides data center and energy infrastructure solutions for about $4.75 billion in cash, but they already owned part of it. They already owned part of this company in some of the equity raises. They had already bought a stake. So this is just kind of the evolution of the relationship between these two companies. But you're right, Jen. Under $5 billion, that's nothing for Google Alphabet with the amount of money that they generate. But yeah, this is Google already owns a minority stake in Intersect from a previously announced funding round. The acquisition will enable more data center and generation capacity to come online faster with accelerating energy development and innovation. So there you have it. Google just keeps making their footprint bigger, and this is another step in enlarging their exposure to AI, Jen.
Yeah, and to your point, like you said, we already did see, I mean, a pretty substantial minority stake and just further development into its AI push as Alphabet continues to really show those monetization efforts that I know the street is right now so desperately needing for proof of some of this massive ramp in CapEx that we've seen. So as far as Alphabet is concerned, I know the energy bottleneck is still a bit of a concern for investors, but to your point, this name has been on a really nice run for the back half of this year, which we haven't seen in some of its competitors, like, say, Microsoft, which has been left out of the conversation recently.
Well, it's interesting. Google just had a wet blanket on them for the first half of the year about regulation and Gemini missteps as they rolled it out. And all of a sudden, with very little notice, the regulation went away, big settlement there, and then Gemini has now turned into the #1 choice and the leader in AI. And so that just unleashed. Remember, we've said for months and months at the beginning of the year that Google Alphabet was the cheapest valuation of the Magnificent Seven. Not anymore, Jen. This stock has had a ferocious rally in the second half of the year.
It has, and with that now, I mean, elevated multiple, to your point, it's also been able to grow. I mean, it has forward-looking growth expectations that can somewhat justify, I'm not saying it justifies a hefty valuation, but a lot of these names have put up numbers that would make you say, hey, no wonder we've seen valuations go up over the last 12 months. But now, lastly, Honeywell, which Honeywell's seeing some pressure today. We're down about 1.9%, but they have a $470 million flex jet problem. Walk us through this story.
Yeah, Honeywell, we're talking about an industrial. That's an out of context talk for this conversation. But Honeywell lowers their full year 26 adjusted earnings per share view to $9.70 to $9.80 from $10.60 to $10.70. The consensus was around $10.56, so lowered full year adjusted earnings per share. Also lowers the revenue to $37.5 to $37.7 billion from $40.7. So a big drop there, about 10% drop in revenue expectations. So the consensus was about $39.9 billion. So pretty significant downplay there. They lowered the operating cash flow for 26 to $5.9 billion to 6.3 from 6.4 to 6.8. Another big drop there. They backed the organic growth views of around 6%, but they released supplemental 2024 and year-end 2025 financial information to reflect its updated business segment structure. So it just looks like they are just taking all their numbers from a big perspective and taking them down, somewhere between 5 and 10%, depending on what you're looking at, Jen. So yeah, Honeywell, that for this big long-term industrial name, not great news today.
Yeah, not great news, and I will say that we're only down, just shy of 2%, so it's not like it's selling off by any means on what could be read as perhaps more dire, but frankly, I will say its resiliency today in spite of this news has been pretty astounding. So appreciate it, Kevin Higgs, of course, contributor here for the Schwab Network, coming to us live from the CBOE. Now I'll send it back to Marley, of course, for what's coming next on today's show.
Thanks so much, Jenny. Coming up, we'll take a look ahead at 2026 and what can drive stocks higher in the new year. Market on Close. We'll be right back.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches, all at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Cotolides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters, Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Marley Caden alongside Jenny Horan here in our Chicago headquarters. We're going to welcome in our next guest. Joining us from the floor of the NYSE today, Christopher Hodge, who's the Chief U.S. Economist at Natixis CIB. Christopher, thank you so much for taking the time to be with us today. As we head into the holidays, and happy holidays to you, I'd love to start with your market thoughts as we head into the end of the year, and I guess ask the question, are you expecting a Santa Claus rally?
Hey, Marley, great to be back with you. Things do look pretty advantageous for the market overall. You have a Fed that's probably going to continue to cut into 2026, the pace of which will be determined later. But we have fiscal stimulus, we have a consumer sector who's not over-leveraged. Balance sheets look fairly strong. CapEx spending for businesses should widen out in 2026. Along with that, fiscal stimulus. So it does seem like that the positive 2025 is probably going to continue into 2026.
You're boring.
Momentum continuing. Has anything given you any pause about the potential consumer slowdown into, of course, year end?
What do you think, Marley?
Yeah, we have seen an increasing amount of spending concentrated among higher income
She's
Americans
not happy with the
overall.
question asking.
We started to see stresses at the lower end of the income spectrum. Delinquency rates for auto loans, student loans, etc., have started to tick up. But in aggregate, balance sheets are still pretty okay. And even though we've seen an increase in these delinquency rates, it doesn't look like even lower end consumers are all that stretched. The default rates and delinquencies really aren't out of step with historical averages, and even though they've gone up over the past year, they don't appear to be increasing any further. So there are some stresses at the lower end of the income spectrum, but that's not unusual at all. And I think, again, in aggregate, I think consumer spending is going to hold up quite well in the next year.
And Christopher, is the slowdown, in your opinion, more about fatigue from the higher prices, or do you think the labor market is finally starting to show up in some of the consumer behavior, and will we see that continue into 2026?
Good point.
I think it's a combination of that. I do think the cumulative effect of high inflation over the past few years is starting to catch up with consumers. Now, we've seen businesses be very hesitant to pass along these costs to consumers, but they're slowly doing so now. And I do think those increased price pressures is pulling back spending a little bit. Similarly, for the labor market, we have seen job growth slow down a little bit.
Life on Tesla here.
Tick up, and we've seen an increase in savings. So even the workers that have jobs right now are a little bit more cautious with their spending patterns, and they're not as confident in their job prospects either.
Okay, so what relief, if any, could we see from more favorable tax policies and easier monetary conditions, as you mentioned, bring to consumers again as we head into the new year?
Yeah, so you are going to see a set of the American population get larger than usual tax rebates in the first half of 2026. By some estimates, it's about $1,500, particularly for the Americans that are going to benefit from the no taxes on tips and overtime pay from the One Big Beautiful Bill Act. On the consumer side. On the corporate side, you have expedited depreciation of CapEx spending. So a lot of the investment for 2025 was concentrated in AI and tech sectors, and I do think this more favorable tax treatment from the One Big Beautiful Bill with investments is going to broaden out that investment in 2026.
So Christopher, with those easier financial conditions that you just mentioned and then some of the fiscal support there, do you expect growth to stay solid through 2026?
I do, and we still have headwinds. There's a lot fewer policy questions though going into 2026, into 2025. If we turn back the clock a year ago, there were a lot of open questions about fiscal policy, immigration policy, trade policy, et cetera, et cetera. A lot of those questions are still there, but at least we have a better understanding about what the broad contours of these policies are from the Trump administration. That said, if there is a resumption of the trade wars, for example, that could certainly cause a pullback in hiring and in spending overall.
Okay, do you see any volatility tied specifically, of course, to the new Fed share that we've, of course, priced in different expectations for the Kevins, as they've been calling it, but what do you really expect with a perhaps new Fed share coming and, we get a decision at least about a month from now?
Yeah, I think the candidate pool has been pretty well narrowed down at this point. So something, out of the 4 or 5 candidates that we've heard over and over again would be pretty shocking. But that's not my base case. And ultimately, the Fed chair is a part of a larger committee. It's one vote in the committee. And while the chair position is very important, it's not going to be decisive unless that chair can pull the rest of the committee along with him. Now, I will say that the court's decision about Governor Cook and the president's legal authority to dismiss a Fed governor, I think that might even be more important. Giving any president broad personnel control over the Fed board, could be fairly dangerous. There's generally a dovish bias among policymakers overall. So that would certainly set a pretty poor precedent and could potentially erode the credibility of the Fed.
You bring up a good point there. You're certainly not the first guest to point out that there have been some questions about the Fed's independence going forward and if they'll be able to maintain it with the outcome of some of these situations that you just mentioned here. If that comes to pass, that we start to see more doubt creeping up about the Fed's independence, where do you think we would see that show up first? Is it going to show up first in rates? Is it in the dollar? Do we see it in the equity markets?
Yeah, I think what I'm most focused on are longer run inflation expectations. And those were elevated in the post-COVID period. They've come down a little bit right now and seem to be broadly well anchored. But I think we should make the distinction between Fed independence and Fed credibility. We haven't been at target inflation for core PCE in about 56 months right now. I think the Fed is going to continue to cut, and that's the kind of thing, not being vigilant about inflation, that could eventually, in conjunction with fiscal spending, which is going to continue in 2026, that could be something that pushes up longer run inflation expectations as well.
Okay, so a pretty favorable right now retail environment, pretty favorable labor environment. Do you think that some of the pessimism that still seems to weigh on what has been a really strong bull market, is it going to be perhaps toned down, or do you expect it to be more of the same, where we are so critical of the bullish activity because it still doesn't necessarily add up in terms of the Fed's plan versus maybe the market's plan?
Yeah, I mean, again, we've seen the spending concentrated more among higher end consumers, and that marginal consumer at the lower end of the income spectrum has started to pull back a little bit. But I would say for the stock market overall, earnings and profits are still fairly strong. You still have the tech sector, which is going along very well also. So, from a valuations perspective too, a continuously dovish Fed, and I have the Fed cutting 3 times in 2026, will only help equity market valuations as well.
Christopher, we appreciate you taking the time to be with us today for the outlook here for the Fed and also for 2026 as well. That's Christopher Hyde from the Texas CIB. And coming up next, we're going to dive into the latest in the saga to acquire Warner Brothers Discovery, as Paramount Skydance is guaranteeing Larry Ellison's backing in an amended bid for Warner Brothers Discovery. We'll get those details and more next on Market on Close.
Well, days going by. I'm waiting if I'm gonna go eat. Back and forth on the open here. New Year coming up. I think it'll be a good one. One of my picks of the year will be Open, O-P-E-N. Yep, that's it. Then I gotta catch Hillary.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me. And my advisor, Jennifer, she was with me, with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Market on Close. I'm Marley Caden alongside Jenny Horn. The ongoing saga to Warner Brothers Discovery continued today with Paramount guaranteeing the backing of billionaire Larry Ellison in its hostile takeover bid for the company. Ellison has agreed to provide a personal guarantee of $40.4 billion of the equity financing for the offer. Now, we'll talk more about it with our next guest. Joining us now, Kenneth Stock, the Chief Strategy Officer at Nexen. Kenneth, thank you so much for taking the time to be with us and talk about this made-for-Hollywood story that's happening in Hollywood right now. I'd love to start with your thoughts on how aggressive Paramount Skydance is being in all of this. They are simply not backing down. What does that tell you about how strategic this deal could be for them?
Yeah, thanks for having me. I think it's so clear how important this is. This really just underlines the importance of this asset for Paramount as they continue to grow, as they try to become a major competitor in this space. If you kind of take a step back and think about what's happening out there, connected TV streaming has now dominated about 100 million households in the US. And each household is spending on average 5 hours a day streaming. That's an enormous amount of time and attention. And as you know, brands follow eyeballs, and that's where the eyeballs are. So for Paramount, this is enormously important for them to get. As you know, they've been going after this particular asset now for some time, and this underscores their importance of getting Warner Brothers Discovery.
Okay, so if, hypothetically, but if Paramount does win, how can Ellison's real deep ties to tech continue to reshape the future of media?
Yeah, it's a great question. I think this is super interesting in the market because of the investments that Oracle has made in AI and how does AI help Paramount win in this space. There's a number of initiatives within the data side, within the cloud infrastructure side, and even if you think about it, the AI personalization of content that consumers will be able to experience to have a much more enjoyable experience watching some of that content from Warner Brothers Discovery through Paramount streaming services.
So how transformative then would you say, Kenneth, that this deal could be in terms of a combined Paramount Warner Brothers business? Because if we look at Netflix on its face, it just sort of solidifies it as the continued streaming giant. But this is potentially transformational for Paramount, not just for the company, but also for the industry itself.
I think it would be very interesting to see how that plays out. Again, that technology, the future of tech as it comes to consumer media and streaming, it really does solidify Paramount's position. And as you mentioned, for Netflix, this is really doubling down on their dominant position within the market with over 300 million subscribers. This really gets them that deep content library that they don't have. They've been making content for a brief amount of time, relatively speaking, but Warner Brothers Discovery has been doing this for over 100 years. So this is an enormous amount of content that would go into Netflix and continue to shore up their leadership position within the platform streaming space.
Okay, so the word dominance is thrown around a lot. Does that give you any pause on whether it's Paramount or Netflix if this deal goes through, just given the regulatory environment right now?
Yeah, something that everyone is asking about and trying to figure out what's going to happen next as that process goes through. We know we've heard some intimations from the Paramount Studios side that they feel like they have a clear path forward. Netflix feels very confident as well. I think we'll see what happens, but I think either way, whoever does get that deep library and that enormous amount of content will be in such a great position moving forward. That's why it's so hotly contested right now.
And in the notes that you sent over, you say that you still see Netflix is in the stronger position. Why do you feel that way?
They just have that global dominance as well, I would say, and so Warner Brothers Discovery brings that content in. I know I've heard from a number of friends who even have learned how to speak English from watching Friends overseas. You know, there's just so much opportunity for international expansion for Netflix, and they continue to do that. This will just solidify their position.
Okay, you mentioned my favorite show, so I have to give a shout out to Friends because I'm a Friends loyalist. But another area of media that I am also very loyal to is all things sports. And so with a pretty major slate of sports events coming now in 2026, really how critical is live sports right now to be in? I know Netflix has dipped its toes, but I'm sure we'll see further development in that space in the coming years.
Yeah, that's something that we've been tracking very closely, and we're seeing the popularity of live sports packages here at Nexen. And so that live sports slate is enormous next year. We have, of course, the Super Bowl coming up, and we're seeing linear consumption of that continue to grow, bucking all trends there. We also have the Winter Olympics coming up, and of course the World Cup, the world stage coming to the US and Canada and Mexico. That will bring an enormous amount of appointment viewing eyeballs to those connected devices. And all the brands are lining up to try to get their messaging in front of those consumers who are there in an appointment setting, which is extremely rare these days. So we're looking forward to a big year in live sports next year.
Yeah, 2026 feels like a battleground, right? Super Bowl, the Olympics, we've got the World Cup. I mean, it's going to be massive in terms of sports. David Ellison has made no secret that he thinks that live streaming sports is a big part of the future, and he wants to get his hands on as many of these sports contracts as he can. Who do you think is best positioned to win this battle in terms of live streaming when it comes to sports, knowing that a lot of these contracts are spoken for right now?
Yeah, it's super interesting, I think, with what Netflix is doing with the investments they've made in some of the areas of boxing and some of the areas of tennis. Of course, they bought the rights to some NFL games as well. And then you have CBS, who has the rights to NFL as well as the Super Bowl on rotating years. They've made a lot of investments in that space, of course, also with the men's March Madness tournament. So we've seen a lot of investments going in on both sides. It'll be really interesting to see how it all plays out.
Okay, and one name we have not given enough love to today has been Disney, because of course Disney's owns ESPN, but is that part of the problem with Disney right now? They're just not in these major conversations, or do you see ESPN perhaps carving out its own niche now in the coming year?
Yeah, ESPN continues to invest heavily in live sports, of course. They also launched their own standalone app as well. I think Disney is saying ESPN is our brand to consumers. We're going to continue to double down in that investment, but the competition is getting even fiercer, again, with Netflix going in, Amazon Prime owning Thursday Night Football for a number of games with the NFL, and we have F1 and we have MLS on Apple TV+, so there's no shortage of competition when it comes to live sports. And what it's really great for, the winners here are the consumers. You can really go to any platform you want to catch the live sport that you're looking for, and I think there's a lot of opportunity for growth there.
Well, it'll be a big year for sure, Kenneth. We appreciate you taking the time to walk through the latest in this Warner Brothers Discovery saga and also the future of streaming as we come into 26. That's Kenneth Stuff from Nexon. And coming up next, we've got Options Corner. Rick Ducat will join us here in our Chicago studio to take a look at Micron after shares hit a new all-time high today. That's next on Market on Close. Stay with us.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out there.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Welcome back to Market on Close. We're watching shares of Micron today after they hit a new all-time high. They continue their meteoric rise in 2025. The memory stock has now rallied more than 220% on the year and more than 300% from the lows that it hit back in April. That, of course, means it's time for Options Corner. Joining us right now, Rick Ducat, our lead market technician, to take a closer look at Micron technology today on the heels of this new all-time high. So, Rick, as we take a look at Micron, no major headlines on this company, but we are coming off of a really good earnings report, even better guidance here. So we'd already seen this move to the upside. I know my opening question is usually, how is Micron faring against the broader market? But I'm pretty sure if you have eyes, you can tell here.
Yeah, I mean, it's a pretty clear-cut case of extreme outperformance. Micron up 207% versus even the best of the other three, the SMH semiconductor ETF, only up about 44.5% or so. So when we also look, though, Micron is part of this smaller subset of chip makers who focus on storage and memory here. So you can see Micron, Seagate, and Western Digital are the very obvious outperformers of the group versus the likes of Intel, Broadcom, and NVIDIA. Even these ones who are the powerhouses of the sector really pale in comparison to this storage space here. And that was the theme of earnings, just demand far, far exceeding supply in the available memory chips that they can provide for right now, and it doesn't seem like it's slowing down anytime in the future.
I mean, it's certainly been a strong space. You can see by those numbers that even the worst performer in the group is NVIDIA. So clearly it has been a good year to be in this space, in this particular sector. As we look at just Micron on its own, though, and in some of the technicals, not just in what we've seen in recent trade, you can see, I mentioned how much they're off of those April lows. You can see that sharp move to the upside. But since then, I see your lines are starting to converge towards each other. So walk us through the technical setup that we're starting to see in recent weeks, too.
Right. You could argue that perhaps this is more of a rising wedge type shape here, where we have our trend line going across these lows here, but then moderating somewhat across the highs. So we have more of a modestly sloping trend line going across those highs, but guess what? We broke out to the upside today anyway. So even though this is regarded typically as more of a bearish type of setup here, it can really go either way. There's no guarantee. And especially then when you do get that rather, maybe perhaps less expected upside breakout move, it can be a very vigorous reaction then as traders kind of scramble to deal with the upside breakout here that it triggers the cascade of orders. So now we can see here, if we look at our moving averages, we're above all our major moving averages, as is to be expected here. The closest one, our weekly 5-day EMA in blue here, could be very short-term resistance near about 258. RSI trending lower here, but we are looking like we're perhaps going to break above this trend line. And if we do start to re-enter that overbought area over 70 on the RSI, that would be a pretty interesting scenario as well. Finally, when we look at volume, we can see that the notable volume area to the downside comes in right around 235 or so. That's the heaviest concentration anywhere near current price activity. Beyond that, I mean, maybe 190 or so will be the next area of interest.
Yeah, that's still about $40 off of where we are right now, because we did see that sharp move to the upside following those earnings. As far as the analyst activity that we've seen on this name here, I've read certainly a lot of bullish notes here. Was there anything notable to you?
I mean, nothing really today, but you could probably do a whole segment just about all the analyst price target upgrades after earnings. TD Cowen, Wolfe Research, Goldman Sachs, JP Morgan, Barclays, etc. There were so many I stopped bothering to write them all out. But just very, very strong bullish analyst activity here. One other thing I forgot to mention, look at the volume spikes here. Very, very heavy volume that we can see after the earnings announcement here. Very high volume signals high conviction on the part of traders.
So when we see high volume like this, Rick, as far as the options activity goes, are we seeing, with hitting this 52-week high and sort of the absence of any major headline driving it, are we seeing any uptick in the sizzle here today?
So actually, it's a little bit lighter over here. The sizzle is 0.86, so that's versus the 5-day moving average of volume here. If we do look out, January 16th, our orange box here, that's our expected move, about 12.3%. That's our most active expiration date in terms of open interest. It's about 29% or so of all the open interest here. The top strikes on the call side, 200, 300, and 270. On the put side, 200, 150, and 135. Those have the highest amount of open interest. One pretty big trade, too, plus 3,000 January 16th, 285 call, $3.84 million debit paid here for this opening trade.
All right, well, a big trade there for Micron, but a lighter day, and they still hit a new all-time high today for Micron Technology. Rick, I want to thank you for being with us for Options Corner today to highlight Micron and some of that action that we're seeing. But I do want to send it over to Jenny Horn to find out who we'll be talking about for Overlooked Stocks today.
Yes, thank you so much, Marley. And coming up next, we will dive into a bullish call we're seeing on Ollie's Bargain Outlet today, setting shares up 2% as they did receive a price target raise as well as just an upgrade from Loop Capital.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
How's it going? Sometimes, you know,
Next. Try again.
you could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest in Trader now.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please.
But there's a...
Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out there.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Welcome back to Market on Close. I'm Jenny Horn in our Chicago headquarters. It's now time to look for an overlooked stock as we're seeing shares of Ollie's Bargain Outlet today on the rise after Loop Capital upgraded the stock. So I'd like to welcome in George Taylor, Senior Markets Correspondent for the network, for some insight on this note today, George. Obviously, Ollie's Bargain Outlet today that is seeing some mixed volatility throughout the year, but following this analyst upgrade, walk us through your thoughts.
Yeah, that's right. I'll talk about the trend this year in just a sec, but for those that don't know, I haven't been to one myself yet, but this is basically a bargain outlet. It's a wholesale kind of membership place like the Costco, but they're essentially a broadline retailer that sells discounted or overstocked general merchandise. They sell name brand merchandise, everything from manufacturers that have overrun, wholesalers and distributors and other retailers bring their contents to Ollie's. They're becoming very popular. In fact, they're in 34 states, got over 630 total store footprint. So they've been growing quite exceptionally well in the last decade or so. But I kind of put them in the camp of maybe looking at them as the TJ Maxx of general merchandise. If that's a way to describe it. But the company also got an upgrade today. This comes from Loop Capital. They increased their price target just slightly to 135 from 130. To buy from a hold rating, and they actually see some improving comp sales for Ollie's going forward into 2026. The competition, Big Lots, which was another sort of broadline retailer that was an overflow or general merchandise overflow business, actually is in liquidation. So one of their mainstay competitors is going out of business and liquidating, not necessarily in bankruptcy reorganization. That's actually a good thing for Ollie's. The other thing is one of the things about Ollie's is that they tend to focus more on general merchandise, but they're actually making a little bit more of an aggressive headway into consumables. So that puts them a little bit more in the camp of companies like Dollar General, for instance, or Five Below. And they also look at, this is Loop Capital now again, look at the seasonal sales as a catalyst for Ollie's going forward as well. But nonetheless, I think what's happened here in the past 6 months or so, if you just look at the stock year to date, it's still higher. But it has been trending, I suggest, very similar to Costco, especially going back to July. And I think this is indicative of what I talked about in Costco, or for Costco, which was we saw a little bit of a multiple compression in Costco. Even though earnings are growing, and of course top-line sales are growing, the price is falling because we're just basically seeing an industry group multiple compression. And I think Ollie's actually got caught in that, and that's why we've seen the stock down, especially since July, but still underperforming, I would say more consumable-based discounters like Dollar General.
Yes, so that was my next question is, you mentioned Dollar General, Dollar Tree, Five Below even had really great earnings recently, as well as TJX has been an earnings star this year in retail. So then where's the disconnect with Ollie's? Because so many of these Ross Stores is another name that's had a pretty stellar year. We're not seeing the same benefit to Ollie's despite operating in this bargain treasure hunting world.
Well, like I said, I think what's going on is essentially institutions, Wall Street analysts are sort of re-rating Ollie's in the same camp as Costco. And again, that's essentially where we're seeing the underperformance, let's call it, of Ollie's compared to, let's say, Dollar General, Five Below, or even TJ Maxx. So, but I think today's news, at least from Loop Capital's perspective, is that they're moving a little bit more into consumables. What this ends up doing is it ends up driving more traffic. Because consumables don't last, and so people come back often for repurchases. And so with that said, that can actually improve operating leverage. In other words, increasing same-store sales, like Loop Capital denotes in their call, increases their margins. One of the other things that I did also notice in Ollie's when I looked at this compared to Costco is that the earnings multiple right now on this year, 28 times, next year at 24 times, it's now trading at a discount to its 5-year average, whereas Costco is still selling at a little bit of a premium. So maybe, Ollie's is setting up for a potential trend reversal here. I can't say it's happening anytime soon, but nonetheless, I think it's interesting or worth watching because I did also notice that, top-line sales are pretty consistent around 12.5% year over year. EBITDA last year grew about 11.4%, but next year, it's estimated to grow at 15%. And if you do the math on that earnings multiple at around 24 times relative to that growth, it's trading at less than 2 times next year's earnings growth, which again, might be interesting, I guess, from a comparative standpoint. But still, the stock is trending to the downside on a daily chart, so it hasn't really demonstrated a major trend reversal yet.
Okay, so is there any risk to diving deeper into this consumables area of their business? Because I was reading about how merchandise has been their star. Yes, so they're trying to grow, of course, outside of that aspect, as you mentioned. But then I do tend to say, hey, I remember the growing pains of, say, like Dollar General trying to get more into consumables, where it was a bit of a margin hit and also just expensive to manage that inventory. Is that then any overhang while also being perhaps a positive as you go into the new year?
So right now, just based on the way the stock is reacting, perhaps the movement into the consumable is expecting to hit margins. I'm just using the language of the market, Jenny, is just kind of elaborate or evaluate in that regard. But I did notice, looking at net income margins last year, they're around 8.9% of sales. So this company, for what it's worth, is much more profitable than Costco. On a dollar sales basis, it certainly doesn't have the scalability nor the volume of sales. If you just look at the sales on the business, $2.5 billion, market cap is very low at $6.62 billion. So it really is a smaller cap, version, sort of a hybrid version of Costco or even a TJX. And you have to keep in mind too that Costco has a low margin business because more than 50% of their sales are food and sundries. So again, those are lower margin business, so maybe Ollie's is going to be sacrificing some margin on a per dollar sale, but maybe increasing the volume of sales because of those recurring customers and more foot traffic that is generated on a recurring basis from those consumables, which again create more repetitive purchases and more repetitive visits.
Yeah, I think a really great comparison to Costco, which I just didn't frankly realize that we were down in Costco by about 8% this year. So actually looking a lot more like all these, to your point, which is down 0.5%. But at least higher today, we're up just shy of 2% after this loop upgrade, and $135 price target obviously implies some decent upside from where we're currently trading at just below $110 a share. Appreciate it though, George Tillis, Senior Markets Correspondent for the network, for that breakdown. But now I'll send it back to Marley in, of course, Chicago here.
Thanks so much to Jenny and George for overlooked stocks there. We are nearing the end of our market session today. That, of course, means we'll be bringing in Kevin Green to take a look at the S&P levels that he's watching as we head into the close and to break down today's action. That's next on Market on Close. Stay with us.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you could have done better. The same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst call. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Welcome back to the Market on Close. I am Jenny Horn alongside Marley Caden in our Chicago headquarters. Now, there's just a few minutes left in today's session, so I'd like to welcome in Kevin Green, Senior Markets Correspondent, to help us close out today's session. Kevin, what levels are sticking out to you on the S&P 500 that you are keeping on your radar as we approach the close?
Yeah, well, obviously we've been hitting this area of resistance, the 6880-ish area, and we have been kind of rejecting it, but it's kind of normal for an environment like today. We actually did see a significant amount of volume on the options front, but the volume on the equity front is also a little bit light. That's not uncommon, especially for the holiday week. So 6880 is going to be our pin area of potential resistance to the upside here. And if you're looking for a downside area of support going into the close, 6865 is going to be a key area of support. One thing I'll kind of also note is the crush in volatility is actually pretty significant. This is the lowest vol that we've seen in the market if you're just looking at the VIX since December of last year, around December 14th, December 15th. So we're at pretty extreme low levels for now, and that probably provides an opportunity for those that are looking to hedge their portfolio to pick up some cheap premium, especially if you look longer in duration, more than a month out, even 3 months out. Volatility is relatively cheap. So with 10 of the 11 sectors in the S&P 500 in the green so far, this has been a pretty decent day, especially to kick off the week. Let's see if we're going to be able to maintain this type of activity going into tomorrow as well, in order for us to try to make new all-time highs by the end of the year.
And KG, you just mentioned the VIX there being at one of the lowest we've seen. What do you think is driving that crush that we're seeing? Is it low participation? Is it the holiday week? Is that to be expected here, or do you think it's something else?
Yeah, I think it's low participation.
We got less than 2 minutes.
A signal that the market is anticipating better than expected economic data, especially when you're looking at PCE and some of these inflationary prints that we will be having over the next 2 weeks, 3 weeks or so. And I think the market's kind of pricing that in, but unfortunately, it's easier to push volatility higher than it is to push.
We're in the close. Start off with 200.
Because it is at an extreme low here, so I would just be very cautious around this. And this is what makes it hard for trading in a week like this week, as well as next
Very
week.
good.
Price action is probably going to be a little bit more bullish, but the volume is really not going to confirm that, and the volatility is really not going to confirm the bullish trend of that's going to stick, if you will, and actually maintain itself. And so I would just kind of be a little bit cautious that first week, second week of January could get a little bit volatile, and a re-rating for volatility, or if you're looking at the VIX, is to be expected here, especially at these.
Oh, really?
Okay, especially when we look at regional banks, I mean, what price performance
January
is
going to be volatile.
We're seeing a lot of focus on the sector going into the back half of this year. Of course, the year closed.
Boom!
Yeah, you are seeing, obviously, regionals catching a pretty decent bid here.
Well, there you go. There you have it. I'm back. Well, let's see what tomorrow brings. I'm sitting to dream about what I want to get watch-wise for Christmas. Mm.